GM Berlin, welcome to day 2 of DappCon. I hope you had a good day 1 and are well rested. We'll be starting, let me introduce myself. I'm Deep Shah. I lead the growth and marketing at Gnosis Pay. This is my second DappCon. I'm super excited to be here. It keeps on growing every year. Today, we have the first talk by Marcos Nunes. He's the co-founder and CEO of Gnosis Pay. As a lot of you might already know about Gnosis Pay, last year we presented at DappCon, which was about the self-custodial cards that we've built. This year we have something different. We're going to speak about what's next in store, the future of banking, and I'll let Marcos come on stage. Can you have a round of applause, please? Thank you.
Good morning, everyone. And thank you guys for being here. I'm very excited to talk about Banking 3.0. It actually glues everything that we've been working for the past 2 years. For those that only believe that we were doing cards, we'll now see what else can you do with the instrument that we're basically putting out there. So we're in a mission to build a borderless banking platform, creating interoperability and composability between TradeFi and Web3, making global banking cheaper, faster, and simpler. So I've been in payments for more than a decade. I'm old. And what I've observed is actually fintechs, even when they're transforming payment or disrupting, they're still offering siloed, bundled solutions built on top of legacy systems. And at the same time, you have Web3 creating new ways of doing things, but of course, it's still far away from the Homer Simpsons or my dad user, which makes it very difficult to get to that billion users. So as a result, we end up having citizens still blocked or locked in the traditional bankers. So the banking evolution. In Banking 1.0, bankers realized running banking was very costly, and they kept opening branches all over the globe, representing their brand. Ultimately, bankers used technology to leverage profitability. And then we saw Banking 2.0, which was finally then technologists understanding that bankers were not doing a great job, but they could basically build a front end which was a lot better, a lot simpler, even though connected in legacy offers, making the life of users better. But then we're in the era of Banking 3.0, where ownership is given back to those that should hold it. So effectively, users regain control of their money, and they will finally start banking without those traditional bankers. So it is time to separate them one from the other, bankers from banking. What the heck do you mean? Well, everybody should have access to financial rails, and users should have a choice to use or not the bankers that they want to use, or have their own custody of their own funds, no longer having to use the mattress. Maybe I should tell that to my dad as well. So global retail banks, probably very common to all of you in this stage, but let me remind how difficult it is and why we do not have global bankers. In fact, if you actually look it out there and research, it's less than a hand of bankers that might hold a full banking license in all countries available. And why? Because financial regulations differ on a country basis. And you need lots of rules around custody of funds, rules around moving funds, and especially for clearing and settlement of those funds, interbanking clearing. Well, that leads me to the second point, which is the payment rails. You have different types of currencies, and different types of systems that needs to be liquidated in order for those banks to operate locally. And then finally, you have also users, which differ. Some users are very used to instant credit. Some users are not in need of that instant credit yet. Even though technology, Apple Pays and the Google Pays between users globally, you still have different behaviors, survival need for credit and luxurious need for credit, right? So imagine that complexity to bundle that and say, I am a bank that is able to do all of that to the community level. I'm not even talking country level, makes it quite difficult. And even when they do so, bankers, they normally choose that very profitable layer, which is the one paying the highest interest on money borrowed, and providing, of course, zero write-off to them, or nearly no lack of payment of those financial instruments, and therefore making them focusing on a very specific target, rather than doing for all. So we saw the trajectory of neobanks out there. Here's a little bit of the evolution from the past 3 years. You see Monzo basically partnering up with Wise to offer a better offer. So a neobank partnering with a money remittant partner and then effectively getting a cheaper solution to the user. And then you have Revolut hitting 25 million users. But all in all, if you look all of these initiatives, it's nothing truly new. And on the other hand, we have our community accelerating extremely fast, making complex topics a lot more my dad proof, which is complexity around wallets and keys and assets, how they're being transacted. But again, organizing themselves in separate groups. And in one hand, you have a crypto user, very willing to do very complex things in order to close the loop for banking, payment, transfer, investment. And on the other hand, a very spoiled group, which is not willing to learn a lot more than just give me an account where I can put my money and I get return on my investment if I have one, or if I need credit, that I do so with the lowest interest rate possible. We need to basically make sure this is merged. How are we going to merge that? If we basically do banking 3.0. So neobanks are trying to develop the global accounts. Traditional banks claim that they offer global accounts. With the separation of asset management and treasury management from banking, we can actually do global accounts. So what is an account, right? I have a money transfer coming in. It can be through a deposit, through an employer payment, and then it sits a digital balance of that money. And from that balance, you have instruments to move that money out, which is a card, which is a wire transfer, or something, or like a withdrawal of cash in an ATM. Okay, so what is the new core banking account then, given the infrastructure that we have out there? Well, now we use blockchain, which means we have assets which are no longer fiat, or let's call them digital cash, digital money. Then you have EUROEs, GBPs, thanks to Monerium, and we have USDCs and EuroCs to Circle, or XDAI, SDAI, and from Gnosis, right? Now, those are pegged against traditional currencies with zero volatility or very little volatility, whatever you choose. Okay, then you have the smart accounts. Pioneer, like Safe, have built the account abstraction. And then you have decentralized KYC and KYT, ensuring that every data now is migratable. By the way, this is the dream to regulators. And we keep talking about regulators. And in European Union, for instance, there's something called open banking. What's the objective of open banking? Data belongs to the user, it's portable, and if I want to have credit from different financial institutions, they should be able to access my score. But the incentive today doesn't allow you to do so, because the financial institution that is serving you will no longer have that need to, will no longer have you. So why would I share the data? So it's a very conflicting point. Okay, so let's break it in capabilities. So we have the card capability. Thanks to Visa, we have Visa Money Sent, which means it's an instrument for you to get money in. And on the money out, Visa created something called multi-currency, where users can spend multiple types of currencies like domestic transactions. If I hold US dollars, I can spend US dollars. If I hold euros, I can spend euros. If I hold Brazilian reais, I can spend Brazilian reais. Virtual cards, of course, Apple Pay, Google Pay, and you have cash withdrawal. Okay, so card capabilities are set. Account capabilities, they're also set. We have instant payments, cash in and on-ramp, which means connected with faster payments, UK, SEPA, European Union, PIX, Brazil, and given an account number, you are now with an account. And the same goes in the way out. Then you have additional capabilities, which is paying bills and local direct debits. And then you have, finally, a Web3 capabilities, which is very familiar to this room. You can basically go from on-chain, bridge, swap your tokens, transfer funds, and then off-chain them in a similar manner. So, yes, it is set. It's ready, it's live, and I have been living on-chain for the past 3 months, paying my bills, just by basically doing exactly the way I used to do with Barclays. So I get money directly from an IBAN issued by Monerium. That money becomes EUROE. That EUROE sits in my account, and then I go and I spend those EUROEs at the point of sale. Oh, but Marcos, there are taxes and blah, blah, blah. Guys, money coming from IBAN, from an employer, it's already deducted taxes. So it's effectively an account. But what other capabilities can you use? I actually pay this garage rental with IBAN transfer. I send EUROEs via IBAN, burned by Monerium, fiat in the account of the garage owner. Oh, but you also have money on chain. Yes. And then I bridge, swap, get my EUROEs, and then I get it into my account. So, effectively, what are we missing then? In order for this to be global, since we have the separation of asset from banking, we gotta go and integrate as many clearinghouses, as many countries, as many plugs we can, so then those that are in custody of funds, either because of stable issuance or maybe a centralized exchange, maybe Binance, maybe a bank, it's not up to us to define who is going to win. In fact, hopefully everybody wins, because that means the entire 8 billion people in the world have an option. It's all about optionalities. So, geographic rollout. I need to make sure in every single country we're plugged. What does that mean? If I'm in Europe, I get an IBAN. If I'm in the UK, I get a sort code and an account. If I'm in Brazil, I get a PIX key. If I am in the US, I got bank, branch, plus account associated with my blockchain address. And if I want to do instant payment, I am connected to the new, faster payment mechanisms. For those that are not aware, one of the highest costs in banking and payment are associated with collateral, because 6 p.m. in a given country, you have the cutting line for the interbanking transactions, and it only reopens next Monday. With all these faster payment initiatives, you can actually do it 24/7, 365 days a year. So by being plugged there, then having local methods like direct debit, SEPA, or Pix, Invoice, Boleto, whereas FedNow, we can basically offer all these stables to be connected and digital assets to be connected to local markets. So you have card schemes, you have licenses, and a bunch of other complexities that will make it extremely challenging to roll out this, but we are in the process of doing already. Right now, we have live 2 countries, and Europe is a country in the eyes of implementation, right? Because it's one regulator that you can passport throughout 29 countries, or 27. Then, the moment we add Brazil, we have 3 countries and 3 routes, which means a Brazilian user can actually pay or transfer funds to the UK. The same for Europe. But the moment you add the 4th country, you now have 6 routes. Because effectively, you can basically transfer balances and funds to all those destinations and exit in all those destinations. What am I saying? Wise, Revolut, Nubank, which is the largest neobank in the world with over 100 million customers, we compressed all their hard work for the past 10 years, and we roll out in the past year. Everything they have been fighting for, all these difficult licenses, banking licenses they have been fighting for, we're able to do it in a much easier way, simply because we're not touching funds. Because we decided to separate bankers from banking. I'm in the mission of providing access. I'm not in the mission to make yield on top of people's money. Eventually, those missions can collide, but let the world decide if that's the way to go. So, by basically implemented what I just said, we're saying we're creating banking 3.0 in Europe, in the UK, now Brazil, soon to come US, maybe next country. Effectively, you created the bank rails to anyone out there. So, what happens to bankers? Can they have access to this? Definitely. I'm not here to decide if they should exist or not. Users will decide if they should exist or not. BlackBerry was not chosen when Apple came in. Not up to us. So if a banker wants to issue our card, they can. And they can turn it on and off money movement via blockchain. So right now, any bank in the globe can get the Gnosis card. As much as right now, any wallet out there can get the Gnosis card. So, but we can't do it all at once, and we need to start somewhere, right? And this is a very important element. We talk about capabilities, and we talk about regulation. There is always a light touch. What is a light touch? Exactly how we started. We needed someone to help us with the license, someone to process the fiat transactions, someone to basically be our godfather in the process from a responsibility point of view. Very expensive setting to start, and we knew it from day one. We got a lot of help from Visa to take off, that was actually extremely important. But effectively, we started. We started with a partner that provided an account number. We started with cards being issued in those two places. But then, as we move, we want to go to a more complex capability, getting licenses inside of Gnosis Pay. Why? Because the more you are in front of the regulator, the more you can help with the new world. This is not different than what they have been doing for the past 100 years. The only difference is we can provide more transparent and clear view on how to use this technology rather than the legacy costly technology. So as we move, we can go from simple setting to more sophisticated setting, giving users more capabilities because we're able to understand them, underwrite them, and provide better services that now do not rely on interpretations. Then, as you get more mature, then you move once again. More capabilities. Now you are plugged into the local clearing and settlement houses of different countries. And this keeps going and going and going to the evolution that we can add a lot more countries, a lot faster than anyone ever did it in the history of banking and payments. So, what do we got right now? Last year, we announced we got a card, but it was never a card. It was basically your first current account, checkings account for the Americans, spending account, you name it. And that basically holds the capability of multi-currency. USD, GBP, EUR-E, you name it. Then we integrated IBANs. You can now pay bills using your IBANs. So let's, IBAN your transactions out. Then I heard very, very important person in Coinbase saying that he never got such a great FX in a transaction when going to the US. We enable that. And we also enable on and off paying a ramp from Gnosis Chain as well as chain transfers. And the funny aspect is we have not created additional cost, which was the entire objective. It was to leverage existing Rails cost set by traditional players. But don't you want to eliminate all these transactions and all these costs? I cannot, guys. But consumers can. Only by bringing billion people to this world, they will basically push existing costs that they are not willing to pay anymore. So, maybe first time we're saying this out loud. EA, UK, ready to go, get your cards, experiment. We're coming soon this summer. Brazil, Argentina, Mexico, Colombia, Australia, Singapore, Thailand, Japan, and Indonesia. So we are going fast. I need you to join us to transform the world's financial infrastructure to finally democratize banking worldwide. Thank you. We have some minutes left. I would love to get some questions from the audience. So please shoot.
I'll just ask everyone. Guys, any questions? We have one here.
Hey, great talk.
Julian.
Yeah, it's me. Julian from Safe. So one question, other than interchange fee, how do you intend to make money on the long run?
So there's several aspects on the economics. You start on interchange fee, there's cross-border fees, multi-currency fees, there are FX fees. So all of those fees are basically inside of already the ecosystem, and we can basically tap on rather than charging the user, just taking it back from what is being charged in the process. So let's say there's 4% charge, 3%, 2% charge to the merchant, and the fees varies depending if you're a domestic customer or an international customer. And there's sufficient revenue to be made in that part of the end. Our objective is to be as nothing fee possible to ensure that we get the adoption on the on-chain side. And hopefully, if transactions are moving on-chain, the cost of transaction becomes even exponentially lower to the degree that you can increase profitability, again, by not having to charge fees on the on-chain side.
Thank you.
Thank you.
Any more questions?
Oh, two.
Yeah.
Upstairs.
Thank you very much. Just a quick one. Actually, an awesome presentation. Thank you very much. Yes, my question is like, you mentioned on your slides like easy on and off ramp for Gnosis chain. So I was like interested if you plan to actually enable more chains in the future to address more adoption.
Yes.
Thank you.
You know, that's probably one of the questions I get the most, regardless of where I go. And there's many explanations to this. Number one, like I said, it's not the card. The card itself is extremely easy to go to multiple chains, right? The problem that we are trying to resolve is this multi-connections and rails to many countries out there. And those nuances is not only about the technical integration, but the safety or security mechanism to avoid bridging and to avoid risks of transactions failing. So when you go multi-chain, trying to replicate all of those elements, plus KYC, KYT elements, plus different types of storing elements, it makes it extremely complex. However, we have been, of course, since day one thinking, how are we going to expand to multi-chains? Because definitely that's something that makes sense. So the drawing that we have in mind, and still, of course, not concluded, and again, I welcome you guys to help us fixing this problem, is by basically providing cards in different chains, and then trying to bring from pre-settlement stage onwards back to Gnosis, because that would avoid lots of development outside this ecosystem, which is, again, the main objective. We need to make a strong ecosystem that can perform to the standard that interoperates among multiple regulators out there. So it's not a trivial answer, and I wish we could just go in every chain and just simply, deploy it. But I think for now, it would be great to have users coming in, growing this with us, and eventually we can actually walk towards multi-chains approach. But again, people have an idea for it, would love to get it, so please ping me on it. Thank you.
Next question.
Thank you, Marcos, for a great talk. For customers in emerging markets like Indonesia or India who can't KYC, how can we onboard them into Gnosis Pay?
That cannot KYC. Now you got me there. What do you mean with cannot KYC?
Like people who don't have an ID, people who don't have a bank account, people who don't have access to most traditional forms of proving their identity.
Okay, now I got you. So the reality is most of the emerging markets that we've been tapping, that we are expanding, there are users that we can onboard. The majority of the users, actually, we can onboard. The offer that we're going to those markets are normally reason why those people are leaving their countries and trying to bring money back. So it's remittance as an angle and payment as another angle, meaning I don't trust my currency or it's too volatile and therefore I would like to hold USD, euros or whatever, and then spend at the point of sale with the best conversion or the minimum conversion at the time of the transaction. So I have not experienced sufficient issues on the onboarding. For instance, Indonesia, that's a very specific question. But Brazil, Argentina, Mexico, we've been exploring a lot. Thailand, Singapore, and basically we actually have mechanisms to onboard these guys, and this is what we're going after. I'm certain that in 2024 we're not going to solve the global's problems, but the mechanism should enable us to accelerate forms of validating people and making sure you are eligible to have a card.
We have time for one last question.
Maybe we can do two very quickly. One here and yeah.
Yeah, I have a question about regulations. What are your mechanisms for crypto assets spending as fiat, because it can be money laundering?
So help me a little bit better with your question. So what do you mean? So
when you have crypto assets, you bridge and then you start spending as fiat. From fiat, it's clear, but what are regulations talking about that?
Okay. It's a very interesting point. Are we spending fiat or are we spending EUROEs? And is EUROEs fiat? So there's a very clear understanding that EUROEs is digital money, not fiat. And therefore, when you're spending with the card, you're spending digital money. I think this will evolve. There is a very difficult gray zone at the moment. And we're happy to be in the gray zone and help to provide clarity. And therefore, we can operate as someone that will not touch funds because it's digital money, and we don't touch the digital money ourselves. So I see this problem evolving over time, and I see that MiCA and other regulators are trying to understand what they're going to do with it. But for now, it's regulated. We're not trespassing. We had the approvals of everyone, and basically you're safe to use the product. We had a final question on the other side. Sorry, yes.
Yeah, absolutely lovely presentation, and I'm also a user of Gnosis Pay card, and it's awesome. So to your
You're a great guy.
Sorry?
You're a great guy.
Yes, I am. Thanks. To your earlier point about removing the challenge about the multi-chain support. So if you did not have to rely on the Gnosis Safe Smart account, but another secure, maybe a hardware wallet or something, wouldn't that be like a big unblocker for making it multi-chain? Of course, there is the faster settlement and stuff involved, but wouldn't that, do you have some constraint saying that, okay, it has to be Gnosis Smart account?
Okay, so let me answer in two ways. First of all, I need to make a disclaimer. Stefan is my co-founder, the specialist in the Gnosis, in the chain side. But let me answer from a bit of a history, data that you don't know. We started this project as a joint venture between the previous company that I was part of and Gnosis. And then we basically spin off. What was the first project? A hardware wallet that could pay at the point of sale without having any interaction on chain to make a decision, and basically just informing the decision was made between the hardware product and the point of sale. That was basically, you could have funds in multiple places, multiple chains, and you could basically do it. It is so difficult to scale. First of all, numerous touches in the back of your product, like of your phone, basically, okay, password, tap the phone, okay, do you allow this transaction, tap. So you have so many things you gotta do prior to a transaction. Imagine a Homer Simpson, or imagine a little bit chubby doctor, which is my dad, that has no idea about technology, having and grab the phone. I mean, my dad still write the password in the back of the card, so please don't tell anyone. And so it would be impossible. We are talking about 1 billion users. We had to think from that angle backwards. I think the multi-chain, it's not a faraway problem to be resolved. It's just that we need a little bit more maturity. We need more users. We need transactions. Like we have a lot of people that hold their cards today and still have questions about taxes, how difficult it is with the tax part and stuff like that. So there's lots of myths that needs to be removed on the current setting, and hopefully we're getting more and more comfortable with to then scale this product and hopefully then go to the next chains with a way that we're not removing users and transactions from the chain, rather making a settlement where we are relying that connections with the traditional world are in place, everybody's comfortable, and we can then make sure we're all moved to a new world together. With that, thank you very much for your time. Sorry that was too early, but I'll see you guys out there. Thank you.
That was amazing, Marcus. Thank you. We'd love to keep the questions coming, but we need to start the next session, which is a special session. Marcus will be available around the booth for any more questions. Before I announce the next session, we're just going to take a moment's break, like a minute or two, and we'll start. Hello. Before we move on to the next session, since we are speaking about Gnosis Pay, there's a small announcement I'd like to make. Gnosis Pay is also running an offer just specially for DappCon. Anyone who orders the card with a voucher code that's on our booth, you'll get the card for free. And on top of that, we're also having a campaign just for today. The first 50 people that come to the booth that don't have a card, we'll be giving them a card on the spot, like a DappCon special edition card. And that's generally unheard of. Usually cards take like a few weeks to come. So yeah, it's a small campaign. It's not been announced anywhere. So please, if you don't have your card, you can get it for free today. Moving on to the next session. We have someone very special coming. Someone that comes from almost a different world, the TradFi world. I don't think we've had that institution participate at DappCon before, as far as I know. We have Micah, the head of crypto at Visa Europe, coming and speaking for a fireside chat with Marcus. Please welcome both of them. Cheers.
All right, long time no see. Good morning. So, sorry for being me again. It was supposed to be Breno from our team, but unfortunately he had some family issues and he couldn't come. But I'm actually super happy to host this panel. Micah, thank you so much for coming.
Thank you
I know
so
it's
much
a very
for
far
having me.
away for you.
Yeah,
you know.
very excited to be here. Thank you so much.
Thanks. Maybe for you guys to know a little bit more about Micah, she had a very interesting career so far. Allow me to read her bio. It's basically Micah, a Visa crypto business lead for Europe. In her position, she's responsible for very difficult words, which means she's going to help anyone that is interested in connecting with Visa when doing crypto activities. And at the same time, she also worked for Visa in the part of a relationship with governments, which makes her role even more interesting, because she understands the regulatory aspect, what people basically are worried about it, and at the same time, the technicalities to ensure that we can bring that billion users back to crypto. So hopefully I didn't miss anything. She studied in London with bachelor in Maastricht. I've been to Tilburg. So, very familiar with the region. And yeah, so let's start. So, of course, we're all interested in relationship of payment networks, blockchain, the evolution, banking 3.0, a little bit biased on that topic. How is Visa approaching the challenges of interoperability between, traditional and crypto?
Yeah. So at Visa, we want to add value to all forms of money movement, and that's whether that's within the Visa network, within VisaNet, or whether that's outside of VisaNet. Outside of VisaNet, it could be ACH, it could be real-time payment networks, but it could also be blockchain networks. And so the way we try to bridge it is by connecting the crypto ecosystem with our clients and existing connections. So our 130 million merchant locations, or our 14,500 financial institutions that we work with. And we do so in numerous ways, right? But it's really important for us to be that trusted bridge between the crypto ecosystem and the traditional world. And as such, we really study these new technologies, go in and partner with companies and partners on both sides.
And how do you see basically traditional financial institutions in the blockchain topic itself? I mean, still a big myth. It's like, oh, crypto, no, please, far away. Or is it something that they're embracing more? And if so, how are they embracing? And how are those requests coming to Visa?
Yeah, it's definitely still early days for traditional financial institutions. I think probably the majority of people in this room deal with crypto day in, day out. And this is not necessarily the case for more traditional players. But what we've really seen over the past year, so we started the crypto team in 2018, that we had a phase where there was a lot of educational work. Then there was a lot of distrust, I think, with all that we know that happened with FTX. And now what has changed over the past 12 months is really an increased interest, not just from crypto platforms, but also from traditional players, merchants, fintechs. So the variety of partners that reach out to us that want to collaborate and explore opportunities and innovations in the space is really accelerating and has been accelerating in the past 12 months.
And what is the number one reason? Why do they come to you? Is it cost? Is it basically, I'm lost? I have no idea if I'm going to lose my job. Please help us to understand, because I think one of the things that's quite interesting, the more you understand why they're coming, the more, the group of people in our community can actually think about solutions to connect those two worlds.
Yeah, I think the reasons are very different, but what sticks out is really the demand that they see on the consumer side. So when we talk to our clients, we start by saying, look into what's the demand on the customer side. How many of your bank customers are actually using crypto today? How much activity do you see in the space, and how much demand is there to maybe invest in crypto assets? And so I think that our business, as well as our clients' business, is very much driven by demand, which is probably one angle. And the other angle is, and I'm speaking more for Visa than for our clients here, but we're really seeing the pace of innovation accelerating in crypto. So there is a very different dynamic and very different pace, and the technologies that underlie crypto really do have the potential to impact the way money is being moved in the future. And that's something that touches our core business, but also touches financial services, commerce, and the wider space of where value is being moved across different networks.
Yeah, it's very easy when you do not understand payments to kind of trying to find the bad guys against the good guys. But there's one interesting element of Visa, or MasterCard Visa, I mean in general schemes, is that you are bringing that interoperability to millions of businesses, which at the end of the day, they need to sell. And if you want to sell, you want to make sure that somebody's going to take the goods, walk away, and you are certain that you're going to be paid. So what projects do you see, or what initiatives do you see that could be helping more of those interoperabilities, that, you know, it helps you to move this money to those merchants and make them actually feel like, okay, there's maybe digital assets now that I want to receive. I mean, Visa should not make a difference between euros, pounds, dollars, or whatever the world is claiming, right?
Yeah, so I think one of the interesting projects is definitely the Gnosis Pay Visa card. But
Oh, no bias.
But if we, maybe I can talk a little bit about the focus areas and how we sort of entered the space and the strategic pillars and the activities where we are active today. So we realized when we started this that consumers, as you mentioned, want to have an easy way to spend their crypto or to use their crypto, purchase crypto. So we started by entering the space in the on and off ramp side. So making it very easy for consumers to purchase crypto or to purchase an NFT using their existing Visa credentials, something that everyone has in their pocket today,
yep.
And to make it very easy for them to participate in that ecosystem. And then obviously once you participated and once you're in the ecosystem, you may have different reasons of why you want to purchase crypto or NFTs, right? It may be because you want to generate more wealth, or because you want to make cross-border payments, or because you live in a country with a high inflation. The reasons may be various. But there will be a time where you probably need to off-ramp again, so where you want to spend your crypto, and maybe you don't want to use 5 steps in doing that, right? Maybe you want to have it all in one place. And so this is where crypto-linked cards come in, where we partner with crypto exchanges and platforms and players like Gnosis to issue credentials that makes it very easy for you to spend from any balance, any crypto balance in the back. And the beauty of that is that on the merchant side, these 130 million merchant locations, they don't need to be crypto fluent, they don't need to upgrade their POS systems. They can just use the system that they have today. And so on and off ramps have really been I think the first step into the space for us. But there are other elements of the technology which are very interesting and which can help on this interoperability side, which is around the infrastructure side. So today we transact in more than 160 currencies, as you've mentioned. A stablecoin or a CBDC in the future is just another currency for us, another form factor, basically a digital form of a currency. And so there is nothing that should prevent us from accepting those new forms of money on our network as we accept 160 currencies today. Obviously, they need to have the necessary safeguards in place, and they need to meet the standards of a currency that we feel comfortable with. But so we experiment a lot on the infrastructure side to see how can we leverage the underlying blockchain network on which the currencies are running on top of. So that's a third area. And then a fourth one is around the existing client base that we have. As you mentioned, we have a consulting practice within our Visa Consulting and Analytics that go in and really help merchants, fintechs, banks to understand digital currency, what are the trends, what can they do with it, what offering can they bring to market. And then lastly, regulators, central banks, they are also in this journey. And they probably lagging a little bit behind even the private sector. So how can we help and engage with regulators and experiment with them when they develop their own digital currencies? So partnering and going in and developing POCs and innovating jointly with central banks.
I mean, there's one, of course, specific, I mean, two comments. One is, of course, traditional regulators and traditional businesses takes longer to adopt technology. I mean, in payments, we saw things like TSM being the first format of people transacting contactless, and then later on, the contactless payments. So between the first initiative, 2011, or even 2012, there was a project called ISIS in the US, which was funny. That involved Bank of America and large telcos, the three largest banks, three largest telcos trying to do payments with contactless. And only in 2017, 16, when Apple Pay truly created that easiness, then you could actually see contactless payment taking forward. But you guys actually took the effort to even provide settlement in stables, which is actually for me, even though it's still, of course, a initiative, it's a project, but that actually says a lot about how much you guys are vested in the technology itself or the possibilities of the technology. So can you comment a little bit of that?
Sure. The pilot that you refer to is what we call the digital currency settlement. So we have started to test with a selected group of issuers and acquirers to test if they settle their obligation with Visa in a stable coin. Today it's USDC, and so I don't know how familiar everyone is with settlement, but it's a truly back-end process where it really relies on traditional banking rails today. And so when someone asks you what's the benefit of a blockchain technology, you will probably all say instant settlement. You will all say it's fast. You will say potentially it's cheaper, depending on which chain you use.
Oh, it's definitely much cheaper.
And so with today's, even though I think it's very, our settlement system is very efficient, and we've been working very intensively on it for the past 60 years, there are still challenges to settlement today when it comes to settlement windows. So settling over the weekend is difficult, has multiple implications, not just technical implications, but also when you're based in particular countries, you may have different challenges. And so we see a potential that blockchain technologies can serve to improve these settlement pain points that we observe today. So this is something we're testing, we're very excited about, and I think which holds great potential on an operational efficiency point of view.
Well, allow me to add one thing to it, because it's, I mean, of course, in terms of interoperability, connections, Visa, it's, you know, all over, connected everywhere, extremely interoperable. But settlement is probably by far the largest cost we regular citizens pay in payment, because you have the collateral, which has to be made available for the period that the money is not settled between the institutions. And that money is just sitting in an account in case a institution fail to then take that money and repay back. So the cost of that, of course, it adds up from all these financial institutions all over the world. US has what, 4,100 banks, last time I checked. So then add all the banks in the world, all financial institutions, all e-money licenses, all money transfer licenses. Then all these institutions basically doing payments, putting collateral aside. That money could be then reconsidered once you have 24/7 access to the cash, to the settlement. So by taking this initiative, I think, I mean, payment enthusiastic for more than a decade in payment is massive, and hopefully this is scaling, and we're helping to scale, and everybody in this group is helping to scale, and yeah, we don't have to depend on traditional settlement. But anyway, just maybe a small biased view on it. But then what's missing to we widely spread, get crypto to be #1 adoption? I mean, it reduces so much the complexity on money movement. Why not just using as a money movement instrument behind the scenes? Forget about it if it's Ethereum, Bitcoin, Dogecoin. Remove that aspect. So let's just talk about the technology. So why not? Why is it so difficult?
Yeah, I mean, even though it reduces the complexity of money movement, it introduces a whole suite of new complexity for the user, right? So when you pay today, you just want to go to a store and pay, and it should be easy, fast, it should work. You don't want your card to be declined. It should be convenient. It should be secure. That's not necessarily always the case in the crypto space, right? You need a bridge different chains, you need to connect your wallet, sometimes it doesn't connect. There's a lot of complexity, and I think people in this room have probably been early investors in this technology and spent the time and energy to understand all of it and to are curious and go in and test and explore. But the day-to-day user who wants to pay and doesn't spend that much time with crypto probably finds it very complex and very difficult. So what we learned from our experience in payments generally is that you need to fully abstract the complexity for the user when it comes to paying. Just like you, when you want to get water, you just open up your water tap, right? You don't look at the plumbing system that's behind the wall. And that's the same that we need to achieve in crypto, that everything that's so complex for users gets behind the wall. And the way we achieve that, or what are some of the aspects that I think we need to tackle, is surely still on the technology side. There is more to be done on security, interoperability, privacy. There is more to be done on the trust side. I think the crypto space had a hard time. So even if the network as such is decentralized, you need to trust the application that runs on top of it. And so trust is an element, but also a compelling consumer proposition. So why should you be using crypto instead of your payment card today and your fiat currency today, right? What is the added value that it brings to you? It may be privacy, it may be the control, there may be different factors, but it needs to be a compelling consumer proposition. And then also the merchants, they need to be ready to operate and handle these new types of forms of money. And so there are still many things that we can innovate and work on to solve the adoption problem.
Hopefully, we basically help slightly different, that we do not touch, a bit like Skype did back in 2001. I was basically a user of Skype, and I was living in Europe, actually the US at that time. Then I had a Palm phone with a Skype app, and Skype in and Skype out. So basically, when my parents were calling me in Brazil in a landline, I was basically getting that phone call in my mobile phone. And a decade later, every call is actually with voice over IP. So nobody actually had to learn anything different because the backend was changed. I think the main thing is, by having the card the way we have, by having settlement and stables as you have, we hopefully can start offering this backend to those that are offering the financial services as they are offering. And then we go from terrible COBOL mainframe into different ways of organizing blockchains and nodes, and then from there, then you can have new providers, and then hopefully then people get more sophisticated in their finance, but I find that a little bit more difficult.
Maybe I can return the question, because I think I've seen most of your presentation before, but I'm curious on, I think besides the geographical expansion and what can be done, where do you see the biggest point to unlock actually this efficiency to reduce the complexity for your customers today?
Yeah, so I'm actually in a difficult journey because I'm looking to customers. One is the very sophisticated, very willing Web3, which is part of our community. And the other one I see as my dad every time. So my dad every time he talks to me, he says that you have something in payment, but I have no idea. I never use. And it's every time I try to use, it's very complex. I don't understand crypto and so on. My main barrier, believe it or not, is none of those guys. In fact, is to prove that everything that exists in crypto and everything that exists in payments or banking has been already set, regulated, and now we're trying to create new names for existing things. I feel like the world is living Silicon Valley, where you don't have commercial officer, sales officer is a chief revenue officer. They got renaming things that everybody should know. It's, I sell to those that want to buy. So regulators have created e-money. Regulators enabled Monerium with digital money. Regulators allow banks to display digital balances in phones for users. And the only question is, those that want to have custody and those that do not want to have custody, how do I treat them? You have already, one is called a money license or banking license that allows you to do those things, and the other one you don't need anything. It's more like technology provider. Can you ensure that the people that you're bringing to the party are allowed to be in the party? And I think that's my main job right now. Help the party to start, help the clean money to come in, given like no criminal activities, no sanctioned users. If I can block them to come in, everything else is already there. So I think that journey of, taking this myth away from you need to be a bank in order to do banking, that is my biggest and most difficult path right now, and hopefully we can open it. Yeah. So maybe 2 more questions, because I would love to get some questions from the audience. It's a fire chat, so we need some fire. So the stablecoins, of course, is living this moment. For good or for bad, it's still very USD based. And of course, Visa, if I recall correctly, 25 types of currencies that you can settle on, maybe 25, maybe 23, I heard so many, maybe 19. But effectively, one of the important things is the schemes. They basically help us or financial institutions to transact in multiple countries, not having to settle in that given currency because you do that. And in fact, a lot of people think that's very expensive, but normally is very reasonable compared even to large chunks of money change. But USD still 99.99. Is there anything that you guys can do? Is there anything that you feel like it's happening out there that could help? Because I think this is one important element. You're in Europe, you want to spend euros. You are in Switzerland, you want to spend Swiss franc. You're in Brazil, you want to spend reais. So how do you see that?
Yeah, first I think stablecoin has been a really great thing for crypto. If you look at the growth trajectory, the users, I think we have 19 million users of stablecoins today. I think it has been a great push for the use or making the technology usable. Now it's true the majority of highly used stablecoins are USD denominated. The question arises, what are you using those stablecoins for, right? So again, different use cases. In some of these countries where you want to hedge against inflation, you may want to have the dollar, a digital version of the dollar. You may want to use it for cross-border payments. Actually, a large chunk of stablecoin payments come from B2B payments, cross-border. And then I think a last element is the settlement element, which is an infrastructural one, right? And so for different use cases, you may need different underlying fiat currencies. And so it's yet to be seen which use cases emerges for which one. For Europe particularly, I mean, this is the region where I work in and where I try to drive the business. I see a lot of potential with the incoming regulation with MiCA. We are already seeing almost every month a new big company announcing a new stablecoin, a euro-pegged stablecoin. We also don't know what's going to happen to dollar-denominated stablecoin in the euro area. So I think the regulation is can potentially change a lot of the dynamics. But it is true that in international payments, cross-border payments, the dollar has been a dominating one. And is probably likely going to continue to be one. But we are seeing new stablecoins emerging, and there is technically no reason why we shouldn't also allow these new underlying currencies on our network if they meet our standards for stablecoins, right? Which has also not always been the case without regulation. There have been many stablecoins out there where we didn't believe they meet the standards of security and reserves, et cetera, et cetera.
On an opinion base, is stablecoin the next banking deposits?
I think it's a question of how you define a stablecoin. If a bank issues a bank stablecoin, a bank deposit, it's technically also a stablecoin. So I think the whole topic of tokenized deposit has been a big a big topic in the banking world in the past 6 months, and I think that combined with the idea of tokenization more widely is definitely an area where we see a lot of opportunity for the more traditional players to come in.
Maybe a final question on my side. Do you see Visa's role in stable, maybe on the settlement, pre-settlement, if we can call that, or during clearing and settlement? Do you see a role that Visa could help with a Visa stable, or is that far away? No, something we have not thought about it.
It's a question I've been receiving from the very first day.
Okay.
But I'd like to say we're not in the currency business, right? As I mentioned before, we transact with 160 currencies and settle in various currencies. So that would probably be my answer for now.
Okay. Fair enough. Fair enough. I mean, the network interoperability first, security, trust. I mean, it's fair. But I would always, of course, see this as something that can help a lot. The middleman, right? The middle layer, which is very costly as well.
And I think we'd be very interested in seeing where the demand comes from. What is it that businesses and consumer want to use? Which types of stablecoins? Again, how many stablecoins need to coexist? There is an aspect of currencies that gains on as many networks they run on as many usage they have. So I think that's yet to be seen how different stablecoins will act besides each other.
Okay, good. Questions to the audience, or please, lots of questions to Micah. Please.
Is there anything regulators can do to help these various initiatives work on?
Sorry, could you repeat?
Is there anything that regulators could do to facilitate some of these things that you're proposing?
So I think generally regulation is good in that space. So the more clearance there is, the easier it is to operate for our partners in that space as well. So I mean, it's not just Visa, but it's also the partners who need to feel comfortable. So I think banks, as an example, now with MiCA, they are becoming more and more interested in offering digital currency offerings or products. So I think we're actually in a good place in Europe compared to, let's say, the US, for example. So I think that's a general aspect which helps to engage and to talk about and then there's this understanding element, because I think very much of regulation is done in a way that is following existing principles and existing thinking, and some of that doesn't work as well anymore for the new for the new crypto ecosystem. So how do you regulate a blockchain network? These are some of the questions that regulators are facing, and so I think it just needs, we continue to work with and exchange with regulators, and I think that's also what's needed and continue to be done with all partners and stakeholders involved.
Yeah, I mean, Europe is very famous for regulating before even thinking, and then the US is normally taking the time to regulate when things are already collapsing. So I don't know. Whatever best time is, I can't comment, but it's definitely happening that way.
There will surely be a MiCA 2.0 at some point. So
hopefully. Okay, more question in the back.
Hey, thanks both for a great panel. Something you said, Mike, really resonated with me, which is not only we should work on abstracting away the complexity from users of crypto, and I feel like probably 90% of the people in this room are working on that, but the second key component is about creating compelling narratives and reasons for people to adopt crypto. Can you elaborate that a little bit more and maybe talk about the drivers? Is this just cost, or what are the possible components that can make us successful there?
I don't think it's necessary for end consumer. I don't think it's necessarily cost, because if you pay today, it's for free. I mean, there may be fees associated to your bank account or things like that, but you're paying and you don't pay anything for that. And so I think it's really convenience and safety, which are the core elements. So a reliable system that, you know, when something goes wrong, then you will get your money back, or there are mechanisms in place that help you to reverse a transaction or to do something that's based. I think that's, at least from the experience that we have, convenience and security is always like two important factors. I think an additional one that comes into play with crypto is probably the aspect of privacy and control, which is something that has been driving crypto users, which is something maybe that couldn't be delivered in today's world at that standard or that promise that crypto tends to convey and hold. So there may be different elements and different users may have different preferences, but it's really, I think, about, you know, finding out where is your consumer and meeting your consumer where it's at. I mean, crypto doesn't equal crypto. It's also different. I think where you meet your customers is you match a non-custodial wallet with a card, so you match the convenience with the control that you have, and that's brilliant. So I think it's these type of value propositions that you need to figure out in order to meet the consumer where they're at.
Thank you. One more question, final one, please.
Hi. So it's a question for actually both of you guys, because I know that you're focused in Europe, and even in your Gnosis Pay card, there was no US colored on the map. So I'm curious to see if you both feel sort of optimistic in terms of making a payment use case with stable coins essentially happen in US maybe this year or early next year or something of that sort.
Should I take first?
You can go first.
Then I'm happy to tell you that already works in the US. No, so I was in New York last week, and if Denver, of course, we spend with the card, and you are able to spend, perhaps issuing to US customers and making them able to spend with stables. So look, maybe not to overshare, but we have validated a thesis that is possible. And with license holders in the US that are willing to do this with us in a similar setting as Europe. There's one element that it's not truly self-custodial, because the funds would have to be settled to Gnosis Pay, and then Gnosis Pay then settles to the payment schemes. So that door was not necessarily the ideal one. And there's multiple reasons why they wanted to do that. And therefore, we have decided not to move forward yet with the US setting. We are exploring different ways to issue in the US. It is possible. Technically, nothing is preventing us. We have all the integrations necessary to do so, probably with some limitations around ATM withdrawals and things like that. But to transact, US customer having balances and spending in the US, yes. Do we get clearance from regulators in the US to do it this year? Bluntly, if I would start now, probably yes. Do we want to do that in the US this year? That's something else. And I think that's a question that I don't think it involves much on the technical integrations and the complexities with regulators. It has more to do with scalability, cost of growing the business in the US, which is a world itself. But
I think it depends on the regulatory environment, and no one knows how fast and in which direction it's going to move. I think the latest weeks have been positive, so excited to see how we'll leave this year. But ultimately, we're driven and always very closely monitoring these regulatory developments, which drive our decisions of what we do in particular markets.
Yeah. Well, but good point, good question. I would like to thank you, Micah, for coming. You're pregnant, taking all the energy to 75% ready, baby, with you. We really appreciate actually all the help that you guys have been giving us, especially you. for not only launching the card, but accelerating with a bunch of things internally. So happy to have you.
We're very excited to see where the partnership gets us and how we can grow it further. So it's a great partnership. Thank you for that.
Thank you. Thank you, guys.
Great job, guys. That was great. Thanks, Micah and Marcos. We're ready for our next talk, which is also very much in the same lines of payments and banking. We have someone with deep experience in building a neobank, along with his team coming to build an on-chain bank, learning from all their past experiences. So without further ado, I'm going to call Hannes, who is building Zeal. Please put in a round of applause for him. Thank you.
Hey, testing. Hey, testing, testing. Testing. Oh, I have glass here. Hello. Okay. Peace on everyone. My name is Hannes, or Gradient on the crypto Twitterverse, and I'm one of the builders at Zeal. Zeal is a team of former Revoluters who started building this neo wallet, as we call it, a couple of years back. And I'm going to talk a bit about what we can learn from neobanks, a problem we were thinking about when we were working at Revolut, and then we've been thinking about how we can apply some of those learnings in the wallet space. This presentation is also known as the Yay, we're launching Zeal today presentation, because that's what we're doing. So first off, what is a bank? Technically, it's a licensed financial institution that accepts deposit from the public and creates a demand deposit while simultaneously making loans. This is what a bank is. But what people want from a bank is for the deposits to be safe. This is the #1 thing for a bank, making sure that money is safe. And people want to be able to use their money together with a bank. More money is moving into banks from cash, because right now, regulators are waging a war against cash. But when we ask the central bank, the ECB, they say that cash is something that ensures our freedom and autonomy. That banknotes and coins are the only form of money that people can keep without involving a third party. This is not me making up. This is a link here. You can check the cash strategy of ECB. And it's also that cash ensures our privacy. They respect our fundamental right to have our privacy, data, and identity protected in financial matters. So how can we ensure that our freedom and autonomy survives this war on cash? We need to build wallets that deliver what people want from banks with what they need from cash. And we'll be talking about some of these design principles that are leading of how we have been implementing Zeal, but also how we think can help others build wallets. These are kind of bigger objectives that we have. By no means are all of these already there, but it's a good goalpost to have to deliver solutions that matter and help people. So first off, we need to build wallets that aim to become safer even than banks, and that are easier than cash, at the very least easier than physical cash, and that can do everything in money, so not just constrained to a very narrow set of use cases. And we believe if we can accomplish these things, then we have built great solutions that allow people to engage in the financial lives with the safety and security that banks give them, but in a self-custodial way. It should be noted here, when we talk about self-custodial banks are licensed entities, so this is more of a design exercise than a marketing exercise. First off, one thing that's important, and we've been making great strides on this one as an industry, is onboarding. You know, the epic example of seed phrases and where you put them or hide them or you lock them up in a bank. We finally have solutions to killing seed phrases. We now have smart wallets with Safe as the industry-leading contract for that, or contract suite, together with new innovations like passkeys and with that biometrics that allows us to secure things in a simple yet safe way. And finally, these things are coming together in a way that we can deliver great experiences to people. Speed of transactions, we can't wait 15 minutes at point of sale for a transaction to clear before we get our coffee, right? But now we have not just L2s, but L3s. We have layers on layers that help us solve the speed problem. And connected to that, also transaction fees. You can't pay for coffee if a transaction costs more than the coffee itself. But with layers and blobs and beyond, we have now also solved the cost of the transaction cost problem, where basically on several places, the transaction fees becomes a rounding error, and we can also handle smaller and smaller transactions. And then gas, not just in the concept of fees, but gas as something that people have to think about when they make a transaction. A classic one is I load up my wallet with, say, USDC, and then I can't make a transaction because I don't have XDAI or Matic or Ether, what it might be. But now we can make transactions with almost any token thanks to account abstraction. And lastly, and this is not so much a technical development, although there is some aspect to it when it comes to compliance and making things work better, which is ramping, both on and off ramping. For a long time, moving money into crypto, or on-ramp, or on-chain, has cost 4% up to 5%, which can work if the objective is to make 10x on a meme coin. But if you're just a person getting your salary and paying your rent, buying a beer or coffee, then all of a sudden 4% is roughly the interest you get on a current account or a savings account even. So if we want to make onboarding work really, really smoothly, we have to make the cost also converge with zero. If we look at neobanks, most of them have removed onboarding costs, and they subsidize them from different parts of the business unit. If you look at both Revolut and N26 in these banks, you can basically move money into your account with the various channels and not have to worry about a very large fee on it. And we need to get that too. I think the solution in this aspect for the industry, and it's happening as we speak, is larger demand, i.e. larger volumes moving on and off chain. And with that, because there's more demand, comes competition. And with competition, that drives down the costs. And that's happening right now, where we see a number of different players coming out with more and more aggressive pricing to make it basically converge with zero. So we think these are some of the key aspects of onboarding that for quite some time hasn't been there, but we're now getting to a place where they are there. And we can build solutions that do things. But we have to do things that are going beyond trading. And this is another aspect that we think is important. Cases, then we only get trading and traders. And if we want to make crypto evergreen, we want to make crypto something that is around the year or around the decade, we have to make it less cyclical and step out of just the bull and the bear market swings that we have had the last 10 years. And really the OG use case for crypto 15 years ago, peer-to-peer digital cash, is something that we still haven't really delivered on. We are starting to deliver on it now. But it's still hard to just send a payment link with some digital dollars to someone who's not in crypto yet. Even people who are in crypto still do traditional Web2 peer-to-peer payments because it's not that easy to just make a self-custodial peer-to-peer payment, even though this was the original promise, right, the Bitcoin white paper. So peer-to-peer payments is one of them. And the other one, and we just had Gnosis Pay and Visa on stage, which is we think one of the key drivers in this, is daily payments. Making crypto useful day to day. And almost all of us buy something every day. Not all of us set up an LP position in Uniswap every day, but most of us buy something every day. And daily payments is something that allows us to build a closer relationship with customers and then can onboard them and bring them out to other use cases within crypto. So we think these are two of the more important things to enable in order to make crypto useful outside of the trading cycles. But by no means, of course, an extensive list of use cases, because there's a lot of innovation in the space. Which brings to the next point of having differentiated experiences. So we got this onboarding stuff done, right? We have smooth onboarding. People don't have to worry about seed phrases, and they can sort out all the basics. But that's just the table stakes. Then what? Then we have to do something that people want to do. Now they can do it, but why do they want to do it? And this comes down to differentiated experiences. At Revolut, we did FX at cost for expats, which was a great nuanced and differentiated go-to-market. And we need to think similar when we're building experiences in this space and grow the pie, not just by differentiating versus other wallets in our ecosystem, but versus real-life use cases. Some people care about self-custody. Some people care about higher yield, lower transaction fees in certain transactions. We need to innovate on these different areas, and this is something I talked to many wallet builders that many or most of us are obsessing about. And we need to make sure that obsession also extends outside of crypto into the broader real-world use cases. A UX one, less is more. We love throwing all the details at people in interfaces, but sometimes less is more. I won't say more on that. Making the old world and the new world work side by side. I think a great parallel here is how voice over IP has slowly integrated to work side by side with telephony. Right now, if someone calls me on my landline, I'm almost a bit afraid why they're calling me on this old number when everyone who knows me calls me on one of the many messenger apps, right? And I think we need to see something similar happening also in our space where it's not like ENS and 0x addresses over there and then real-world finance over here. These two worlds need to live side by side. And we have an amazing, ubiquitous money address layer, money address protocol globally, right, with card details, with card numbers. So we need to let our hex addresses and our IBANs and our card details live side by side in experiences that embrace both of the worlds and make them work together. So these are some of the kind of broader dimensions we're thinking about. And I want to actually show how this comes alive inside Zeal. Our mission at Zeal is to empower people to transact freely without intermediaries. We're a team of 11. 7 of us came from Revolut. It's been about 2 years in the making. We're a UK company. Gnosis just joined us as an investor and a partner a couple of weeks back. So Gnosis joins our other investors, Variant, Framework, Galaxy, and many others. And we're super excited after almost 2 years of building this, and recently also testing since last DappCon last year, to now take our product live on multiple platforms with multiple products. So today we're launching both the Zeal browser extension, the Zeal Android app, and the Zeal iOS app, which currently is available on test flight, but anyone can get access to it, similar to how Uniswap launched their wallet. And Visa cards, importable or orderable through Zeal together with Gnosis Pay. We think these are key building blocks to help us bridge between your on-chain financial world and your real-world finances. So, see if this works as well. So, what we have here, well, first off, we have our homepage on the left-hand side, which we just launched this morning, zeal.app. I'm going to show a couple of different use cases now so you can see how Zeal comes alive. First off, just a good old portfolio. You can add any wallet as a tracked wallet. So I'm going to add in Dejan Spartan here because he has a large portfolio of many things. There we go. So we can see obviously all the tokens across many different networks. It's a long network list here. We support all EVMs, but some networks have smart wallets. Not all EVMs have smart wallets yet. DeFi positions, where you can see pending rewards, health ratios, and lending protocols. And if you have some NFTs, you can see them at the bottom as well as a gallery. So a very broad portfolio mode where you can see how your assets are developing over time. Both when they're in your wallet as well as when they deposit in different protocols. Now, I'm going to demo our smart wallet, which is an exciting one. All right, so smart wallet, you can pay for network fees with stablecoins and tokens. It's powered by Safe, and we support, off the get-go, 9 different networks with the same address space. So we're going to create a wallet here on stage. Now, this is a biometric safe wallet based on passkeys, right? So first I'm going to create a passkey with my face. Now we're generating a safe, counterfactually. And now we're deploying a reference safe on Gnosis chain. What's happening in the background here, in this two-step click process, is you created a safe on Gnosis chain with a validator contract connected to your passkey and a secondary locally stored private key that can be used for ongoing transactions to reduce the gas overhead when making transactions. A little bit of technical detail, but it makes things smoother and also allows us to recover this address in the future with the same address space on multiple chains. So now we have a wallet here called OnStage. It's a freshly created wallet, as you saw. I'm going to send over some tokens to it. Let's send over some XDAI to OnStage. Send over 2 XDAI to OnStage. Now we're doing safety checks. So you can see first token balance simulation. You see exactly how tokens will decrease or increase in your wallet. In this case, it decreases because I'm sending out the tokens, right? You also see safety checks down here. Safety checks, for us, are many different things. One of them is we're on a tenderly simulation, and you can open up the trace and see exactly what happens in the transaction if you're technical and want to see that. We also check if the tokens that are being transmitted or received are verified tokens on CoinGecko and a couple of other sources of truth. And we're also performing safety checks with Blockade to see if there's any issue with the contract that you're interacting with or the token that you're interacting with. So Blockade safety checks, tenderly simulations, and a number of proprietary internal safety checks. So let's send this over here. Add queue, and you can see here transaction status at the bottom. And yeah, there we go, transaction complete, sent. I'll also send some, just to show that it's a smart contract or multi-chain wallet. I'll send some USDC as well to OnStage. Oh, this is the KVM, okay. Let's do, there we go. Same thing again, we get safety checks, sending to network, add it to queue, where is it on this journey to the first confirmation on chain. Okay, include in the block. So now we can open up the other wallet, the OnStage wallet, which now has received some tokens here. You see, you saw this is a new wallet, right, that I just created. So there's no Matic anything in this one. But I can now swap this Matic or this USDC to some token, to some Matic, for example. We have built-in swap and bridging screensaver. How many minutes should I roll back? So we now show a swap from USDC into Matic on chain, approval transaction. Now, this is the first transaction I'm making here, so now I have to use my Face ID for the first transaction. It's the passkey signature that's happening now. Now I see relaying, queuing. This is account abstraction with Biconomy, with a safe, but with Biconomy for the accounting as abstraction. And so you can see the step along the whole relay journey on the different stages. All right, now I've shown you our transactions. Now, let's do a off-ramping transaction. We also have built-in bank transfers. So we can move money from on-chain USDC onto your bank account within Europe and the UK using faster payment cycle instant SEPA. And we can do it with USDC at the interbank rate without extra fees. So let's do that and see how quick that goes. So I'm now going to off-ramp, withdraw, say 5 USDC into GBP. Continue. All right, now we have started an off-ramping. And that might take a minute or two, so I'm going to let that cruise around in the background while I show some other cool stuff. What I wanted to show next is the guys who are on stage just now. Some of you might already have a Gnosis Pay card. Now you can have your Gnosis Pay card on the go in your phone as well. So you see down here in the middle, there's a little card tab. I'm going to switch over to that. And boom, here's my Gnosis Pay card. Here's my Gnosis Pay card with my transaction history. I'm not going to reveal my card details, because then you're going to empty all my 4.7 pounds on the card. But if I click card details, then you can see your information so that you can get your card details on the go without having your card on you. And you can add cash, which links out to a cross-chain transfer so that you can top up your card with URI, or GBP in this case. So now you can have on the go your Gnosis Pay card and see the transaction history and your details. You can use it just like an ordinary new bank cards, side by side with your DeFi portfolio. And by the way, you can load them up in read-only mode to begin with, right? Like I did with the Spartan. So you can load up your Gnosis Pay card and your portfolios, and you can check your tokens and DeFi positions, while you can also manage your Gnosis Pay card, all in one app on the go. Now, I should mention, because we use passkeys, we're also cross-platform, right? I mentioned we're launching Android, iOS, and desktop, right? So here on the computer, I can now recover the same passkey wallet that I just created on mobile, because it's cross-device. On stage, biometrics, and here we go. Recovering this on desktop. Boom. And that's roughly how it works if you're getting in a new device. You just recover it. Takes very little time. No fiddling around, calling your grandparents for seed phrases. Just click, recover, and off you go on a new device. OK. That's it. Available today at zeal.app. The permission-free digital wallet for your everyday life. Questions? Yes?
Are there any restrictions on who can use this?
Are there any restrictions on who can use this? So we are a software developer, but we interact with a number of different financial institutions that have licenses in different jurisdictions. So that means if you want to use bank transfers, you're creating an account with one of our partners, and they have licenses right now in Europe and the UK. And so you can do bank transfers in Europe and the UK. Gnosis Pay country availability is the same as Gnosis Pay, obviously. It's a card with them, right? So Europe and the UK. So primarily right now, it's Europe and the UK, and we are expanding to other territories very soon. But passkeys and self-custodial wallets and all that, that's without jurisdictions, right? And it's available in all app stores, not North Korea and Venezuela.
Any other questions? Yes.
Do you provide any other options for wallet recovery as well?
For specific smart wallets, we have a GDAI recovery, but we are sunsetting that for passkey recovery. So right now we are focusing on passkeys for recovery. We do not custody anything. We do not do any recovery. We haven't integrated with the broader safe recovery suite either. We're focused on the passkey recovery, which is done, I should also mention, in a self-custodial way, in that we don't work with another service provider that stores the mapping for the passkeys to your keys. This is done with an on-chain validated contract. So your dependence in this case is Google and Apple or whoever stores your passkeys, but they're stored also in a way that they don't have access to those passkeys.
Any other questions?
All right. Try Zeal. We're very excited to see what you all make use of it, and bridging the world between on-chain and real-world finance.
And I can vouch for them. They built something really cool.
Thanks, Steve. And yeah, the withdrawal sometimes takes a couple more minutes. It's been now probably 5 minutes. So try it out and see if you can get it to done faster.
Awesome. Thank you so much, Anis. Can you have a round of applause, please? Before we move on to the next one, we'll just set up the stage for a couple minutes and be back. Thank you. Hello. We're back with an exciting new panel, very much on the same lines that we've started today, where Marcus, who's here, introduced the future of banking and the concept of an on-chain current account. On this panel, we have leaders from MasterCard, Safe, M0 Labs, and Transfero, as well as our very own leader at Gnosis Pay, Hafa, who will be speaking about how each one of these parties is kind of contributing to building the on-chain current account and their angles to it and their thoughts around it. So without further ado, let's please welcome the panel. Can we have a round of applause, please? Thank you.
Well, guten Morgen. I realized that the only thing standing between you and lunch, so we're going to try to make it worthwhile. So before we jump right into it, just a quick round of intros. I'm Rafa. I'm with Gnosis Pay. We're going to be piggybacking on what Marcos introduced today, like the concept of like banking 3.0 and the separation between bankers and banking. So I'd like my colleagues here on stage to quickly introduce themselves as well, so get to know them. Let's start with Julian.
Yeah, thanks. My name is Julian. I'm head of institutions and fintech at Safe. Safe is your account for everything in the future, be it banking, payment, crypto, whatsoever. So my past is I worked 4 years as a lobbyist in the realm of payments and also crypto. After that, 3 years as a managing director in a bank heading the digital asset business. So I know a thing or two about regulated finance. And what I can tell you, I learned some dark lessons, and working here at Safe is kind of solving that basically for humanity, because if you really control your bank account and you can take that wherever you want, and instead of kind of us, like in Web3, we getting integrated as an embedded wallet or something, instead we integrate the Insti-Rails, I think that's a way better future and gives really ownership to the customers.
Thanks for having me. I'm João Reginato. I'm one of the Joaos. It's the first panel ever that I've been with another João fighting outside of Brazil. It's proud to be with other fellow Brazilians. I lead strategy for M0 Labs. At M0 Labs, we build the infrastructure behind a project called M0, which should be launched soon. M0 is an infrastructure for a federation of digital dollar issuers. So imagine a situation where you have these stablecoin products that are centralized and have a single issuer. I'm talking about like externally collateralized stablecoins. We are building a solution whereby any institution can plug into this infrastructure, can plug into this protocol and become an issuer of a fungible, a single stablecoin, a single crypto dollar, as we prefer to call. Prior to working at M0, I spent 8 years at Circle, where I led the build out of USCC.
Awesome.
Hi. My name is Christian. I'm heading fintech enablement and crypto go-to-market for MasterCard in Europe. Before this, I was general manager in one of our European markets and heading core product management for MasterCard. My first job was in corporate banking, and then I moved into internet services and telco prior to joining MasterCard.
Awesome.
My name is João as well. I'm actually one of the co-founders in BRX. We are partners with Transfero, and we develop capital markets Web 3.0. So we orchestrate all of the capital markets infrastructure within Transfero through smart contracts to create a seamless experience for institutions and for users that are using our infrastructure. We usually abstract the Web3 kind of complexities that users deal with, and orchestrate everything through smart contracts and account abstraction. And our objective is to make products that are creative, that are not copycats of traditional products, but on-chain. So our idea is to develop always like products that have a take on the benefits that Web3 offers us, and not just replicating products.
Awesome. So let's get right into it. I think like Marcos introduced the concept of banking 1.0, where like bankers had control over technology and used technology to kind of like improve profits by being more efficient. Then we moved to banking 2.0, where like technologists took over banks and created like awesome user experiences and used banks as infrastructure. And now we're getting to the ownership era, right, where users have control back and ownership back over their assets. So first question maybe to you, Julian, like, what mistakes from the past we can learn from those different stages of evolution? So for instance, like open banking was always a desire, but never a reality. So how we can make sure that we don't repeat the same mistakes and enable sort of like a true open banking and ownership experience to consumers?
The easy answer on a little bit of an abstract layer is by building on the right tech stack that has the core values that we need for this more truly open system, which is obviously crypto. But to be a little bit more precise, it's actually funny to see Maike on stage and also Christian, you. Like 5 years ago, we were kind of meeting with Marvin because we were all in jobs in fintech on the rather lobby side, Maike and myself, and you on the business side. But we were discussing this concept of open banking quite a lot. So what does that actually mean, right? So back then, so I give you a little bit of a pitch that I had on my slides like 5 years ago in front of regulators and stuff. And the pitch was basically, so we are getting into kind of modular services basically everywhere, right? We looking, watching movies on Netflix. They are hosted by Amazon on a computer built by Apple and stuff like that. So there's a nice network of different services plug into each other, modularized, you can say. But in banking, it didn't work that way. So we had those silos. Imagine you have a landscape, and there are kind of big rocks, and there are no kind of bridges between them, and you cannot put a brick out here and put it there. It's absolutely the opposite of modularized. It's kind of a, how we call that in crypto, canonical or a siloed approach. So the regulator understood this is not good for competition. This is not good for driving prices down. This is not good for innovation. This is not good for stability and a heterogeneous system. So they tried to bring out these kind of PSD2 regulation, Payment Services Directive, with APIs, and the banks can then plug into another and kind of build good services. As you just said, that didn't work out well because they don't have no interest in sharing those data, as Marcus also said. Like, if I give away my KYC data to another bank, they kind of have the customer. You don't have an incentive in that. And also, there are some regulations that make it very difficult. So, for example, imagine the example of Netflix and Amazon. If both were regulated, this outsourcing that Netflix does to Amazon to host the movies is a highly complex thing. Outsourcing analysis is needed. Here in crypto, now jumping to the light side or the bright side of the story, it's so different. The smart contracts, like the ones from Safe, are sitting on the blockchain since 2017. You can just build stuff on that, and we don't have those old problems of those silos anymore, because the services in its core are modularized and open source. There's a lot of Lindy effect, and that's, by the way, the reason why so many people on stage here today are building exactly on Safe, because you have this Lindy effect. It's open source. You can plug into others. You see an ecosystem growing on that, so why don't you build on that too? So that's why I believe finally we're getting to this vision of open banking, be it now banking 3.0, the true open banking. But that's, I think, what's making me really excited, and a lot of people who come from fintech now working in crypto are really excited to see that.
No, awesome, awesome. And João, maybe like flipping over to you, open banking will require like interoperability amongst like all the different types of players. What is the role of money on this, and like how M0 is looking into that?
Yeah, and I remember this period of time 5 or 6 years ago, and I remember mentioning to people that the best open banking API that they had was on chain, right? That was the best API already. But going to your question, and I'll allow myself to nerd out. I think we're all money nerds here, as I call it. So just we have to go deeper and look at things from a technology point of view to be able to really disrupt things and not just come out, with another layer of another like kind of nice looking facade on top of existing infrastructure that doesn't really innovate at all at the end of the day. Lipstick on a pig, if you will. If you look at money from a technology point of view, it's actually extremely complex, right? There's no definition even for the technology of money, perhaps like we have on the internet with 7 layers and all that kind of stuff. But the way that I look at money, I look at it from a technology point of view into three layers, right? There's this foundational layer, the base layer, if you wanna call it, which really has to do with the belief systems that we have as societies, right? We choose to get together as nation states, as societies, and believe that there's value in gold, or there's value in government, or there's value in the tax system, or in armies, things like that. All of those things that effectively guarantee some base level of what underpins money. Again, whether you agree, like it or not, that's just something that we get together as citizens and believe together. On top of that, then, there is, again, if you want to call it layers, there's sort of a middleware layer where actually money gets produced and moved at scale. So these are things like governance systems, like who gets to do what, who's licensed to do what, and how. How is money actually issued? How money is actually settled and transported? And then only on the top you have this front-end layer, which I think in the last number of years we essentially call it fintech, right? These are front ends. These are actually applications that consumers use on a day-to-day basis. Fintech, I think we touched, and we're going to touch more. Fintech has had a lot of problems. It's certainly where most of the innovation in the money tech stack has happened in the last number of years. But it's also a little bit like lipstick on a pig, because you can put a nice front end, a nice facade on these services, but if it doesn't actually settle on a weekend, if it doesn't actually work after 5 p.m., like what are you actually doing, right? What are you actually innovating on? Base layer, it's not for me to innovate. I think, Bitcoin, Ethereum, these things potentially, in our field can innovate at the base layer, but fundamentally, I live in the US, I still use the dollar. I don't think that's going to change anytime soon. But this middleware, boy, there's a lot of opportunity for innovation here. And I think this is where really crypto can play a role. We organize, again, around these systems of governance, right, today, which are essentially executed by regulatory bodies around the world. But crypto can innovate a lot on that. And so those are one of the things that we are trying to do at M0. We're trying to connect this base layer of money, which, again, if you want to use the dollar as an example, the foundation of the dollar are US treasuries, right? That's what the dollar is actually, like the dollar balances that you have on a bank account. That's not actually the dollar. That's a claim from a commercial bank on US treasuries. We can move all that infrastructure and run a lot of that on chain, right? So we can run issuance. Money issuance is super easy. We understand that on chain. Governance, we understand how to do that on chain in a decentralized manner. So what we're trying to do is bring all that technology and that infrastructure to run money issuance and democratize the access to that on chain. And by doing that, we believe that a lot of what we know today as banking services and fintech services can connect directly to that and be a little bit more independent from this commercial banking system that we know today.
That's awesome, and I'll piggyback on something that you just mentioned, like having money as infrastructure, right? Customers need real sort of like life applications, so like money is going to be used to pay for something, as an example, right? So Christian, maybe over to you. How do you see MasterCard innovating and building up on top of what has been just mentioned by Julian and João?
I think I can relate to a lot of points that were iterated today, both by Marcus, I think, who also took up a theme that, dates back almost 25, 30 years to Bill Gates, who was saying, people need banking, but not bankers. So I think, it was a promise for the longest period of time, or a bold statement, however you choose to look at it. And I would also agree that fintech was lipstick on a pig is, of course, wording some fintech people would disagree with, but it was sort of a superficial, if you will, user experience optimization, which I think has immense value because it raised the bar for the industry as such, right? If you look at the fact that nowadays you can use your iPhone or Android phone to pay pretty much everywhere in the world, and you get a transaction notification before it says on the terminal, transaction approved, I think there's inherent value in this, and consumers absolutely benefited because it reduces cost, friction, and so on and so forth. But I fully agree that the core, and the core for me constitutes two elements, the underlying technology and the concept of money itself. The core, as of now, has not been really touched, but only in what we now call digital assets or crypto. The fundamental concept of money is really reassessed. And I think we see multiple inroads of challenging the concept of money. We will have CBDCs, central bank digital currencies, that might or might not be based on blockchain. We have stable coins, which I think are super interesting, especially in Europe with the upcoming regulation. We have tokenized bank deposits. So we're not only discussing form factor innovation, but really the underlying technology. And then without boring people too much, and Marcus alluded to it, I think Julian also, up until now, we still run in a real-time authorization and then clearing and settlement in batches. And in a world that is very much spoiled by real-time expectations on everything, and I have the world at my fingertips, is that the best that we can do as an industry? Quite likely not. And that's also one of the reasons why MasterCard engages in this. And we heard about stablecoin settlement. That is also something that we're engaging with. And again, I think it's about using the underlying technology in a very meaningful way to enable consumers to use their funds as they will in a very safe, simple, and convenient manner. And that's, at the end, what it's all about, because that's what we learned in MasterCard over the last 50 years. People don't want to pay. Nobody wants to pay, right? You want to shop, you want to watch a video, you want to split a bill after dinner. And you know, you can't convince people and say, oh, that was a real-time payment and this was a tokenized payment, or this was, people don't care. And I think, as to the theme that we are today, if we push that in the background, if we make it easy, frictionless, at the same time, very secure and transparent, that's the way to go.
Awesome, and I think like we're gonna go back to this sort of like seamless experience where people need banking, but banking touches everything. It's a friction. So, but I wanted to piggyback on something that you mentioned also on tokenization, and maybe like flip over to João, in terms of like on top of like uses for payment, like people need like savings, right? Need invest for the future and so on. João, can you talk a little bit about tokenization and how is this whole thing evolving in this banking 3.0 era?
Yeah, so I come from a very different market, I think, that is the Brazilian market, which I don't know if everyone is aware, but we're going through a process of mass tokenization. There is an expectancy of a CBDC for late next year. So once we have the currency tokenized, we need assets to be tokenized for the currency to interact with. So, and that brings about some questions and some challenges, which I think only in Brazil we'll be able to answer this in the long run. But just again, as a background, Brazil is a market that's extremely evolved in financial technology because of the level of fraud that we had in the past. So we have extremely evolved financial products, but it always lacked a high level of people being bankerized, right? Banked. We had around 40% unbanked before PIX. And PIX pushed this level to where you probably have more bank accounts today in Brazil than you have citizens. Just Nubank has half the population, right? So, so this takes me to the CBDC, right? So when we talk about investments on chain, in Brazil especially, this is tied a lot to the CBDC because we see the CBDC as the wave that's going to push these people on chain. Banks are already having this discussion currently. And then we start to deal with the important part of tokenization, right? Tokenizing an asset is extremely simple, and it's just a legal process currently and very well detailed in Brazil currently. But then the next question is like, how do these assets interact, right? How do you make them talk to each other? And how do you evolve them so that they can have kind of this 3.0 effect and not just mimic assets that are off-chain to be on-chain, right? So, we are working on these questions today without the CBDC yet, and we've come up with some interesting answers. But in my opinion, the products that thrive, they will be products that usually are going to piggyback on the traditional distribution rails. They will abstract the Web3 kind of interaction, and I think us as developers of the technology, it's our responsibility to make the interface as simple as possible so that we have this growth, which, if you look at the fintech revolution that you guys mentioned, it's just based on UI and UX, right? And in crypto, we need that. We need the blockchain to have the UI and UX that fintechs proposed, and for financial products and investment is the same thing. So having native products with the benefits of the composability that we offer on chain is where I see the future, and where I think we are in the right market to explore this starting in Brazil, because this exploration is going to be kind of forced by the central bank into all citizens and to all banks. So instead of having this gatekeepers like banks, which usually prevent us from innovating and developing new things that are going to compete with the current products. We actually have the banks starting to get interested in how are their products going to be interacting on chain, and how are their products going to be when they are tokenized and how they're interacting with other products. So yeah, pretty exciting times in Brazil, and excited to see the future and see how we can explore expanding this beyond Brazil, right?
So I think that's lovely. So like, I think that's a great warm-up. So we've spoken about all the things that we pretty much like all agree on and have some sort of like converging views of the world. So I would love now to kind of like hear things that we don't necessarily converge on, right, and have different opinions. My personal belief is that fintechs have made sort of like a great dent in the history of humanity right now, kind of like creating like awesome experiences, banking more people, allowing more people to use digital currencies, having like checkings account, savings account, doing cross-border payments and so on and so forth. But it hasn't ultimately changed the business model, right? So if you take a look at the most successful fintechs out there, like you can talk about Nubank, Revolut, Wise, you name it, they all are going back to the old banking business model, right? You have this checking account, you make money out of fees, out of interest, you create closed systems, gated systems where like you protect your users from like everyone else. So you still have that concept of like owning the user and so on and so forth. So I'd love to hear sort of like different views on like how we can avoid the different pitfalls that have been made on this transition from banking to fintechs, so we don't fall into the same traps again, like when we're going towards this ownership era. So how we can make the system more open, more user-owned, leveraging the best experiences, leveraging the best, maybe like core evolution in terms of like backend. So I'd love to kind of like hear from you guys a little bit about that. And I'll engage the audience a little bit on to help us kind of like getting the heat up here. So maybe Julian, like, start with you on that.
Yeah, so why I'm very confident that we will not repeat the mistakes of the past is the very core is not a silo. The very core is not the one company, one fintech, be it Nubank, be it N26, be it Revolut, or any kind of this old incumbents, where you have your KYC data, and then only the ones who have your KYC data, how old are you, what's your name, what's your birth name, where you're born, yada yada. We all have done like too many KYCs in our lives. Only the one who has those data can offer you financial services. And here is the tricky point. So what is a financial service? Actually, what we define as a regulated financial service is usually the point where you give up control. So if you have your money with the bank, it should be regulated. It should. And since it's black box banking, other than open, permissionless, on-chain explorers where you can see where your funds are flowing, they are responsible for anti-money laundering. That cannot be outsourced, because only they know, oh, Julian is sending stuff from Deutsche to HSBC to Nubank or something. Only the banks know. The bank cannot look into the next hop. On-chain, you can't do that. So by having our industry built on a completely different core in the very inner circle of it, which is a permissionless blockchain and a smart contract that you can trace through, those needs are not there. So we are not stick to the one service where we did the KYC with. We can move on. And that's the point why I'm so confident that we'll not repeat those tasks. I mean, obviously, we can be abused or mistreated by regulators if they crack down on payment, P2P payments, so basically self-custody wallets. If that would come into effect, that would be kind of that would be a nuclear option. Then we would probably not have this panel again next year because everything is done. But I don't believe that's coming. I think we have very good reasons for that, and also kind of things like Mika show us a path that, yeah, there is compliance. For example, you guys at GnosisPay, you're doing KYC for the where you need it, right? Because wherever you give up control and settle one of the schemes, Visa, MasterCard, potentially Amex, then you have to still uphold those licenses, but not when I do on-chain transactions. So the future will be, you have the account, usually the Safe Smart account, and you implement those rails, and you can plug them out and integrate others. You stay with your account, and here you can in a modular way plug things on top of. And that's the reason why I don't think we'll repeat the mistakes of the past.
Awesome. But right now, like within a safe, let's call it like a safe account, right? Yeah. I can pretty much like own each different type of asset that I want. right? And it's a permissionless system. So like, let's say that I want like a token that's issued by, or like a stable currency issued by using João's infrastructure. How does this trust system like work, João? Like how can I make sure that a stable that sits on Safe is going to be accepted by Christian whenever like I'm processing like a payment, touching my MasterCard at the point of sale? How does that work in your view? Like,
yeah, that's so using your prompt to kind of disagree a bit. While I agree with Julian that I think we are in a better path and we have a better foundation, but I'm not so optimistic as Julian because I think we as an industry and we as a sector, we also like to like repeat mistakes that have been done in the past. And right now, let's zoom just in the stablecoin sector, right? If you want to read a bit about history, for example, of commercial banking in the US, you know, early 1800s, like that's where we are. We have like these private, isolated issuers issuing their own, claim on a private liability, and they're not interoperable, right? And there's no infrastructure to kind of allow true interoperability. I mean, we have swapping, we have trading, but you go through price discovery. That's not really interoperability. If I'm using Tether and there's a use case where I need to use USDC instead, I need to go myself as a user or developer of that functionality needs to plug into like some sort of clunky and non-standard interoperability function. So I think we are in the 1800s of stablecoin sector, just to use that sector as an example, and we have to move a lot forward to be able to really like fulfill some of the promises that I agree with Julian that we are on the path to. So I think, and this is not to criticize Christian and MasterCard and Visa, but I think if we don't fix that side of the sector ourselves, there's going to be a lot of interesting business for companies like MasterCard and Visa and others, because they will continue to be this network of networks, right? They will connect to all these stablecoins and say, don't worry, we deal with all of them, we'll trade with all of them, we'll connect to all these networks. And like, are we building anything new fundamentally if we end in that path? I don't think so. I think it will be more lipstick on a pig. So that's why we have this really uphill battle ahead of us, at least at M0, but we are going to fight the good fight, which is there shouldn't be many stable coins. There should be one stable coin, because we don't have many dollars. We have $1, we have €1. Granted, you have specific liabilities of specific banks when you have a bank account with a balance in that currency. That's not actually the currency, right? That's like a liability you're holding towards that bank that has a claim on the actual currency. But you are free to take your funds out and to move to another bank, and there's a lot of interoperability and infrastructure that has been built over years to allow that to happen. Today, if I'm holding USDC or if I'm holding Tether and something happens, I need to figure out myself, and a lot of people lose their shirt in that process. But also, I think the model is completely upside down, right? Because we have these companies that are stablecoin issuers, and what do? They issue a stablecoin, fine, but what actual value, what actual service they're providing to end users? Our perspective is that instead, if you look at the companies who are building use cases in this sector, they should be stablecoin issuers. Not because they want to be a stablecoin issuer, but because they have customers, they have customers' deposits, they have built that trust with their customer base. Why are they allowing somebody else to monetize their customer deposit float? That doesn't make sense to me.
But do you think, like, I disagree with that. I know it's your business model, that everyone can issue on the kind of a common infrastructure your own stablecoin, and that's kind of really floating and fungible. But like, when we look into this fintech revolution of the last 10 or 15 years, it wasn't kind of the Deutsche Bank and HSBC and well, Nubank's the wrong example, but like, it wasn't the big incumbents coming up with the most innovative front ends. It was rather Nubank, it was rather Revolut and 26 and Trade Republic and Robinhood for trading. So do you believe that the incumbents will now kind of leapfrog everyone else and pass away and Gnosis, Zeal and all those companies? I'd rather bet on the Gnosis Pays and Zeals to be the big new customer fronting retail banks of the future.
Oh, I completely agree with you. No, don't get me wrong. I don't think, we don't serve, without an infrastructure, we don't serve banks. We actually will compete with banks. We actually will democratize access to any fintech front end to become potentially their own crypto bank. We don't need the commercial banking layer. I'm sorry to say this if it is a surprise for anyone. We don't need a commercial banking layer as it is today with crypto. We don't need it. We can directly plug in, the underlying foundation of money, you know, treasuries, whatever you want to believe in, directly to the front end with like on-chain infrastructure. So this middleware is ripe to be disrupted right now.
So Christian, let's bring you in on that discussion because it's super interesting, right?
I think one point that I would sort of politely disagree with, that repeating the mistakes of the past. I think it's a journey, and when we speak about banking 1.0, as it was called today, I would actually argue there was a banking 0.0 when there was brick and mortar banks before online banking was even around. And I think it's sort of almost unfair to judge fintech, you know, and pull it out of the historical context, because these companies started between 2012 and 2014. And obviously the technology as we have it today wasn't there yet. And I would almost argue that the evolution for consumers to trust a company that hadn't been around like 50 years or 100 years ago and say, okay, this is a bank that only resides on my mobile phone, that was a big step. Maybe not in the underlying technology, but financial services and economy is a lot of psychology. So I would say it was a necessary part of the journey, and for sure not the end of the journey. That's one statement. The second statement, what is necessary to succeed or to evolve, I think regulation is. And in Europe, I think we are fortunate with MiCA coming up, because only if consumers have, let me call it the equivalent level of comfort to what we now have with deposit insurance, zero liability chargebacks, what we call crypto will scale beyond 2 to 5% of the market, because a lot of people, you know, they don't want to deal with all the complexities. They like the, you know, ownership and whatnot, but they don't want to be confronted with all the risks. So that's why I think regulation is key. And the third,
risk?
Sorry,
what risk?
Pardon me?
What risk?
Let's put it like this. If today something goes wrong with a payment transaction, right? And let's say I buy something, I'm residing in Portugal, and there's a Polish web shop. You know, no offense, just taking examples from the other end of the continent. If I wire transfer 200 euros to the Polish web shop today and the merchandise never arrives, you know, I as a consumer can choose, you know, do I want to open a court case? Do I file a claim in Warsaw or in Lisbon or whatever? If I do it with a card, I can call my bank and say I made a payment, the merchandise never arrived, I want to trigger a chargeback. So that's what I say, you know, in what we call Web 2 or traditional payments, there's rules, regulation, there's dispute resolution. And as much as we would like the world to be binary and be fit in smart contracts, maybe it's not. Maybe the Polish web shop sent me the merchandise, but it was wrong, it was broken. So they can say, yeah, but we send it, but I would still argue. So that's why I say there's nuances, there's details, there's shades of gray. And that gets me to the third point that I wanted to make. I wouldn't, you know, reinvent the wheel from scratch. Just as much as Marcus was saying, you know, he has a global platform, global vision, and he partners with companies such as Visa and MasterCard, who are global by definition. You still see the need to connect into local rails, right? And that's where I would say don't fix what's broken. If you consider, you know, international schemes, scalable, efficient, and consumer-friendly on and off ramps, and connections into the real world, why fix it? Apple didn't use iTunes as an acceptance system. I mean, Apple could have gone to any German bakery and say, you know, we have 1 billion iTunes accounts, so why don't you, you know, open up iTunes as an acceptance brand? They basically piggyback on card rails, and I think the way Gnosis is going about it absolutely makes sense too. So back to your question, I would say it wasn't there were mistakes, and there continue to be mistakes. Are they unavoidable? Are they part of the journey? Point one. Point two, I think regulation is key. Point three is leverage what's there. Take existing bits and pieces, optimize what you can optimize, and where people have pain points. That would be sort of my position.
Oh, no, awesome, Christian. And I feel like the only people who make mistakes are the people who are in the arena building stuff, right? Yeah. So it's not a criticism. It's about kind of like learning, right? Yeah. So and I think, and that's something that very much makes sense for me. And when fintech for me was questioning
the paradigm of rendering the service, but not the service itself, right? The playing field stayed the same, but they say we don't need mainframes and COBOL and branch networks. We do everything cloud first, real-time mobile. But it was still optimizing within the old paradigm. And now sort of you redraw the map and say, let's challenge the paradigm. And as per my initial statement, let's challenge what money is. Does money always need to come from the ECB when it sits in my wallet physically, or does it have to reside in my current account as in commercial money from Deutsche Bank, Commerzbank, Societe Generale? And I think obviously that opens the funnel for solutions, and I think it's super exciting to see where, if we reconvene in 5 years to say, what were the mistakes that were repeated, with good intent, and what were the real increments.
Yeah, but let me kind of bring John to the conversation now, because I think we touched on a very interesting point. I think all of you touched it lightly or not, regulation, right? And with tokenization now, you have assets that can be tokenized and become accessible for everyone anywhere on Earth for now, maybe even out of Earth in a few years. But how is the role of regulation and on this tokenization of assets? How do stop people from different places getting access to things that they're not supposed to, or how do you protect those people? Should you protect those people? What is the role of different players on all of that?
Yeah, I think that's a challenge that this global network kind of imposes on us. We are deep believers that a transparent and clear regulatory framework is always needed for this to be institutional and not be just a side project for people. So, but we understand that the regulation should be on distribution, right? On which types of investors or which type of customers you can acquire, and not on the innovation side and the types of product that you can create. So you can limit the types of people that can access this product, but not limit the innovation on the product side. That's at least our take on it. And this kind of resonates a little bit with the KYC challenge that I think Julian posted, and the fintech revolution and the effects of it, right? We talk a lot about the fintechs and they were all good and everything happened. We have the examples of the winners like Nubank, but how many losers did we have for one Nubank to be there, right? And at what cost were they there, right? Nubank was deeply backed in the initial stages. So the reality there in the fintech world, especially where I come from, is you have a very low switching cost to move from one platform to the other because there's no cost on the emission of the card for onboarding. The company is taking that cost in and increasing its customer acquisition cost, right? And once we move to a framework where the KYC is more on chain and the data is an availability layer that's a little bit different than we have currently, where it's siloed, as Julian put it, we start to not incur into that mistake that the fintechs had, which is coming across huge onboarding costs. And instead, they could actually monetize the onboarding throughout the platforms, right? Which is a model that we've seen in crypto for some types of KYC projects. So once that is solved, you can start having kind of a global reach KYC, because if people are sharing the information, of course, with the consent of the user, you start being able to have this KYC come across borders and being implemented in different jurisdictions or being added, if additional information is needed. And you start giving access to these people to more products because they are KYC'd and they are eligible for that investment. And we don't go back to that model where, in the fintechs, they want to silo their clients, isolate them because they had a cost to put that guy in there and they need to make money on top of him at some point. And most of them offer a lot of free products and don't actually make any money on top of them.
Great. So I think we have about a minute left. So I'd love to take one or two questions from the audience to kind of spice up things here to wrap it up. So questions?
Thank you. I think we're talking about non-custodial accounts, and I'm curious to hear if you have any thoughts on non-pegged stable coins that are built on top of Ethereum. We have a few examples these days, and it feels like today we are just talking about USDC and USDT, as the only options for stablecoins, but if there are any thoughts on RAI or any options that are actually non-pegged, low volatility collateral for Ether. Yeah, I would love to hear that.
Yeah, maybe I'll take a first stab at that, given that that's our sector. That's why, honestly, I don't personally like the term stablecoin, because I think it puts everything in a very broad basket, and these instruments, as I call them, they're very different one from the other. I mean, what is a stablecoin? Oh, it's an asset that has a peg to another reference. Fine, UST was very well pegged up until it wasn't anymore, right? So is it a stablecoin? I think people focus too much on price stability in that sector as a definition of an entire sector, which is I think not the correct thing to do. Our interest, and that's why I maybe mentioned too much, fiat collateralized or exogenous collateralized stablecoins, because our focus is really on how this type of technology can become middleware for money, can become infrastructure for fintech, so that they, instead of having a partner bank, as it used to be the case for many years, now they can potentially have their crypto infrastructure and operate like that instead. But I think there is space for experimentation with all these instruments, right? Athena, like all these things that are being built. I don't think they are stablecoins. I think they're something else. I think if you dig into traditional financial services, like there's a name for those things, and they're not stablecoins, or they're not, they shouldn't be treated because they have fundamentally different risks. I think there's a space, and I think decentralization is really important. We are trying one approach to decentralization, but the collateral is exogenous, so you will always have things that are hard to manage on chain. But I don't like the term, because I think those instruments are very different. They have very different risks.
Yeah, I think so. There's nuance, right? We have the guys from Monerium here, and that's actually real money by definition, right? Monerium has an EMI, E-Money Institute license, and what they issue, no matter where it is, and it's on a blockchain, it is money. And that's definitely different for Athena. By the way, Athena is not claiming that it's a stablecoin. I think it's a kind of a derivative on US Treasury yield or something like that. And there's nuance. So I like Safe's perspective on that. You can throw in whatever you want. You can have a Trump NFT, and you can have, I don't know, some kind of meme coin or Ether in your wallet. We don't care. I think who should care is definitely the front ends, who are in parts regulated or are integrating regulated services. And that's why Gnosis Pay chose Monerium and not Athena, because it makes sense, because at someday you will roll out your product to non-crypto savvy people who know about things in the past, like Terra Luna and stuff like that. So definitely you have some responsibility to pick the right stablecoin, but we don't.
I agree, and the last thing I would add to that is that, because I didn't mention, I think people focus too much on price stability, and if you are a fintech front end, you should care more about solvency, I think, because ultimately, if you're really building for your consumers and you want to care for them in the long run, you should care about solvency of one of these instruments, not necessarily price stability.
Yeah. That was a great question, because we can keep talking about this for like another 30 minutes. It's like, I think there are like different perspectives on it. Thank you very much for the question. So it was the first very good one. So anyone else want to keep up with that question? Like back there.
Hello. So, João, Reginato, you said something about how decentralization is important, and you're pursuing some decentralization in your project. And João from Transfero also talked about the Drex project in Brazil. At some point in my career last year, I was deeply researching different initiatives like stablecoin consortiums, the Drex itself, with MasterCard. I spoke with Raj Damodaran who was the vice president and still is, I think, for blockchain. So I would like to understand, so touching on decentralization, are we talking about just using Ethereum as a credibly neutral settlement layer, or does it extend to the infrastructure, let's say the hardware? In terms of the Drex, I also heard that there's a focus on privacy. So are these initiatives looking to build on distributed systems, or will the infrastructure itself be more centralized and just get some small benefits from the Ethereum blockchain, like the credible neutrality, etc.? Or is there a real intention in having distributed systems for the infrastructure and for the users to connect to each other and do their payments, etc.?
So I can answer about the DREX. They're having issues now with privacy, as you mentioned. It's not actually a focus on privacy, it's that they figured out that the transactions are going to be transparent and each bank is going to be able to see their competitors, but they're getting it solved. The DREX is going to be issued initially in a Hyperledger Bezos, and the validators are actually going to be the financial institutions. So I don't think they're going a lot for decentralization, right? It's a central bank issued currency, so I think they are solving for other issues, right? So if you think about, in Brazil, you already have PIX, which is instant money transfer. So that use case for digital currency is useless in Brazil, you may say. So why are they doing the DREX? For you to have programmable currency and interaction between tokenized assets and the currency. So I think in the long run, the drawing they have for the DREX is initially a issuance for the banks, reserves. So the central bank's going to issue for the banks, and they're going to be able to hold reserves in DREX. And then each bank is going to be able to issue their own kind of a stable currency, which is a little bit of a drawing of way back on currency-wise. But this is, again, like we are optimistic because there is a view on developing this technology institutionally within the country. But I think we are like 5 to 10 years away of having the DREX, circulating in a public blockchain, integrating with the application. So what we view is that, for example, for stablecoin issuers in Brazil, like Transfero, today the reserves are kind of opaque, right? They're held in a bank account. You can do an audit. You can provide some type of transparency, but they're held in a bank account. With the DREX, we can start to see these reserves starting to become transparent. And with that, you kind of start to abstract this private layer, which is the stablecoin issuer, from the equation, because you have real-time access to the reserves holdings, and that can be a direct proxy for the DREX in public chains.
Yeah, I know we're over time, so I'll try to be super quick. I think decentralization is the only reason why I'm in this industry is because of decentralization, and it's always a spectrum. But I think just as what the internet has allowed, for us to like completely disrupt the way communication and media and getting connected to other humans, and that became like an open system that anybody can connect to. It's not completely decentralized, but it's much better than what we used to have. And all the problems that we're having now, discussing, what is true, what is fake news, like in a way, it's a good debate because we have an open system and anybody can participate. That's a proof that anybody can participate. We don't have that for finance. I think people should continue to question and push the boundaries there. So that's why we're building a system that is potentially multi-issuer, that is open in terms of, the way that issuers can connect to the network. It's governed on chain. It has a layer of validators that can actually introspect and prove that on chain that the reserves are what people claim they are. The protocol is immutable. The stablecoin is immutable, so there's no central entity that can say, oops, we would like to change the functionality. As I think, that's my problem with CBDCs, is because there will always be a way to upgrade them and completely pull the rug from under consumers. So yeah, I think for me, that's why I'm in the industry. I think if we are not pushing for decentralization, then we're not doing the right thing.
Yeah, so we ran out of time. It would be lovely to see you guys back here in DappCon25, see like how much progress we have made. So thank you for being here. Thank you for staying with us. Hope to see you all next year here. Thanks.
Well done. Just. Thank you so much. We're done with the first half of the day today. We'll be breaking for lunch and be back at 2 p.m. Thank you.
I'm Mona. For those of you who don't know me, I founded Enzyme back in 2016, which was the first decentralized on-chain asset management protocol. Today, I still contribute a lot to the Enzyme DAO, but I spend most of my time with Avantgarde Finance. We are one of the leaders in on-chain asset management, and we have a regulated on-chain funds business, but we also support DAO Treasury Management and DAO Treasury Advisory. It's a real pleasure to be back at DappCon today, so thanks for having me. Today I'm going to start my talk by giving you some hopefully new insights into where on-chain asset management is going from the trends that we're seeing. I'm then going to talk to you a little bit how Enzyme is evolving in order to better service and adapt to these needs. And hopefully I'm going to finish off by talking to you a little bit about why certain projects are choosing to build on Enzyme. So if we look at the data, the on-chain data on Enzyme today, it's interesting to observe that more than 90% of assets under technology are being used for DeFi native on-chain management use cases. Now, I sort of say this is interesting because anyone who's familiar with Enzyme today might know that it's usually associated with traditional fund management. So the fact that we're seeing all of these kind of new and innovative new on-chain asset management use cases, I think is a really interesting observation. And I'll talk to those a little bit in a bit. The second interesting observation is that if you look at the top 2 vaults on Enzyme by assets received last quarter, or another way to say that is the fastest growing vaults on Enzyme in Q1, again, they're not funds. They're these kind of new DeFi native use cases which are emerging. So I thought it would be interesting to share a couple of case studies from our top 10 user base and show you how and why they're using Enzyme. The first one I'm sharing here is one of our top 10 users. And Nexus Mutual, I hope most of you are familiar with them. If not, they're a great DeFi insurance protocol. And the way that Nexus works is that it accepts ETH collateral as deposits from users. And on the other side of that collateral, it's selling cover to insure the DeFi space and actually more broadly the blockchain space. So it's a really critical piece of infrastructure in the space, and it keeps DeFi secure. Now, the interesting thing is that until last year, the ETH was sitting in the Nexus vault, not earning any interest or yield. And so the sort of decision that Nexus had to make was, do we build out and add to our smart contracts, which was a little bit of a distraction from growing their existing insurance business, to adapt it to have integrations that we need, the policies that we need to protect assets in a trustless way, and also monitor the assets on chain to make sure that the protocol is never becoming under-collateralized. It turns out, actually, that they heard about Enzyme, and together we were able to very quickly integrate Nexus and Enzyme such that Nexus didn't have to build anything in the end. All they needed to do was connect to Enzyme. And the way they did that was they created their own Enzyme vault, the Nexus vault, which was owned and controlled by the DAO. They configured and customized it in such a way that they could delegate execution to a third party in a trustless way, in a way that that third party couldn't misappropriate funds, couldn't interact with any DeFi integrations that were not pre-permissioned. So essentially setting smart contract enforced roles and permissions. They deposited assets into the vault from Enzyme and in return received back vault tokens. And a crucial bit of the infrastructure is that those vault tokens had an on-chain oracle, on-chain price, which tracked in real time the performance of the assets in the vault. So they incorporated the yield from staking and other activities. Now that's important because at all times, Nexus now knows what the assets are as a whole and can ensure as a protocol that the Nexus protocol isn't under-collateralized. So all of these benefits were extremely useful to Nexus and prevented a bunch of development work from them. It saved them a lot of time and money, and it was also enabled them to move very quickly. So the assets that Nexus have in Enzyme today, that number is slightly out of date, is $52 million, and and we're really excited about working with them. The second case study that I thought I would share is Swell Network. So for those of you who don't know Swell, Swell is a staking protocol. And Swell was looking to diversify staking away from some of the giants and into Swell in order to boost liquidity for their protocol. And when they approached us, the solution they wanted to do was create a Swell, a Super Sweth campaign. What that meant was creating a Super Sweth vault owned and controlled by the Swell DAO, and creating it such that the vault was denominated in Lido staked ETH, which is the largest liquid staking token. So depositors of Lido staked ETH could deposit into the vault, and then they designed a rewards program for people who participated in there and stayed in there. And what the vault did is it used Enzyme's automation to, as soon as the Lido staked ETH was accepted, it was redeemed from Lido staked ETH, and then Sweth was minted within the Enzyme vault. So the result for them, again, zero dev work. We're able to turn this around in a couple of days. They were also able to integrate this into their website through Enzyme's white label solution. And the end result was that they managed to grow their TVL by 22 million, with 639 new depositors, unique depositors, and that's an additional 6,000 ETH staked for them. The last case study I have is DIVA staking, similar but slightly different use case. Similar because, again, trying to bootstrap market share, but different because, interestingly, DIVA was not live as a protocol when they launched their DIVA, when the DIVA community decided to launch this vault. So the DIVA community voted on creating an Enzyme vault. And the idea for this vault is that they wanted to attract and incentivize pre-launch support for DIVA. So the idea, again, they have two vaults here on Enzyme. One is denominated in Lido staked ETH, and the other is denominated in ETH. And the idea is people could deposit into these vaults, and the longer they stayed, or if they stay till the end, they receive DIVA rewards for their loyalty. And the idea is that when DIVA goes live, again, there's a set of policies to control that the behaviors of what can be done with these assets will not be misappropriated or done, anything else will be done with them other than go into DIVA. So the idea is as soon as DIVA goes live, Enzyme will facilitate an integration into DIVA. The DAO will vote to redeem from Lido staked ETH and into DIVA. And because the aggregate amount of TVL in the DIVA vaults is $52 million, that guarantees them a day one launch of 52 million before they're even live. And again, from this program, we've seen 636 unique depositors, which will result in 12,500 ETH staked when they go live. Another interesting characteristic of all these three projects is because Enzyme has APIs and white label, they can integrate all of these vaults into their interface with their own branding very quickly, very easily. And the APIs also make it really easy for them to calculate the rewards owed to each depositor, display them on the interface, and eventually distribute the rewards. So those are three interesting use cases that I thought I would share. Hopefully you found them interesting. And I think what's clear from these use cases is that Enzyme is starting to show itself as a versatile on-chain asset management infrastructure, which is really fostering diverse verticals built on top of its foundation. And it's able to do that because at the core level, the protocol has taken a very modular approach. And that modular approach makes it much easier to build and innovate on top of the protocol. So we've talked a little bit about what we've been seeing in the on-chain asset management, and I've shared a few case studies for how some DeFi native use cases are emerging on top of Enzyme. But now I want to talk to you a little bit about why projects are choosing to build on Enzyme. And there's two parts to this. There's the tech component, and there's the sort of businessy component. So here I have a diagram of, we did an exercise to try and break Enzyme's value add down into like really simple building blocks. And if you look at the first 5 horizontal lines in white, you can see like this is how we see the protocol in a very abstracted way. There's really 5 areas that we see time and time again where users find value in the protocol. The first is the concept of vaults and shares, the fact that you can deposit, receive shares, and manage in the vault while those shares have an on-chain value, and Oracle. The second is the pricing gateway, and by that I mean there's a method built into the protocol, and that method is used to value assets on-chain. The third is DeFi integrations. The way that we do DeFi integrations is at a smart contract level between Enzyme and the third-party protocol. So today we have dozens of integrations with various DeFi protocols and also some staking and governance protocols. The fourth is policies. Some people might relate to policies better when I say roles and permissions, but the idea of policies is really just codifying what vault managers can and can't do. So vault owners can do anything. So let's say a vault owner is a DAO, but if you assign management to a third party, you can control their roles and permissions in a smart contract enforceable way and very user-friendly way through the interface. And these can be things they're allowed to trade, not allowed to trade, protocols they're allowed to interact with or not. It can even be things, because we have this knowledge of price on chain for the value of the assets in the fund, we can also deal with things like maximum slippage stop loss or even P&L stop loss. And the last is reporting. So because we run 7 subgraphs underpin the Enzyme protocol, we're collecting on-chain data in lots of different verticals, and then putting that data into a user-friendly API, which can easily be used for many other things. So that's the modular protocol, core protocol. And then where we've spent the last 12 to 18 months really focused on is the tooling around the protocol. The tooling, I'm going to go into a little bit on the next couple of slides, but really at a high level encompasses SDK, API, automation tools, the white label, which I briefly touched on, configurations, and customizability. Now, the combination of the core protocol plus the tooling lends itself to lots of verticals being built on top of Enzyme in the on-chain asset management space, and lots of front ends being built in a really easy, user-friendly way. So that's what we're hoping to see a lot more of in the coming months and years. And those verticals could be anything from active trading like funds, indexes, protocol and DAO asset management, liquid restaking products, structured products, fintech and crypto banking, etc. This is exactly the same slide, but I've just mapped out here my 3 case studies that I shared with you. And you can see, let's see if I can, you can see here, yeah, our Nexus Mutual is using reporting policies, integrations, and Priceway modules, as well as using reporting policies, integrations, and vaults, and Diva is using all 5 of the modules. So again, just to reiterate, this is all smart contract-based modules that they would have had to build from scratch, would have set them back and cost up a lot of dev time and distracted from their main kind of value proposition. So some of the areas that have been growing and that we have been seeing some traction in on the asset management side are a regulated fund platform. So that is something Avantgarde Finance has been focused on. We became, as far as we know, last year, the first ever company to become regulated to launch on-chain funds on Enzyme in as light way as possible. And we're able to open up that infrastructure to third-party managers. So any fund manager that wants to come and launch their own fund can now do that on our platform without having to go through, I think it took us 18 months to get all the licenses. The second area which we've been focused on, we'd love to, we're very aware that we can't build this all ourselves. So we've been very focused on building through partnering as well. And this easy facilitation of indexes and AI agents is a great example of area where we've funded grants in the ecosystem to help further build out that functionality. So in terms of facilitating indexes, the key thing that we've been asked time and time again for is the possibility to rebalance portfolios automatically. We funded 31/3 to build that out for us through a grant. That's nearing completion. Hopefully we're going to launch that end of May or early June. And we also have become really interested in how AI agents can be useful in on-chain asset management. And so we recently partnered with Giza to fund their hackathon to build AI agents on top of Enzyme. So we're really, I think that's happening this week and next week, so we're really happy and excited to see the results from that. The third area that we're very focused on is DeFi automation strategies. So building automation tools around much more complicated DeFi native strategies. And we've made huge progress in that, and we're starting to actually onboard a few projects in that respect. We've also started to explore RWAs and structured products a bit more. And we have, it's no secret that we're working with Sygnum Bank for on a pilot since last year. And we funded a project called Gorilla Funds, which very excitingly built a direct bridge between Monarium and Enzyme. So through them, you can deposit into an Enzyme vault through Gorilla Funds from Monarium account. And in terms of why builders are choosing to use Enzyme, as I said earlier, the tools have developed a lot since we first set out. We have sophisticated SDKs, APIs. We have automation tools and libraries. We're also building out Python libraries now in addition to the ones we already have. We've also built out a services team to support teams that want to build on Enzyme but maybe don't have all the right skill sets. And the white label is also very helpful to get people building faster. So those were the sort of more technical benefits. In terms of more kind of businessy benefits, the obvious one is it's a huge reduction in cost for a team to build on top of Enzyme. As anyone here probably knows, hundreds of thousands of dollars to launch a set of smart contract protocol and audit that and maintain it per year. So being able to plug into one that's existing is much easier. It also accelerates your time to market. All three of those examples that I shared were, it took about, from the time they made the decision, it took less than 2 days to actually launch them. The infrastructure is reliable and battle tested, which says a lot in this space. We've been on chain for more than 5 years. Enzyme can also help projects accelerate their TVL growth, as we saw with Diva and Swell. And we're also starting to explore more off-chain integrations as the space of RWAs really increases. So to summarize, the way we're seeing Enzyme today is a protocol that accelerates growth for asset managers and builders. And if any of you in the room are thinking about building anything or even want to contribute towards the tooling side of things or even the protocol, as I said, I would definitely encourage everyone to check out the grants section on enzyme.finance or reach out to me. I'll be here this week. So thank you very much. I don't know if anyone has any questions. I think we do have time if there are any. But yeah, thanks.
Yeah, we have about 5 minutes now for questions. So anyone in the audience? Okay, going once, twice. Great, thank you so much.
Thank you.
Okay, we'll take 5 minutes, and up next is Felix from the Cow team. So. Okay, welcome back. Join me in welcoming Felix Leopold to the stage from the Cow team, who's going to share a talk on the question, does Ethereum need PBS? So welcome to the stage.
Thank you. My name is Felix. I'm leading the technical development at Cow Protocol, and I'm here to talk or question more so the direction that we are currently taking, maybe as an Ethereum community, asking the question of, does Ethereum really need PBS, or are there other solutions to what we think is a fundamental problem, MEV, and can it be solved only at the infrastructure layer, or can it be solved at the app layer? Before I start, I want to give a brief history of how we got to the point that we are now with the discussion about enshrining PBS and basically really committing to infrastructure solutions to this problem of MEV. And my history starts in November 2020, when a research collective around Phil Dayan and his PhD colleagues at Cornell and some other researchers in the space founded a research collective that was called Flashbots, and that coined this term, which became very influential in the Ethereum ecosystem, MEV. And the goal of Flashbots was really to hit the problem of MEV head on and tackle it via three main kind of goals: to illuminate, distribute, and democratize access to MEV. But let's first maybe look at what MEV stands for. I think a lot of people know the acronym. It stands for basically any value that can be extracted from the party that produces a block on a blockchain by deciding the ordering of transactions within that block. The most simple example is if you're minting an NFT and there's a limited number of them, let's say 100, but there's 200 people who want to get that NFT, and you're the proposer who creates the next block. It's up to you to decide who of the 200 participants actually ends up getting that NFT. And if you're a big NFT fan yourself, you might even include your transaction first to make sure you get the very first version of it. And so the first thing that Flashbots did was illuminate what they would call the dark forest, the games that were being played in the public mempool around transaction ordering and the value that was extracted from users by doing so. They created a number of transparency dashboards. This one is one of the more recent ones that only captures the value extracted since the merge, but that basically showed how much of a problem MEV really is. It's $1 billion a year kind of value that's being extracted, and at least the data that we see here is a lower bound because there's a lot of value and communication that are not actually visible on chain. So the true MEV that's being extracted is likely an order of magnitude more, and that doesn't even take into account all the MEV that would be created if we got a lot more users on chain. And at least in our mind, solving MEV is a prerequisite of getting 1 million more users on chain, because if there's no safe and secure ways to make sure you're not being taken advantage of, you will reside to other solutions. But let's go back on the timeline. It is 2021. After illuminating the dark forest, Flashbots went on to democratize access to MEV by creating a client, which was basically a fork of Geth that they called MEV Geth, and which gave block producers, which were called miners at the time, a way of communicating with another party for the extraction of that MEV, and that party was called a searcher. Miners were traditionally very good at getting access to cheap hardware, cheap electricity, but they were not DeFi deegans that would understand the underlying protocols and optimize kind of the games and strategies you could do in reordering, including, or censoring transactions in meaningful ways. What MEV-Geth basically was now an auction protocol that would allow the block producer to kind of sell off the right for proposing the correct, the most value extracted version of the block to an external party, the searchers, and basically have an auction for the searcher that bids the most for what they would call a bundle, just an ordering of transaction, end up getting their bundle included on chain. We can see here that MEV-Geth basically created a huge amount of extra revenue for the miners that opted into this system, an order of magnitude larger block rewards if you were a participant in that MEV-Geth protocol and you used the extra revenue from the MEV, versus if you were just sorting transactions the vanilla way that Geth would do. And so MEV-Geth found a lot of adoption. I think just before the merge, it was around 90% of blocks on proof-of-work Ethereum were produced using MEV-Geth. And this was somehow kind of possible and easy because proof-of-work was very centralized. There's only roughly five or a handful of different mining pools that were producing the largest part of blocks, and all that kind of, this Flashbots had to do was to convince those 5 mining pools to adopt MEV-Geth, and basically they could reasonably do so because there were so few of them. However, one of the fundamental problems of the MEV-Geth approach in proof of work was that there was a trust assumption inherent to the auction. The searcher would not be able to just reveal the bundles that they have found kind of straight to the miner and say, here's the MEV that I found, please go and extract it, I will pay you 50% of it. Because in that case, the miner could have just taken that bundle, replaced the transaction of the searcher, put in their own address, and taken 100% of that value. Now, this kind of trust assumption is inherent to this new, you have searchers, you have block producers, But it was not such a problem in proof of work because the block production process was such a repetitive game. If there's only 5 entities creating blocks, and it means like every minute you are creating a new block, if you were to violate that trust assumption now just to get maybe 1 or 2 more ETH in the current block, you would lose up all the revenue in the future blocks because no searcher would reveal their content to you anymore. However, in proof of stake, our vision was that we would get on to many, many different solo stakers, each of which would maybe produce a new block once every 4 months. And so that trust assumption and that repetitive game, that violating trust in one round of the game would sacrifice your entire revenue for the future, is much more of a big problem if all you really get is 1 block every 4 months. And so I guess if we hadn't thought about PBS, or if we hadn't introduced PBS at the time, what would have happened is Flashbots would have gone to the big staking pool, got them involved into continuing to do the MEV stuff and working with searchers, and the solo stakers would have kind of been left out because you cannot really trust them, but that would have led to significant centralization on the validator parts. Big mining pools or big staking pools would be able to get more revenue, and so they would be able to accrue more and more stake, centralizing the protocol further. So what the Ethereum Foundation and also Vitalik's post kind of suggested was that we split the task of creating consensus around what is the next block, kind of more on a high level, what is the block header and attesting and validating blocks, to this core decentralized solo staking incentive capable group of people, and have another task that is more specialized, more complex, which is actually creating the full contents of the block, which transactions go into what slot, to a different party, which would be called the builders. So we can keep proposers highly decentralized. There's no advantage in being a big staking pool or a solo staker, as long as you opt into this, again, auction system where builders kind of propose blocks that you would adopt, and you as a validator only have to take the highest bid and not worry about finding any arbitrage or finding any other MEV yourself. So, this is great system and great in theory, and also Flashbots agreed to adopt this system and basically build a proprietary version of PBS, which they called MEV Boost. MEV Boost got huge success in the first 3 months after the merge, and I think today about 95% of blocks are built using this version of PBS. However, the fundamental trust assumption that we had in MEV Geth and that we're trying to also somehow model with PBS remains, is that the builder or whoever finds the MEV cannot just simply give out the blueprint and trust the proposer that they will not unbundle the block or change some of the blueprint for themselves. But at the same time, the proposer can also not just say, hey, builder, just give me a block header and I will attest to it, because if the proposer attests to a block that's invalid or doesn't actually get revealed at the end, they also lose out opportunity cost and potentially even get slashed in the proof-of-stake protocol. So one of the core components in PBS is this middle layer, the so-called relay, which bridges that gap and again takes something that is maybe not so repetitive in the game, like a proposer only validating a block every 4 months, and makes it a very repetitive game. Builders will not submit their block blueprints to a relay if a relay starts leaking the content of the block blueprints, and proposers will not request blocks from relays that have been known to give them invalid blocks or blocks that end up not getting revealed on chain later. And so we ended up again with this somewhat central component that involves trust, and now the idea of enshrining PBS is to basically apply the fundamental theorem of blockchain engineering, which says that, well, any problem can be solved by just introduction of another consensus committee, and basically try to put that relay into the core layer by virtue of adding a new consensus committee. I don't think this version of PBS is final yet. I also don't want to go too much into the details of how it works under the hood, but basically you will have then the validators, which are fully decentralized, attesting to the block headers, and then you'll have another committee and the builders who are responsible for revealing the block content separately. But needless to say, adding another committee adds complexity to the chain, and it's not even clear that enshrined PBS will be adopted, because whenever you try to build something into a peer-to-peer layer, you're taking some trade-offs which you don't have in the existing system. Some advanced features of relays today are, for instance, builder bid cancellations. So if a builder changes their mind and doesn't want to pay 10 ETH for the block anymore, but only 9 ETH, they can do this today. and also more advanced co-location techniques where you're trying to really shave off milliseconds of latency by being very close to the relay or very close to the builder are things that just simply do not work in a fully peer-to-peer system. So even if we enshrine PBS into the base layer, it's not clear that big builders and large staking pools will adopt this as the only way of producing blocks. So the question that I want to ask is it worth to add all this complexity, or is there not another way of how we can address MEV? And I think one slide that I actually also wanted to just briefly mention, one of the kind of obvious drawbacks of this proposer-builder separation is, well, it keeps the proposer layer very decentralized. We have 1 million validators that are proposing blocks. But if the thing that's really important about blocks on Ethereum is what's inside them, and if the entities that decide on the contents of the block are just 3 that create here, I think, more than 90% of today's blocks, and 2 of them, for instance, apply some semi-questionable censoring decisions to the contents of their blocks, then how decentralized is Ethereum really? Like how much value is there in having decentralized block header production if the block content production is highly centralized? Okay, so this was my rant. Let's now go and try to find an alternative on how we can solve this. Before we do so, I want to go through a few more types of MEV that are kind of at the core of this problem and contributing to most of the value that is being leaked today. The first one you probably all know, swap MEV, commonly known as sandwich, front-running, back-run. If you go on a MEV-aware block explorer like this one, ZeroMev, and look up a trade that you may have done in the past on Uniswap or some other kind of traditional AMM, you might find yourself in what is known as a sandwich, which basically you have someone that is labeled as the miner, so it might be the searcher or the builder, that ends up trading the same asset that you're buying, coincidentally just in front of you, driving the price up. Then your trade gets included at a higher price than you would maybe originally expect, and then that same entity is selling the asset at the higher price because you just drove the price up even higher and makes a risk-free profit. Swap MEV is the most detrimental MEV to the average retail user, but not the largest MEV in terms of absolute cost or absolute kind of value leakage. The largest is actually the arbitrage that happens between centralized and decentralized exchanges, which is also commonly known as LVR, loss versus rebalancing. And it stems from the fact that centralized exchanges move at a much faster pace than the Ethereum blockchain. Binance has a trading model of continuous time, so the price on Binance updates kind of always, whereas the price of a Uniswap pool, for instance, on Ethereum can only update every 12 seconds when there's a new block. And so now let's say that the price of Binance went up and the price of Uniswap stayed untouched for the last 12 seconds. Whoever now gets the first slot in the block and can grab that outdated liquidity from the Uniswap pool at, I think, $2,800 here, can turn around to Binance, sell it for $2,810, and make a risk-free profit. That difference is called loss versus rebalancing, and it's basically a cost, a tax that is paid for by the liquidity provider that contributes funds to Uniswap. You can see this type of MEV usually at the top of the block. There are many minor transactions that are buying the same asset kind of on different pools, trying to sweep in all the outdated liquidity at outdated prices and paying a hefty tip to the proposer to get the right to be included in the first slots of the block. We also have liquidations. If you have an Aave or Maker position and your collateral becomes worth less, then the protocol might trigger a permissionless liquidation where anyone can buy the debt from you and pay back the debt on your behalf to seize your collateral, which again creates some MEV because there's usually a premium for doing so, and so people are racing to be just behind the Oracle update, which got your position underwater. There's 2 more types of MEV, which by and large are negligible in terms of frequency or size, so I don't want to go much more into detail here. The thing that I want to do is I want to slice MEV by a dimension which I would consider DEX-related MEV and non-DEX-related MEV. And what we've done here is we've looked at the transactions that are not found in the public mempool but ended up on chain. So these are transactions that have been communicated directly between searchers, builders, block producers, and those are an indicator of kind of MEV transactions that try to kind of have a preference on how they are ordered. And if we then look at how much of those this is the value that they produce. If we look at how much of those transactions are involving some kind of DEX trade, and how many are not, we can see that MEV is vastly, vastly dominated by DEX-related transactions. So if we can get rid of DEX-related MEV, my argument is we get rid of a large chunk of the MEV. Even the non-DEX-related MEV on this slide is partially could be considered somewhat trading-related because NFTs are taken out of here and even some of the liquidations are not accounted for. And so if we can solve DEX MEV, we are basically reducing the amount of MEV by an order of magnitude. Okay, so let's try to solve DEX MEV, and for that I want to first recap the root cause and kind of what do all these points that I had before have in common. The fundamental flaw that I think we've been doing in Dapp design for the last 5 years, or basically since Ethereum is around, is that we've built DeFi mechanisms on the false promise of continuous time. If you trade on Ethereum, if two people trade on Uniswap in the same block, those two people will get different prices. So we are in this spot now where there's only some amount of information getting revealed every 12 seconds, and the ordering of how transactions are ordered in the block that gets revealed is up to whoever produces this block, yet we have the same asset inside the same block trade at many different prices. Here we have the most liquid asset, ETHUSD, trading at 1% difference within the same block. And this basically allows the block producer to look at all the different trades that are in there and say, okay, I'm going to create a transaction that buys at the lowest price and sells at the highest price and make a risk-free profit. Really, to me, that's kind of the fundamental root cause of MEV, or DEX MEV at least, is the fact that the same asset in the same block can have many prices. So how do we solve this? I have to speedrun this solution. It's basically what's implemented in Cow Protocol. I'm happy to talk more in detail also afterwards. But basically, first, what we have to do is we have to break kind of the sequential processing of transaction that is inherent to the Ethereum protocol. So instead of having people say, I'm sending this transaction touching this Uniswap pool, and that's my trade, we need people to sign limit orders, or how they are now called, intents, that say, I just want to buy some Ether and at the best price, but I don't care which pool you're using. Because that then allows us to batch all those trade intents together into one big settlement transaction, which, together with all the other liquidity we can find on-chain, we can solve for. So you can think of this as like a market with demand and supply, and we're trying to find a solution that kind of settles demand and supply, but it adheres to one simple rule. Every token just has a single price per batch. So if you're trading Ether and I'm trading Ether, and we end up in the same batch, we're getting settled at exactly the same price. Because there's no time priority, there's no concept of who came first, who came second in Ethereum, it doesn't make sense to have different prices. Now, finding such a clearing can be a very computationally complex task. In fact, it can be intractable for larger problem sizes. So what we need to do is we need to decentralize that solution finding off to a network of what we call solvers, which can try to find solution candidates for our batch auction problem and report it back to the protocol. The protocol then scores those candidates based on a goodness criteria, which we call surplus, and picks or allows the solver that proposed the best solution to settle the trade. So how does this protect from MEV? I mean, basically, this is what we built with CowSwap or Cow Protocol, or at least the design has been heavily influenced by this fundamental idea. And it provides MEV protection for a variety of MEV causes that we saw on the previous slide. First of all, it protects users from swap MEV. In the very simple sense, even if you're just looking at intent-based systems like Uniswap X or 1inch Fusion, one thing that those intent-based systems allow is they allow you as a user to just say, I want to buy Ether, and I don't care where, which makes it much harder for a searcher that's trying to manipulate the price on a specific AMM to target your trade and, well, basically manipulate the price. Because instead of just having to address one Uniswap pool that you picked before, they now have to kind of manipulate the entire liquidity that they can find on chain. More importantly, by being agnostic to the exact route that your trade is taking, we can do some more optimized things like deciding to not actually match you against an AMM, but instead match you against another user that also wants to trade at the same time. This is what we call coincidence of wants, short cow. It's where the protocol takes its name from. And the idea is that if you want to buy Ether in the same batch as I want to sell it, then why do we need to pay liquidity provision fees, price impact, and all this stuff? Why don't we just trade peer-to-peer? But even if we cannot find a coincidence of want inside the batch, maybe the solver knows that, oh, this person is buying a very liquid token. There might not be a counterparty right in this settlement here, but I'm sure in the next 5 minutes somebody will show up and take the other side. So a solver might just take some private inventory risk and market make your swap against you, and you don't have to touch an AMM and therefore are not exposed to MEV risk. But even if your token is illiquid and you end up just swapping it, the best route is just ending up swapping it on Uniswap. It's not you who's taking the MEV risk who has to defend themselves against sandwiches, maybe use a private mempool or do whatever more sophisticated entities in this space would do. It's the solver that has bid for the execution who is now responsible for delivering that execution to you. Solvers are sophisticated entities, so they can protect themselves from the risks of the public mempool much better than users can, and we've abstracted that problem of MEV away from the user. But Cow Protocol doesn't only solve MEV for DEX traders and swaps. It also solves the much larger problem that we've seen of centralized exchange, decentralized exchange arbitrage. Because if we actually make the liquidity provider part of the batch and also settle the AMM at the new equilibrium price, which, if you remember the slide, was much larger than what Uniswap was in the previous block, then that entire difference, that LVR that currently gets captured by the arbitrageur, but who has to pay 99% to the builder, who has to pay 99% to the validator, gets captured by the liquidity providers and can serve as an additional income on top of LP fees as revenue. So we can really make AMMs much more profitable by making them part of the batch and also having them adhere to uniform price clearing. And CowDAO is working on a product for that, which hopefully will come out soon. Liquidations honestly can also be solved in this kind of model. At the end of the day, a liquidation is just a conditional stop-loss order where you're willing to sell your collateral once a certain price is hit or it goes below, the asset goes below a certain price. It's not yet done in CowSwap specifically, but we'd love to work with projects to explore also how we can capture liquidation MEV on the app layer rather than on the infrastructure layer. Now, I was talking a little bit about centralization of PBS and the builder infrastructure before. Of course, one of the questions we get asked also a lot, well, isn't Cow Protocol also going to get centralized? And there are a few centralization risks. I think the most obvious one is, well, if the builder market is centralized, how do we make sure the solver market doesn't centralize in the same way? Well, we have been using, or the DAO has been using Cow Protocol's tokenomics to incentivize a more heterogeneous and like diverse set of solvers to operate by not simply giving just rewards to the winning solver, but also giving some what's called consistency rewards and making sure that we have a good coverage of competition on kind of the token pairs that people care about. And now the clicker died. But the other centralization risk is, well, whenever you have an auction, you might also have a need for some auctioneer. The thing that you saw on PBS, it was called Relay. But I think that for CowSwap, what we actually need as an auctioneer is just a data availability solution. We need to agree on what are the orders that were valid when a batch was kind of released to the solvers, and then we need data availability on all the solutions that were kind of proposed by solvers and which one is the best. And even if we end up creating a lot of complexity, I think it will be simpler to build this than enshrining PBS. But even if we just need another consensus committee and also apply the fundamental theorem of blockchain engineering, then at least that complexity is localized to the DEX use case and doesn't affect general transfers or all the other applications that we'll hopefully be able to build on Ethereum that don't involve decentralized trading. And with that, I want to close and ask you to join us on the mission to fix the underlying mechanisms and not kind of work towards more complex infrastructure and load the base layer with all that complexity. And yeah, basically, thank you very much.
Great. Yeah, thank you, Felix. So next up, we have Ugur Mersin from API3, who will be sharing with us today on the revolutionizing DeFi with MEV-aware oracles. So Ugur, welcome to the stage.
Check. Holy. I can't see anyone, but that's all right. Hi, my name is Ugur. I work at API3, jack of all trades. For those of you who don't know API3 or have never heard of it, an Oracle project. There are many of those out there. I'm pretty sure you heard probably all of these names. And more specifically, in the context of, let's say, DeFi, all of these, in one way or another, provide you with the same thing that all of you want. Please give me a price feed of, let's say, ETH/USD. Obviously, there are nuances to it. Everyone does it slightly differently. There's different levels of centralization, verifiability, and so on. But especially during a bull market, dApps tend to not care about that. They just want a certain price on a certain chain. And all of these projects, essentially doing the same thing, are competing on a beautiful chart, let's say, which is the DeFi Llama TVS chart. And that is essentially the value that all of these oracles, in one way or another, secure by providing price data to certain protocols. And I titled this slide, Meaningful Numbers Without Meaning. And there's a certain reason for that. We are somewhere at 9. And at January this year, we weren't even on this list. We had like 10 million or so. I think in the next couple of days, it's going to be at like 1.5 billion. But our revenue is unchanged. So it was 0, and it is 0, and still. And we could be securing 10 billion, and it's still going to remain 0. So the Oracle game, essentially, is a subsidized, what I like to call, mess. Nobody pays, but everybody somehow secures value. And the meta, so to speak, to make money as an Oracle project is the following. You climb the corporate ladder, aka DeFi Llama. You do that with all means necessary. You bribe people if you need to. You promise them tokens if they switch over to you. Once you have somehow attracted a couple of protocols and are somewhere there, up there, and you have made a name for yourself, you market that heavily. Like, look how much we're securing. And the fact that you bribe people to get there doesn't matter. The fact that you make 0 money also doesn't matter. And then you initiate phase 3, which is you just sell your token as heavily as you can, because you need to keep these feeds running. There's costs associated. But there's effectively no value capture mechanism for your token or your token holders. And effectively, that brings us to this situation. Nobody makes money. Every Oracle project somehow just dumps on you relentlessly. From a dApp perspective, especially during bull markets, nobody actually underlyingly very much so cares what they use. Everybody is kind of the same. Just give me a price. And business development is somehow reduced to promising people token. Like, if you switch over, we'll give you X amount of tokens worth, let's say, 100K. And this is a very unsustainable business model, or a completely unsustainable, essentially, situation. So if you want to build price feeds, let's say, there's no way you're going to make money with those price feeds, because some other project is going to come, they're going to create a token. With potentially point systems seem to be very attractive right now. Some point system, if you switch over, and they're going to heavily subsidize it, because that has been the name of the game for the last 4 to 5 years. Essentially, this is something we did not want to take part in, and also everybody kind of does the same thing. They do price feeds. So how do we do something slightly different? Like, how do we do something more, offer anything more than just simply a price? And that is why we essentially how we got to focusing on something called OEV. OEV stands for Oracle Extractable Value. You already got a little bit of an MEV introduction in the last presentation. So essentially, any value that can be extracted due to Oracle updates. And there's a lot of examples for this. I'll do the most basic one that everyone will most likely understand. Everyone here probably knows GMX. It's a derivatives platform, so you can go, let's say, 50x long on ETH/USD. The nuanced thing about it is it's not based on an order book. Like there's no other side actively taking the trade against you. Like it's LPs, but no essentially order book style. You take that trade on the basis of an Oracle price. Now the Oracle price is on-chain, and when the Oracle updates, you see that in the mempool. So what you can do is you can monitor the mempool. Let's say ETH is at 3,000, and you see the next Oracle update coming in at 3,030. You place a trade, go 50x long right before the Oracle update, and essentially close your position right after. And that's guaranteed profit. There's nothing that anyone can do to stop you from this. And this has been going on for GMX in late 2020, where for 40 days, essentially, somebody just continuously opened the trade before an Oracle update, closed right after, and funneled off like $250,000 in potential profits. Just the most basic example of OEV. How big is the issue? This is a past number. This is closing in on well on $500 million that has been lost across numerous protocols. And it's lost in the sense that users of these protocols are bleeding this value away needlessly. And I'm going to, in this presentation, go heavily into lending protocols because it's the most easy to explain. So lending protocols are utilizing oracles to determine what your collateral potentially might be worth. When you then take a loan against that collateral, let's say you put an ETH in and take out 2,000 USDC, you essentially have a health factor. As long as this health factor is above 1, you're fine. You can just go on about your life, use that USDC, ape some more ETH. But the moment essentially ETH drops in value and your health factor drops below 1, you become liquidable, sorry. And what determines that is essentially the Oracle price change on-chain. And in order to essentially not risk getting into bad debt, these protocols are offering up a percentage of your collateral as a bonus to get anyone that wants to compete to liquidate you. And we say it's 5 to 10%. I recently also saw some insane numbers, 5 to 20% essentially of your collateral being offered up in case you get liquidated. Now, the bad thing about this is, or like, first of all, the flow, like if you get liquidated on a lending protocol, the flow is typically that the Oracle updates, your health factor drops below 1, and then searchers see that your position is now liquidable, and a bunch of other searchers might also see it, and they compete in block space auctions to have their transaction included first. So they bribe block builders, validators to have their transaction included above others, and then essentially you get liquidated, the searcher makes whatever is left after paying out the bribe. The interesting thing here, however, is that this competition for liquidations is quite significant. This is a quote from Monocero's report called the MEV book. And basically, on the right side over here, you see the largest liquidation on the Aave protocol this year in January for 4.2 million. You see essentially here how much was available as a reward for this liquidation. And you see below how much the searcher paid as a bribe in order to execute this, to walk away with $60.59, 95 cents. So essentially, this is a common occurrence. Protocols are offering up to $141,000 in rewards, but the searcher is willing to take $60 and use the rest to bribe his way to $60. And the funny thing about this entire concept that is happening on-chain is all of this is only possible because Oracle projects so far have decided not to take advantage of their privileged position. And what I mean by that is that the entity deciding what the price on-chain is could, in theory, simply bundle the Oracle update together with the liquidation. So all this of people seeing a position would never happen because together with the update, atomically, the position would be gone. So there's no chance for anyone else to catch that position, which obviously opens the question, if you have essentially this super entity with deciding the prices, why should anyone else compete? Like, you're going to have nobody else looking for liquidations, and now you end up in the situation where if the Oracle project ever fails to liquidate, there will be nobody else to liquidate, and you're kind of wrecked. So Oracle projects have collectively so far decided to ignore liquidating on lending markets for this potential danger. So they just update blindly. They don't care what potential OEV happens across whatever many protocols. So as a summary of how liquidations look right now, we have established that the fees are too damn high because we know that liquidators are giving away 99% of what they're being offered. And in theory, the oracles hold all the power. So how do we solve this? And we solved this, or are trying to solve it, there's very, very different approaches to it, by building an auction mechanism on top of the oracle. By simply moving the auctions, essentially, that currently already happen on the block space level, and making people compete for the oracle update that allows for the liquidation instead. And how we do that is essentially with what we call the OEV network. The OEV network is an oracle market and like a roll-up with an auction platform that is essentially hosted on a roll-up. Here you see essentially our general infrastructure. API 3 operates what we call first-party oracles. These are data businesses in the space, like CoinGecko. They operate the oracles directly themselves. And they maintain a feed on, for instance, Mantle like ETHUSD. This feed is slightly delayed by 15 seconds. And they also sell in real-time data without that 15-second delay on this roll-up. And now you, essentially, as a searcher, you can see it as an express highway. If you see a certain price that you like, where you can perform a certain action for, let's say liquidation, you can get the price immediately here for competing for it, go to the chain, update, and essentially front run. You don't have to wait for this to happen, for these 15-second delay to pass. You can just essentially scoop in and get the potential liquidation, and whatever you paid for it here is enshrined in the meta transaction that we give you, and you pay the dApp in the process to do that. So on this rollup, there's essentially an auction ran for each data feed on each chain for each dApp. So essentially, there is Mantle USD for Init Capital, which is a dApp on Mantle. You could have ETHUSD for Compound on Arbitrum. You could have BNB USD for Venus on BNB chain. And the searchers essentially can place bids. Let's say they pre-calculate there's a massive position that is liquidable at 3,000 ETH. It gives me a reward of $1 million. I'm bidding 900K. The moment the oracles essentially hit 900K, the answer is posted here. You can take that answer, and that answer enshrined has essentially how much did you bid, which chain did you win on, which dApp did you win on, and all of the oracle answers that you need in order to update the data feed. And you can essentially bundle this together directly with your liquidation. The dApp gets paid, you get the remaining reward, and the position is liquidated. And what then happens is essentially that these 141,477 that currently are used as a bribe to effectively, or like the cost rather here, to pay validators is now returned to the dApp. So that's a massive amount of money that you now have at your disposal. And what do you do with that? And that is essentially the core of the essence of this presentation. I just needed to explain a lot of how that works. So you have millions, sometimes even hundreds of millions now coming in. Like, what can you do? By simply changing an oracle, you essentially now make a lot of more money, which allows lending protocols to potentially customize themselves to become, let's say, more advantageous in certain areas. One potential solution is, I'm pretty sure you all are aware of Compound Finance. Compound is essentially a lending protocol, and they hand out essentially comp tokens as a liquidity mining reward for you to, for instance, lend them your ETH. And from inception to date, Compound has, quote unquote, lost or paid out 90 million in liquidation bonuses. So 90 million users have been overcharged by 90 million since inception. If you actually essentially got all of that back, essentially what I've written here. If Compound recovered the OEV and bought comp tokens at the end of each month since inception, you would have now an additional roughly 700,000 comp. The daily issuance of Compound is currently 1,652 tokens. So essentially, if we keep that number up, they could keep their liquidity mining program, which will essentially last maybe for 2 more years or so, running for another 1 year or so. Another interesting idea is, this I think is my old slide, sorry for that, but you could essentially take OEV from liquidated borrowers and offer it to borrowers that are more reasonable. So what happens is that if somebody goes degen, let's say 5x long on Aave and actually gets liquidated, and you now have this new money that you distribute among the other borrowers, you drop their costs to potentially near zero, and you having the costs at essentially near zero will attract other borrowers, and all of this will create a positive flywheel where lenders are just essentially making a lot of money. The third thing that people could potentially do is token burns. Just showing this at the example of Venus, also a lending market on BNB chain. From inception to date, Venus has lost roughly 70 million to OEV. If they recovered that every single day and at the end of every single day bought their own token, XVS, they could have burned roughly 4,600,000 tokens. That is essentially 15% of the total supply. And the current circulating supply would be down by like roughly 30%. So there's various different ways how lending protocols could use that money that is now coming in. They could make their own token more valuable. They could make the markets that they're offering more valuable. They could keep liquidity mining programs running for longer. And the fourth way that I actually don't have on the slides here is you could also just give it back to the user that was liquidated and drive the cost down immensely. So why would you use a lending protocol that charges you a 20% penalty if there's one that charges you less than 1%? And that is essentially the summary of this presentation. Was a bit quicker, made some time up from before. If you have any questions, shoot. Our feeds are live on like over 25 networks right now, and the auction platform is set to launch imminently. It's already operational, and liquidations are already being performed on most of our customers through that. It's just not publicly announced yet. Nope.
Great. Thank you for the lovely presentation. We have time for questions. So we'll start off here in the front.
Yeah, thank you for the talk. Could you explain maybe a bit more? So you mentioned that the oracles can technically exploit their privileged position, but they just decided not to do that. And my thought is, OK, if I'm an oracle and I want to bundle my oracle update with a transaction that exploits this like market inefficiency, how do I ensure atomicity of these two transactions? Because in the end of the day, they will be included in a block by some builder or by some like validator or whatever you call them. And it's up for them eventually to maybe unbundle my transaction and replace my transaction with their own transaction. It's not up to me to construct a block, right?
Yeah, but theoretically, essentially, the oracle can still limit who is allowed to update that specific feed and what action follows it. So essentially, if you only allow the first action to happen after the second one, there's like no way for anyone else to take advantage of that. In our system specifically, for instance, if we sell the rights, the right to update is attached to a certain address that is allowed to do that. So that person essentially then bundles it together with like the oracle update together. Only they are allowed to update, and after that follows the liquidation, which means that if you essentially try to split the first one like apart, like you can't actually do the second one because the first one has to go through for the second one to go through. Okay. Yeah. We can have a chat after. Just come to my booth.
Great. Yeah, next over here on the left.
In your example with the
the fast highway and the 15-second delay for Mantle, what is the incentive for the layer 2 in this case to to agree to that 15-second delay, or is there some incentive?
It's not something that the layer 2 decides. Like the Oracle nodes together essentially just imagine it as two endpoints. One is selling the instantaneous data, and one is selling the 30 seconds delayed data. Similar to some, let's say, stock API providers. Some have like these 15-minute delay regulatorily that they can't sell you real-time data, but they can sell you 15-minute delayed data. And similarly here, you can essentially see it. The regular ETHUSD feed is maintained with a 15-second delay, but you can have instant data whenever you want over the rollup and just pull it into the chain whenever it is beneficial for you to do so. So like, it is nothing that the chain essentially can decide, but obviously the chains are incentivized to do this with us because we're essentially keeping, first of all, TVL on their chain. The liquidation bonuses are typically just leaving the chain. If you pay out, let's say, 100K as a bonus because you liquidated someone, rarely does that stay within the ecosystem. You essentially took away TVL from a potential DApp. All chains are competing for potential value to climb up again the DeFi Llama corporate ladder. And here the chain is incentivized because money just stays with the DApp. And essentially the DApp is incentivized because they climbed the corporate ladder, and so on and so on.
Great. Highly engaged audience. We have,
I was just wondering, how do you guys bootstrap the searcher market for backrunning the liquidations? Yeah.
That is a very good question. I think that is the most challenging part with any system. It's also when people typically say every DApp can just run their own auctions, this is the first problem that they arise to, like how do you actually get searchers? And we're in touch with a lot of them, essentially incentivizing them through agreements with us to get it bootstrapped. And then the idea is that when it grows large enough, similar to what happens on mainnet, you will actually have natural competition appearing. You already see dApps making these sorts of deals on their own. I believe like Angle is a good example. They have a private deal with, I think it was Propeller Heads. So dApps are already essentially pulling in searcher teams themselves and making deals with them. So initially to bootstrap, we will have deals with a lot of searcher teams, making sure that there are sufficient liquidations. And some of these protocols that we work together with already have established deals that are just going to essentially use this new highway to make use of the privileged position and flow money back to them.
Great. And time for one last question. OK. With that, thank you very much. We'll take 1 minute, but stay in your seats. So, thank you. Hello again. OK, so next up we have Yaron Vellner from B Protocol, who will be sharing a talk today entitled Humans versus Code. Permissionless MEV, revolutionizing DeFi with permissionless, anyway, OK, great.
So thank you, everyone. MEV will not actually be the topic of this call.
But this call is somewhat related to the previous one, because also here we are actually not trying to solve problems in oracles, but rather try to suggest Oracle as a solution to a problem. So this talk is a lot about risk management and the problems and a potential solution to it. By the way, for the stage, the timer is not running. So first of all, what is DeFi economic risk management? Because I'm pretty sure everyone in the audience are kind of aware there's a lot of risk in DeFi and smart contracts, crypto in general. But most of the people are particularly concerned not with economic risk, but rather smart contract hacks, loss of key, and all the classic cyber security attacks. And this is mostly because we are at a very early stage where most of the issues we see stem from these kinds of things. While in traditional finance and eventually also in DeFi, and I'm hoping sooner rather than later in DeFi, we will reach into a stage where like all the classic bugs are kind of solved. We can write like very robust software and smart contracts, but then the economic mess begin, and specifically in finance, and also these days in DeFi, credit and issuing credit is one of the most maybe saddled issues and problems, and a lot of bubbles and problems and bankruptcy issues stem from there. So the focus here in this talk and economic risk management is right now mostly around lending. You also see it in maybe stable coins, which are some particular form of lending. And it's mostly about some protocol is giving a loan, and typically versus some collateral, where the goal is to eventually have the user to repay the loan, and where the only reason where users do not repay is if the loan terms were kind of too generous, and at the end of the day, the collateral might worth less than the user debt. And then, especially in DeFi, where everything is permissionless, the user will just run away with the debt. So risk management, economic risk management is notorious already in TradeFi, not only in crypto. And arguably, it was one of the kind of factors that even led to the creation of Bitcoin, right? The 2008 financial crisis was largely a credit crisis, where a lot of loans, specifically mortgages, were given in such a way that eventually borrowers did not have to repay their money because the collateral was some kind of subprime real estate, which ended up worth much less than the actual borrower's debt. And this world is controlled, like in the TradeFi world, this is controlled a lot by like very few agencies. I think notably most of them are Americans, known to be biased because of political and also business conflict of interest. There's arguably kind of, like very huge bias towards maybe the US as a country, right? The government debt, risk management, right? And we can only speculate. It has to do something to the location of these agencies, the connections they have, etc. Okay, so this is TradeFi, but now we have crypto, right? And everything is perfect. So now, right, like last year, we had some bankruptcies that was largely due, not only due to loans and credit, but specifically due to kind of very creative risk management and issuing loans. So Zero Capital, you can argue also FTX case might have been, like a complete fraud, but eventually also there were entities that were giving them credit. I think Genesis Trade or Capital is notably kind of a, like very serious entity with their own risk management team. Where at a certain point, they took a decision which is, to be honest, very common, like in banks and TradFi, just not to liquidate 3-arrow capital, because otherwise it would trigger, like a even bigger liquidation cascade and mass run to the bank, etc. It didn't work out for them. FTX poses liquidations for Alameda, so okay, that's probably fraudulent, not because of some risk management, but still all bankruptcies, like eventually stem for that. And then you can say, okay, so, crypto is still, like an emerging market, not heavily regulated. But here we actually see, like an example from the London Metal Exchange, where the exchange operator decided to pause trade for a while, and like there were a lot of complaints and suggestions. They did it to protect one of their whales from liquidations. And okay, so this is regulated, so there are some lawsuits about it, but like eventually we can only speculate, why they paused the trade when they did. So okay, so this is crypto, this is TradFi, but of course DeFi, right? DeFi is different. We have DAOs, everything is transparent. We have forum posts, right? We know the agenda of all participants. So to some extent, it is true. However, at the end of the day, it's still very common for humans to eventually take decisions on risk management, also in DeFi, whether it's a DAO or some committee that recommends the DAO what to do, or typically like a multi-sig with some either off-chain or on-chain vote. It doesn't really matter. The point is that eventually you have people with many interests, and to be honest, in these days, there are mostly like good people all around. But one day it could change. And like very recent example, and again, this is not like the worst example out there, and eventually things there didn't really, went too bad. But like a month ago, we all witnessed like a DPEG of unknown LRT, Easy East. And this had an effect in particular on two lending markets. And actually there we saw like two phenomena which are very typical in DeFi risk management. So one is that one platform decided to freeze liquidations, which is again like perfectly valid decision to make. In retrospect, it saved the platforms from a lot of bad debt. However, this is DeFi. We like to, or I'm a developer. When I'm interacting with a DeFi protocol, my kind of source of learning how the protocol is supposed to work and how it will work is from the code. It's also very possible that this policy was somehow conveyed in a forum post. I don't know, maybe yes, maybe no, but even if it was conveyed, at the end of the day, if you have like a person that need to decide on whether you need to click the button, you don't really know what will happen, and there are always, some considerations here and there. And again, this is something very common that a bank will do. Maybe, it even has some sort of like expected positive value in terms of the outcome. But this is not really how we would expect DeFi to work. And then like in another platform, which might be the opposite problem, but one of the issues with human risk management that it is slow to respond. And here, so like the previous call was on MEV, so it's not only, we are not talking here about 10 seconds and about beating, MEV bots, but here I'm talking about, like hours, even days, and actually it is the norm that in some lending markets that are controlled by a DAO, it can also take weeks. So here, like in this example, in one platform, so because of the DPEG, liquidity was completely drained, and like for over 24 hours, this collateral was still offered with very attractive lending conditions, even though the amount of collateral was like 10x higher than the actual DEX liquidity out there. So it takes time for a human to respond. So what we offer is kind of solution for both. However, at least from the vision perspective or the narrative perspective, I see like the first problem of not about speed of response, but actually about making the response political and non-transparent, like an issue. And yeah, so like in this slide, we'll kind of give like a quick crash course on how risk managers roughly work. And by the way, we ourselves over a year operated as risk consultant for over 7 different platforms. So at the end of the day, we all have some quantitative metrics that are kind of objective, such as DEX liquidity, volatility of the asset, etc. And these are numbers which, in general, all risk managers see the same. Also, all DeFi users see the same. And we call this, kind of the objective risk of an asset, where surely, like the more DEX liquidity out there, the better, the less volatile the assets, less likely we will end up with bankruptcy. But then there's like more domain-specific knowledge, and this is like very subjective, both for risk managers, also for platforms, also for maybe like the community of the platform. And Luna and UST is like an obvious bad example of having like exactly the same maybe objective data, or I don't know, like liquidity and volatility as a USDC, for example. And to be honest, even there it wasn't really the same. There were like volatile periods there. And you can also argue, maybe the design is different, but still, so maybe USDT is even like a better example, because some people like USDT, some don't. I think it's maybe a lot about geography and use cases, etc., right? And you probably take a guess that, like in this forum, people maybe are not very bullish on USDT, but throughout the world, especially in Asia, people do like it and enjoy using it. And this part is very subjective, right? And we can argue, like for hours on USDT and how it works, but eventually, if it's non-transparent, so it's very hard, to kind of rate it, and eventually, someone need to take kind of a subjective decision. And what we observed, like during the years of doing risk management, is that eventually, when you give it as a service, people pay you both for the objective decision-making or building quantitative models around it, mathematical models, but they also very often at least want to get an advice, sometimes even a decision on the kind of subjective things. And also, even worse, they don't even know like where to put the separation between objective and subjective. And yeah, eventually, like as a risk manager, we kind of enjoy, like charging a lot, and it really helps us charge a lot. But like in many cases, our opinion is not more important than the community or the DAO, or like the users of the platform. And like USDT is a very good example where we cannot really say something very like smart about. So yeah, so the question, so we are in DeFi, we have humans, like right now, very good and smart humans making decisions, but they are still humans. We don't know who they advise to, what's their, like conflict of interest are. So of course, like, right, like in one of the earliest talk today, someone said like the recipe for solving, like crypto problems is, okay, let's have a consensus committee. So even more fundamental solution and preferable solution is, let's have a smart contract, right, which is even better than a committee or a DAO. And this smart contract will take some quantitative data, which is objective data, as an input from some feeds. And right now, these feeds is mostly what we work on. But then in general, it will take something like a confidence factor or risk level, which means, OK, how risky I want to be. And this is not really anymore like as a, so it could be by a risk manager, but can also be like by like a business decision or other, this is what the community wants, the DAO wants, maybe, even, like arguments like, OK, we are, partnered with them, etc. So right now, a lot of it is implicit, and users, if you're a lending market user, you have no idea about, like eventually what was like the excess risk that a platform took. But yeah, so like here, like very clearly, like in a smart contract, you put both of these, and then depending on the risk you're willing to take and the data, the smart contract will spit out loan-to-value ratio for the lending. So specifically, we are now live with a very specific formula. However, the concept could be and will be adjusted also to other formulas, where eventually, and this is a bit technical, but like eventually it very much depends on kind of the volatility of the asset, which is denoted here by sigma, how much liquidity is available, so we can dump on it, how much of the asset is offered for a loan, which is the borrow cap. And then we have, like this very subject. So all of this is somewhat, objective. And we can relatively easily come to a consensus on what are these numbers. And then eventually the confidence level or risk factor is very platform specific. Yeah. So this is a formula, and yeah, and now this is live and actually manage, or at least self-manage, a market of $30 million on top of Morpho on one of the vaults. And this is a bit technical slide, so I will dive into how exactly it is built. And also specifically, Morpho has a special setup that allows us to experiment with that without breaking too much stuff and without triggering loss of funds. But the setup in Morpho right now is that we, B protocol, together with Block Analytica, are kind of manually guarding everything, but like we also deploy an automatic system which works as follow. So we fetch data like in a very concrete way from dexes, and like from dexes we can aggregate both how much liquidity there is out there on the chain, but also we can fetch prices and specifically volatility. And recall that these are the only two numbers we need in order to make the decision. So we have relayers who fetch data from here. Because it's on-chain and because it's on block level, it's very easy to reach a consensus there. We don't need like any fancy median mechanism or something else. They put it on a database. Right now, the database, for simplicity, is GitHub. But of course, as it grows, it will have some sort of data availability solution. So now this data is available either on-chain, but even if off-chain, it is cryptographically signed by the relayers. And now we have a risk manager logic that actually goes to the smart contract, the smart LTV contract, and it feeds it with the public signed data. And then it gets, and specifically now, what it gets is, from this data, it gets the risk level that fits the current loan-to-value ratio in the platform. And now, specifically with Morpho, if the risk level is too high, then we just withdraw from that market. If it was a different setup, we could consider just maybe lowering the loan-to-value ratio and, of course, doing it gradually to prevent liquidations. Okay, so now we have, kind of a programmed risk management strategy where actually anyone can, fetch the data from the public database, enforce withdrawals if it kind of exceeds, like the risk level that we declared. And just to finalize, like the entire setup, this risk level is public not only on a forum post, but like more importantly, it is configured, either here or here, but like actually on chain, and we can convey to users in a very transparent manner. So yeah, so this is like the smart LTV setup, and again, right now live in Morpho, but can easily be adapted to basically any lending market. And yeah, with these slides I conclude, and if there are any questions, I'll be happy to take one.
Great, so thank you, Jan. Anyone, any questions? Time for maybe 2 questions. Okay, if not, thank you very much. Yeah, and yeah, we'll see you guys in 3 minutes, okay? Awesome. OK, thank you, everyone. Next up is our final talk for this section. So join me in welcoming Sam from Phoenix Labs, who is going to be talking about Spark and why composability matters. So give it up.
All right, test, test. OK, we're good. Hello, everybody. This talk is Spark, why composability matters. So let's get into it. First, who am I? I'm Sam McPherson. I'm co-founder and CEO of Phoenix Labs. I've been an Ethereum fan since 2017, DeFi user since 2018, Maker Core Dev from 2020 to 2023, and most recently a Spark contributor from 2023 onward. So let's start with a big question. Why are we here? Maybe it's for the gains. Maybe it's for the memes. Maybe it's just for the friends we make along the way. For me, at least, one of the main reasons that I'm here is to empower the individual. Now, you may ask, why does this matter? It matters because there's this ever-present tension between governments and individuals, where governments have this top-down authority, individuals are more of a bottom-up emergent thing as well. So this tension exists, and it's important because there's always this natural tendency for things to consolidate and centralize and move towards, the power naturally shifts towards governments on the one side. So it's important to supply individuals with as much tools as possible to make sure this power balance is always balanced. So some of the tools that governments use is fiat currencies. So fiat currencies allow governments to regressively tax unsophisticated actors via inflation. Another issue is with the banking system, where banks extract value from low information customers. Not everybody even has access to banks. This is the world's unbanked. So here's a little bit of an oversimplified version of the way things work. So governments, with the invention of fiat currencies, allow governments to run liabilities much, much higher than their assets, and they've used this to scale up. And while this is useful for scaling, it carries with it the problem of inflation. And normally this is kept at, they target like 2% inflation in modern times. But sometimes when the deficits are very large, you get issues with inflation like we're seeing now. And now we're in the next phase of this, where the monetary policy tools that the government has available are rate hikes. And so we see this take the place of, or take the form of rate hikes, and everybody's holding cash is great, like, oh, awesome, I'm getting all this extra yield on my cash. Then this is a tool to fight inflation. And so banks wrap this up. They hold T-bills as their assets, and then they expose this to people in the form of money market funds. And so you see the monopoly man on the top. He, as the sophisticated actor, is able to get protection from inflation by holding hard assets, or going into these money market funds. And the people who are holding cash, the unsophisticated actors, maybe people just don't have access, their purchasing power is eroded over time. But so we see examples of this in like Argentina and Turkey, but really this is the end state of all fiat currencies. It's just a matter of how long it takes. The temptation to print money is just too high by the governments in charge. And we just reached this end state where cash becomes more and more undesired by the population. Governments will eventually put in capital controls, force citizens to use the country currency to try and boost demand. Money market funds provide shielding for sophisticated actors and businesses. And really, the ones who lose the most out of all of this is the unbanked. And for example, in Argentina, about 50% of the population is unbanked. And so they have this extra taxation against them. And what this manifests as is it just facilitates this flight to safety via centralization. We see it within the countries. For example, in the US, when there was the banking crisis last year, you see all the money consolidating into these GSIP banks. This is the too big to fail banks. And then you see this even between countries as well, where everybody is piling into the US dollar. You see it like Latin America, like people prefer the US dollar because it's just this pile of cash where everybody's going into, and because everybody's going into it, it provides this extra degree of safety. So this isn't great. I mean, how do we fight back? And really, access is the key. It's not going to solve everything, but we want to subscribe everybody to the risk-free rate of the currency, so to mitigate some of these effects. Governments still increase rates. Inflation is still a problem. It doesn't solve all the things, but at least now you are no longer taxing poor people disproportionately. So now everybody has access to this currency that is receiving the base yield, as opposed to just US dollar cash, which gets eroded more rapidly. And DeFi democratizes access. We can see this last year, the emergence of T-bill products going from basically zero to now approaching $1 billion. And the growth has been accelerating with new players on the scene, such as BlackRock. You see the gray there more recently. This market has just been booming, and this is in the underlying thing that's driving this is people want access to this yield. They do not want to give it up to the issuer. So Savings DAI is kind of a little bit of a unique product here in that the DAI savings rate is actually above the TradFi risk-free rate. So currently it is 8%. Maker targets a 25% cash reserve right now. This is in liquid stablecoins such as USDC, such that it can maintain high liquidity, while still targeting this yield that is ideally going to be bigger than the US dollar risk-free rate, because it has access, Maker has access to the DeFi yield as well. So far, total deposits into the DSR are 2.1 billion, so it's a fairly big product. You may ask yourself, the past few years I think have taught crypto a valuable lesson in, there's yield, where's the yield coming from? It's very important to know this. The yield should be sustainable and being paid by actual people in a sustainable way. So, Savings DAI yield sources. First and foremost, the base yield is provided by short duration treasury bills. This really should be the yield that any US dollar stablecoin is providing by default. Users who are depositors into these instruments are taking most of the risk, and they should be rewarded for that risk. So SDAI provides this base yield by default. Now, if DeFi happens to be yielding more, and in bull markets it often does, we can shift some of the backing into DeFi lending. This is lending operations such as Maker Core Vaults, Sparkland. These are the kind of things that you're used to how Maker was founded, where you lock up your ETH or LSTs or whatever, and then you borrow DAI, you pay that stability fee, and that's the fee that's going to SDAI holders. So yeah, this is for DeFi native crypto lending. More recently, we see products coming on chain like Athena that allow access to the centralized exchange perp yield. So this is more generally, this is the cash and carry trade where you go long on, say, ETH, and then you short the perps, and it allows you to take out a delta neutral hedge position. Now, I mean, this is nothing new, but what is new is that Athena has tokenized this, such that it can be used quite easily as collateral in DeFi. So Maker has been able to tap into this. And the great thing about this is centralized exchanges. DeFi is still relatively small. Centralized exchanges are at least an order of magnitude bigger. So this is a huge amount of yield source that Maker can source here. And so let's look at the Maker collateral portfolio over the years. So this is since the inception of DAI in 2019 over here. You can see that the orange here, this is crypto leverage. So this is the backing of DAI that is filled by users who are taking out leverage, usually on ETH, but also Bitcoin. You can see around 2020, this is a Black Thursday event here, when DAI started trading above $1, and the peg stability module was onboarded right around here in order to bring the price of DAI back down to $1. And so this is really the only way to scale a stablecoin, is you do have to back it with centralized stablecoins. So it was added here, and then there's the bull market 2021, and the total aggregate DAI demand briefly touched 10 billion, but then came back down, and you see the demand for leverage just cratered. Right around here, Maker was receiving a lot of criticism for just being wrapped USDC, and it was not entirely unfounded, but I mean, this was never to be the end state of things. The plan is always to rotate this into T-bills. And so you see at the beginning of 2023, this is the green here, this is the T-bill, direct T-bill exposure of the balance sheet. So Maker rotated these stable coins into yield-bearing T-bills, which then it forwards the yield on to users via SDAI. And then more recently, you see, here's the bull market from the past few months. And then this little bit of blue here, this is the new market. This is Athena exposure here, where Maker gets exposure to the cash and carry trade. And even this small amount here is able to provide pretty massive returns. So let's talk about the power of composability. So first and foremost, you get ease of access. This is, if you want to go into savings DAI, it's as easy as using your favorite exchange, and you swap whatever asset you want, and then you just have access. Integrations is another huge benefit. So with these tokenized yield-bearing stablecoins, you can use them as collateral in lending markets or DEXs, and you just get this extra level of capital efficiency. And this leads to the third point, reducing opportunity costs for LPs. So in DEXs, if you are market making with USDC or USDT, there is this implied opportunity cost that you have to deal with, where you are not receiving the risk-free rate, you are forfeiting that to the issuer. And so to reduce the barriers here, SDAI, we want to forward this yield to the users to get improved capital efficiency within DeFi. So we can run over some use cases for SDAI. So this is the first use case that we got, which is that was somewhat big, and this is lending. So you can use SDAI as collateral to take out loans of ETH and Bitcoin. This is useful for hedging or shorting or whatever you want to do. And because you're using SDAI as collateral instead of, say, USDC, you get this nice DSR yield on top that you can rely on, which is great. So this has been onboarded into Sparkland as well as Aave, and it's proven to be a pretty popular product. Additionally, in DEXs, so due to the 25% cash reserve with USDC, you can treat SDAI pretty similarly to USDC. Maker holds these large cash reserves to ensure redeemability is available in most cases. And then you can use this for further pairing with stable coins or other assets or whatever. So, and then the market makers are able to receive this yield instead of, again, forfeiting it to the issuer. And then third use case, savings. This is the most common use case where you just want a yield on your cash. And so SDAI is a perfect place to park your funds there. And whenever you need to pay somebody, or exit into fiat, you can swap out to USDC whenever you need. So here's a chart of SDAI usage since it was was launched at the beginning of 2023, but it became popular around August of 2023. So we see the vast majority of the use case, the gray and even the green. These are EOA wallets, and then Treasury is the green. So these are people using it as a savings product. And it's perfect for like businesses or individuals who are just holding cash and they want this. They do not want to forego this extra yield. You can see the purple at the top. This is the lending usage. So this is SDAI as collateral. So there's been some nice usage there. And then more recently, you have DEX, the blue sort of to the top right here. This has been kind of growing steadily. This is usage of SDAI as pairs in DEXs. And so at Phoenix Labs, one of the products that we've just released is called Cash and Savings. And the goal of this is to make it easy to get in and out of SDAI, dealing with things like the ERC 4626, the fact that the units are not rebasing, kind of a pain for users. You don't think like this. So we are extracting this away such that you can swap your idle cash into savings DAI, and then when you want to exit, you can exit at size. And so I'm announcing now, a few days ago, we just released this product. It's on mainnet. We released it on Gnosis chain as well. So you can get in and out of sexy DAI, which is awesome. So here you have an example of the withdrawal page. And so you can keep your money in SDAI, earning that yield. And then the minute you need to pay somebody, you need to pay a provider or whatever, you need to pay them some specific amount. You can exit 10,000, and then it does all the calculations for you and facilitates the swaps through Maker core infrastructure. And due to the PSM and the liquidity, Maker offers one-to-one swaps with USDC at the scale of hundreds of millions of dollars. So if you need to exit with 100 million, like right now, you can do it. So where is this all going? We want SDAI, and then the rebranded version when that's out, to be the savings account of DeFi. And so the next steps we're going to be taking is ensuring that you have access at scale to the DSR through SDAI, on all of these chains. So users can feel confident that when they have cash on these chains in USDC, they can swap it into SDI, get that yield, and whenever they're ready to pay providers or exit or whatever else, the liquidity is there, and Maker will ensure that one-to-one swap is there. Other integration we're looking at, we're very, very excited about things such as Gnosis Pay, these non-custodial Visa cards, where people can pay for things. So you hold your idle cash in SDI, and then right when at the point of you make a purchase, you can then move it out into the Gnosis Pay Visa system. So this is very exciting development. So really, we want people to think about Spark as your self-sovereign digital bank. You can hold your cash in SDI, you make purchases with Gnosis Pay, and you take loans with SparkLend. And so you may ask yourself, we're starting to reach a point where, do you really even still need a bank? And this is exactly where we want to go. So thank you.
Great. We have time for some questions. So any takers from the audience? OK. If not, yeah, thank you very much, Sam. That was great. And for everyone, we'll see you back here at 4:25, so roughly 30 minutes from now. Enjoy your break, and yeah, see you in a bit.
We'll talk about the future of decentralized lending, and we'll be joined by 4 speakers. Dave Montali from Karpathy will be moderating the discussion, and he will be joined by Sam McPherson from Phoenix Labs, Paul Frambeau from Morpho, and Emilio Frangella from Avora. Please welcome guests.
Awesome.
We're supposed to go in the order.
Cool. Hello, everyone. How's Berlin going?
Excellent.
Very nice. Thank you, guys, for having us. Absolutely. I hope, Emilio, you're fine among 2 merit diluters. Yes, absolutely. I thought we could start off. Maybe you guys can give an overview as a user. Of course, you guys are all 3 lending protocols. Are you guys like targeting the same users? And maybe you guys can like highlight what the main differences are of what your protocol might appeal to different users?
Yeah, sure, I can start with this. So I would say actually we're a little bit unique in this, in that we're not so much a specific lending protocol, but as under Spark, it's more of a liquidity provisioning for Maker and DAI. So in that sense, we can use multiple markets. So we have, well, we've even lended in the past to Aave v2, Compound, and now more recently Sparklend, which is the Aave v3 fork, and now we've lended to Morpho as well. So that's a little bit of a difference between us, I think.
Yeah, I mean, pretty much Aave v3 and the Aave protocol has been like one of the, it is currently the largest protocol by TVL. So users that use Aave, usually they look for leveraging options to leverage their own collateral or to earn yield in a very simple fashion, where users can just supply liquidity, whether it's USDC, USDT, DAI, ETH. The latest protocol iteration has a lot of features that allow even long-tail assets to be supplied safely and to be used as collateral in a safe way. And yeah, it's been a great journey, 5 years of grinding and innovation, and we recently announced V4. So yeah, like we keep moving forward. Awesome. I think Morpho is a bit different design by principle, right?
Yes, exactly. So maybe it's worth mentioning that we have 2 protocols. So initially, we were actually built on top of Aave and Compound, so some kind of optimization layer on top of Compound and Aave, providing like better interest rates with like similar guarantees and similar users. With Morpho Blue, which is the latest protocol, is very different approach where the risk management is externalized from the protocol. So the Morpho Blue protocol is very primitive. And so therefore, and it's also permissionless, so anyone can create the pools they want, etc. So it addresses a user base that's much more advanced in the sense that they have to know how to do risk management, right? And so in practice, it means risk managers, like, directly using the protocol, or DAOs that are, like Spark, like building like lending products on top, right? And so as you move into the abstraction layers on top, then we target like similar users to Aave, where, obviously you have the lenders, okay, excess of capital, want to generate interest, and borrowers, okay, want to leverage on some collateral that you have. I'd say main difference that we are probably able to like target a broader set of assets, but we're obviously much smaller than Aave v3, so we can, we kind of like larger users tend to prefer like Aave v3, which has like larger liquidity at the moment.
Makes sense, yeah. I think the risk management is probably one of the big differentiators. I think, Paul, you previously said that Aave is a financial product and broker, while Morpho is more of an immutable financial infrastructure. Do you mean this because of the active risk management, or is that like one of the components of it?
Right, so like we have this mental model of like distinguishing protocols where, platforms where the risk management is enshrined inside the platform, in which case, you have the DAO essentially taking risk decisions to connect liquidity and to set risk parameters, quite actively, so users don't have to. And this is what makes, Aave or Sparklend, very good products. Like users don't have to really think. they deposit their money and they're fairly protected in a decentralized way, by the way. So like, and while the Morpho approach pushes this complexity back to the user, which has some upsides and some downsides. Downside being, okay, they have to be active and they have to be knowledgeable. And obviously the upside is that we can target more use cases. It can become like immutable and permissionless. And then on top, you have those decentralized brokers that can be rebuilt on top, right? So like reaggregating liquidity and doing risk management, etc.
Makes sense. Do you guys agree with the?
No, I disagree with that view. I don't think that Aave or the Aave DAO act as a broker or as decentralized fund. I think his main point regarding this topic was risk management and upgradability of the contracts. So it is true that the Aave DAO manages the upgradability of the contracts. The upgradability of the contracts is not used to manage the funds, of course, although there is the potential for the DAO to do that, but there is nobody in Aave actually managing funds or moving funds around or deciding, like if we go to the actual meaning of a broker in real life, a broker is someone who does reinvest eventually capital or applies investment strategies to capital that someone else supplies, which is not what happens in Aave, because everything is algorithmic and pre-programmed, so the rules are on chain. Rules can change, of course, through governance eventually, but the upgradability of the contracts is not really used for that purpose. One of the things I want to clarify is that the current deployment of Aave, the biggest deployments of the Aave market, the protocol doesn't necessarily need to be deployed that way. The way that currently is functioning is one of the ways that the DAO, through trial and error and through years of experience, found that works at the moment and scales. But it's not necessarily the only way. The protocol is quite flexible, so if an immutable instance of the market for certain needs is required to cover certain needs that the main market cannot cover, it's perfectly possible to do that. So I don't think that Aave acts as a fund or a decentralized broker. And I do believe that at least the immutability will be targeted pretty soon, because we all believe as well that the ultimate goal of a decentralized protocol should be immutable. That's the ultimate target for a decentralized protocol. And also with V4, there will be a completely different approach to risk management, which will further reduce the need for the governance to intervene while keeping the same trust assumptions. So, yeah.
I'm going to disagree with that. So I think Aave and Spark as well are absolutely the risk managers of the funds that are deposited into the protocols. So we are managing where the cash balance is going. It can be more indirect in the sense that you're onboarding a collateral and then users are taking leverage. But fundamentally, the backing of something like AUSDC or AUSDT or DAI is decided by which collaterals you're onboarding. And in the sort of extreme, and it's really just the amount of leverage you offer. So as you go to infinite leverage, you approximate something that looks more like the protocol directly investing into something, but it's really sort of more of a gray area of where you go. So if you're at like 99% LTV, you're effectively allocating funds into something, and the backing of the deposit token is the decision of the DAO has been made to go into this asset, that is backing the deposit token. So in that sense,
the users, like if a user doesn't like an asset that is listed on Aave, they can easily withdraw and go somewhere else. So
for sure, but you are opting into the Aave DAO doing risk management. Would you agree with that?
Yeah, I do agree, but I don't consider that a brokering strategy.
Whatever I don't care about the terminology, but yes, you're doing risk management on behalf of the users.
Okay.
And same with Spark and Maker.
Yeah, but that's undeniable. I don't think that accounts for brokerage. That's my point.
Okay, whatever the term broker means, I don't really care.
The term can be discussed, but we can agree that, even though, the Aave view, for instance, could become immutable if we remove the upgradable proxy, and the logic becomes immutable. What's most important here is like the parameterization of the risk, and this can be managed by the DAO, which we all agree.
And in Morpho, it's all isolated, the lending positions, right?
Right. So on Morpho, like the core market has like a specific risk, right? And then it's an opt-in for people managing risk on top of Morpho to decide to allocate a portion of their funds or their capital, into this specific market, exposing users to this specific very primitive risk. So it's much more primitive than the risk you get exposed to, like on a compound or a NAV. It's like one collateral, one rate, and one oracle, for example. And gives you much more flexibility, and maybe we can talk about what we've been doing with Spark and how they've been exposing DAI to SUSDE in a fairly senior tranche way.
Yeah, for sure. I mean, I think USDE has been a big topic over the last few months.
Maybe I can get into that, like why we chose Morpho for this specifically.
Yeah, absolutely.
Because I think it highlights some of the limitations of Aave v3 and really just the compound design where everything is pooled together. So originally when we were wanting to onboard Athena as collateral because of the risk-adjusted yield is just a very good opportunity right now due to the bull market kicking off. So we were looking, the default was of course to use Sparkland, right? We want to use that, it's available, it works really well, high quality code, so we were going to use that by default. There's kind of two main problems with the limitations, and one is that the borrow rate. If we were to onboard this collateral, either you allow users to borrow at the, roughly the DAI savings rate a little bit above. It's the same rate that we would offer to, say, users who are using ETH, right? So ETH is like borrowers are taking leverage on ETH. They get this, 8-9% rate. But if we were to offer the same rate to people who are taking USDE leverage, it would be seeding way too much money it's like too good of an opportunity for the person who's taking leverage. So Maker wants to capture most of this value because Maker is the one LPing into this. So with Morpho, you're able to, the markets are isolated. So we can offer a borrow rate that, sometimes they're like 30% because of the high yields. Maker captures way more of this value, and then it wouldn't crowd out the existing borrowers on Sparkland who are enjoying, this more 8-9% rate if they're borrowing with a high quality collateral such as ETH. So this allows us to capture more value into the protocol, and then it segments the risk. And so as Maker, it's a little bit different as like a regular LP, where you have this opportunity cost with idle capital. So you have to pick this market and be like, okay, I think there's going to be demand here, so I'll put my USDC in here. With Maker, Maker can just mint DAI into these markets, and they're available on demand. So there's no opportunity cost for holding DAI. So it's really not a problem for us to support every lending market because Maker does not pay a cost to that, and we're able to meet the users where they are. So in this particular case, it turned out that Morpho Blue was a much better market to facilitate what we needed.
I pretty much agree in the sense that for this particular use case where there is unique individual single entity liquidity provider, like in this case Maker, you have the capability in Morpho at the moment to segregate capital better than what you can do in Aave v3. It's of course going to get addressed with Aave v4. We have a wide series of features that will allow to do pretty much what was done with Morpho Blue using Sparkland vaults with v4, while maintaining, avoiding segregating liquidity. I just want to say something regarding risk management. It was mentioned before, because it is true that the Aave DAO is doing a risk management on behalf of users, but and it is true that Morpho Blue pools have immutable risk parameters, which might be debatable if it's on the long term, if it's a great choice or not. What I want to highlight is that there is still risk management, whether the parameters are immutable or not, because what's going to happen, for example, we have been seeing with the Gauntlet Vault on Renzo ETH, that if a market is deemed too risky by vault managers, which is the primary way liquidity is applied to Morpho Blue, what happens is that a risk manager will probably pull the liquidity out of the pools that are riskier which means that the borrowers that are borrowing from those markets will be subjected to higher and higher and higher rates until the outcome is either they rebalance to a less risky pool or they get liquidated. So the outcome for the borrowers and the users is basically the same, with the aggravating circumstance that you are actually gonna get paid more in terms of, get charged more in terms of borrow rates. So the outcome, I would say, whether it's the DAO managing the risk parameters or risk providers built on top manage risk parameters is pretty much the same, but there are trade-offs on both solutions, in my opinion.
On this poll, I know Morpho is like positioning itself as like a risk management marketplace. With the Renzo liquidation that happened that Emilio just mentioned, do you think like users acknowledge this differentiation between protocol and risk management platform?
Right, so obviously, like it's very hard like to get the message out that, protocols are fairly different in the way they're structured. But I think, it's starting together. Like people understand that on Morpho Blue, the protocol is permissionless. And I think in the day we deployed Morpho Blue, like really few hours after, we had the first scam markets created. Like, someone was already, like on Uniswap, you get like many scams, every day like created. And so obviously, it's really a different paradigm in the sense that we don't, as a DAO, we don't guarantee anything to the user in terms of, the risk they're taking on the specific pair, because a pair could be anything, really. And so lenders, some lenders, they are fine with that, and they, do their own risk management. Most users, usually they want to delegate that responsibility, right? So they usually, use the second layer of Morpho, which is called Metamorpho, which is used for many different things, including doing risk management, reaggregating liquidity, arbitraging rates, et cetera, et cetera. And so as a lender, you would go through this layer if you want to be passive, right? As a borrower, you're still using the primitive as of now, right? So like the raw primitive. So you have to make your choice between the different set of assets. And obviously some assets are here, and you're taking significantly more risk using the Easy ETH USDC pair than if you were like borrowing USDC with BTC on Aave v3. But Aave v3 does not list Easy ETH because it's more risky. But some users do want to use this, right? And then they acknowledge the risk and go for it still. So yeah, and I think that's just like simply part of the design, essentially.
Makes sense, yeah. And then just coming back to USDE, I know Aave was also very critical of like the large exposure Maker was kind of getting with the Morpho allocation. I think it's at 350 million now DAI, potentially going up to 600 million. Yeah. I think like Aave is now also onboarding USDE, right? There's a snapshot passing. Do you see that like differently, or is it like smaller amount, or?
I think like most of the concerns, at least on my part, there were many voices when this started. The main concern, at least on my part, was neither that they were using Morpho, or the main concern for me was that Athena is a quite new design. It's untested. It's been growing massively on the initial bull phase on this market. It's, in my opinion, a protocol that works much better in a bull phase than in a prolonged bear phase. And my main concern was if I just didn't want to see the space exposed to strong systemic risk, which, in my opinion, at the moment seems quite conservative. So I don't particularly have strong concerns around it. And I think there was no, it was pretty much public information, was on the forum that Aave was going on board USDE at some point. Yeah. And this is just a natural evolution of this proposal that was created a few months ago. I think like already some time passed as well. They kind of sustained already the first strong market movement downward with relative ease. So I do think that if we are careful enough, like this thing can scale further.
Makes sense. And were the DAI parameters adjusted on Aave? I know there was a lot of discussion around that.
I think just the LTV, but slightly.
Okay.
Yeah.
Makes sense.
Yeah, so for Athena, I mean, maybe from the outside it looks like we're just YOLOing money into stuff, but like that's not at all what happens. Like there is like deep risk analysis of the entire structure that was done for many weeks in advance, and then there was a controlled ramp up. So like some people were throwing out the number, 1 billion or whatever, but as you said, the exposure, it's been 2 months and the exposure is 350 million, which has been ratcheted up as we see things are proceeding well. So and the other thing to keep in mind is like this is not direct investment by Maker. These vaults are over collateralized, and so when you do this risk analysis, sometimes it can be like counterintuitive, but really you just kind of have to dig into the numbers, figure out what are the likely scenarios where there could be insolvency, and just set the parameters accordingly. So yeah, it's been fine so far. It is definitely a product that's going to thrive in a bull market, but there's the analysis is done, and like even when there is a switch to the bear, these positions can just unwind. At most, you're dealing with slippage, getting in and out of these perps products, but we're not talking about catastrophic losses in like an extreme scenario. We're talking about a couple percentage points of potential losses in extreme scenarios, and this is precisely why the Athena team has built their own internal insurance buffer. There are many, many, many layers of protection protecting DAI holders, and this is the advantage of being in the DSR. You get Athena's insurance, you get the over-collateralized vaults, you get the Maker surplus buffer, which is 50 million DAI, plus 160 million in protocol-controlled value that is in this Uniswap pool. This is all protecting DAI holders such that they get the best risk-adjusted yield in DeFi at scale.
Makes sense. I guess Morpho's quite happy with these as well. I think it's like 60% of borrowed assets come from this Spark Vault, right, on Morpho Blue at the moment?
Right, so happy, so one thing to clarify is like we're different than having the structure, but also in the revenue model and how we think about revenue generation. So currently we're not generating any fees on any of the protocol that is created. So we just have like a fee switch that is turned off. So yes, we're happy to have like activity and volume on Morpho, but we don't have any financial interest like directly related to this. And it's fair to say that so Morpho Blue is actually quite recent. It's like 4 or 5 months old, and that does represent like a large proportion today of like the activity there. But all the other use cases are growing quite rapidly as well. So yeah.
I have a question for him. Can I?
Sure.
Like, how do you plan? Like at the moment, the returns on this market are quite small related to the risk. So these protocols usually manage relatively high capital. The return is not particularly high for entities that created it or manage it. So at the moment, most of the return is captured by risk providers on Morpho, as far as I can tell. So how do you see, given the small margins, how do you plan to make this competitive, like given that you already have part of the returns going to risk providers?
Yeah, it's a good question. So I guess the main thing here, the fee switch in Morpho is tied to the license, right? So what happens, so the current code of Morpho Blue is a BUSL license, but as soon as we turn on the fee switch, it turns open source, right? So it means that as an infrastructure, like if we start generating some fees, but we don't create value, then people will just fork the protocol, and just change and move to another instance just because they're not happy with it, right? And so how do we create value is the question. Well, I think as many protocols, in general, we create value by bringing together lenders with borrowers in a common place, right? And so essentially, you come to Aave v3 and not an Aave v3 like another instance of Aave v3 for the state of the smart contract. So liquidity that's in there. And it's the same thing for Morpho Blue. So on Aave, you get the state, but also the risk management. In Morpho Blue, you get the liquidity and the risk management. So state and those two are, in our opinion, two different fee revenues, right? So risk managers get paid for their risk management, and the infrastructure gets paid for the network effects, like liquidity that comes here. And because you have like network effects, you're able to charge like a revenue. And I agree, it's fairly small, right? And it only works at scale. And it's very similar to the Uniswap approach, where frankly, if this Uniswap starts activating fees and the license has turned open source, well, people will start building forks. And if you look at the Gauntlet study that was done on the Uniswap v3 fee switch, if I'm not mistaken, well, they actually priced this, like the value of the network effect And so same thing for like Morpho, essentially. Like
Yeah, no, I just see like with thin returns having like the risk managers embedded into their flow of revenue, because like you mentioned Uniswap, like Aave and Morpho are already similar in the sense that we have liquidity providers which receive fees in case borrow interest, and there is a small part that goes to the DAO, for example, in the Aave case. And in that case, there will be DAO risk managers and users. So there is another entity in the middle. That was my question. But
so I'm not sure to get this. So on Morpho, you get the DAO fee and the risk manager fee, which, by the way, is optional if you know how to do risk management, yes. Right? I'm not sure to get how this is different from Aave. Like Aave has to pay for like DAO operations as well as for risk managers, and then maintenance for upgrades and everything, which by the way we don't have.
Yeah, the difference is that we decide how much like the risk managers get.
Yes, and so I would say so in the case of Aave, the DAO decides. In the case of Morpho, there is like an open market, right? So like risk managers can compete with one another. It's not a one size fits all model where you essentially, if there is like huge network effect in the instance, the DAO will be able to charge fees, and risk managers are pressurized, essentially in the sense that there is an exclusive contract, they need to get it, and they're put into competition for this. While on Morpho, risk managers are directly aligned with users, and essentially they charge according to the volume that they get and according to what the free competition is doing. So obviously that should compress fees down. It's already the case. Like if you look at the fees on Morpho, they're really, really tiny for risk managers. So yeah.
Cool. Sam, one thing I wanted to ask, last year everyone was launching a stable coin and carry trading SDAI if the interest rate was low. Do you think we'll see this trend continuing? And I know Maker is also doing some changes with DAI. There's some new stables coming. It's just a rebrand of DAI. Maybe you can give some insight into that.
You mean for like borrowing DAI, the carry trade into like higher yielding opportunities?
Yeah.
Yeah, absolutely. So like, I mean, these people, they post collateral. This is a great use case for like Sparkland and Maker Core Vaults. And like people can post collateral, and if there's opportunities elsewhere in the market, they can borrow DAI and then, take that rate arbitrage. So yeah, that's like been a big use case of Maker for a while. So yeah, I think it definitely will continue.
Yeah. I think one of the stable coins launched last year was Go, right? Which struggled a bit at the beginning, now is back at peg. I think the Aave DAO started investing a lot heavily into Go. Curious to see, it's been a lot of effort and investment going into it, a lot of emissions. What's like kind of the vision? I saw Go is also like a big component of Aave v4. It's like much more integrated. Can you give us like an overview of like the vision of Go in the future and how it's being built out?
I mean, it's my personal vision, not necessarily the vision of the whole DAO. Personally, I think that Go can be a pretty strong component of the DAO in years to come. Some of the features of V4 are like to more tightly integrate Go with the protocol, because I personally believe that by doing so, we can provide benefit to the users. So for example, receiving interest in Go, when Go is strongly at peg like it is right now, can, for example, the DAO can benefit from having Go injected into the market in different ways. So by doing that, you can provide benefits to the users that are actually supplying stablecoins by, for example, charging less from a revenue standpoint. So there are some benefits regarding some stuff that we can do that we could not do before Go, like, for example, soft liquidations, which is a mechanism that was introduced by CRV USD, something that some people think that should be built on top, which is possible, of course. Aave actually already has, through integrators like DeFi Saver, there are some automatic repayment features or automatic collateral exchange features whenever the market is going down, for example. And they work great. But we did some analysis on CRV USD, and the fact that it's integrated at a lower level into the protocol makes it possible. Sometimes users even profit from the application of soft liquidation to the protocol. So this is something that without a stablecoin you couldn't do it basically, because stablecoin is generated on the fly whenever such a transaction happens. So there are quite a few benefits of having a stablecoin for a protocol like Aave, and I do personally think that it should be a strong driver moving forward.
Cool. And Paul, will we see a Morpho stablecoin coming soon, or?
No, it's not. It's not. At least it's not something we're considering right now. I think, to be frank, like the way we're approaching like DeFi lending is, I think everybody guesses like fairly different approaches, and I think the Aave approach is actually very close to what you, in terms of like engineering and operations behind the scenes, is very similar to what you need in order to get, the decentralized management of a stablecoin, right? So it's very natural for me that Aave came to like do, the GHO stablecoin, but that's. Like again, we position ourselves like like the base primitive lending market, so would make much less sense in our position. Even though, like, again, it's quite a lucrative activity.
Give them 5 years of development, and they will come.
I want to comment on the stablecoin thing a little bit. So, like, I think there's this, like, magical, thinking that, like, stablecoins are these magical things that just can yield all kinds of return. And that's really not the case. Like, really, a stablecoin is fundamentally a tokenized deposit into some lending apparatus. And so whoever's dealing with that, that's details. But it's like a tokenized bank deposit, but on chain. That's essentially what a stablecoin is. And the vast majority of stablecoins are actually not revenue generating. They actually cost more than they end up providing. Because you have all this like cost with bootstrapping demand, keeping it at peg, that costs money. And so most of the time, these protocols are using incentives to maintain the peg and boost the supply at the same time. This takes the form of token rewards on like a Curve or wherever else, right, where they can boost the demand that way. And like this is even true for DAI. So DAI actually emerged in this kind of nice period where it got this bootstrapped demand right off the bat, and it's sort of been coasting a little bit off of that. But since then, the competition is just extremely fierce. So Tether is completely dominating this space, and they can continue to consolidate their lead. And so even like Circle and DAI as the next largest are struggling to maintain this thing. The natural tendency is things to just centralize and consolidate. So the value prop that the stablecoins need to offer is offering more and more yield to the users. This is the only way you can really fight demand in sort of a sustained way, and finding more integrations and stuff like that. So it's really like it's an uphill battle, and like even if you're well established, like it's really tough. Yeah, so it's an interesting part of the space. Yeah.
Cool.
I don't think it's. I agree with him on the fact that like it's really hard to grow and maintain a stable coin. I think that's pretty much true for everything. So like even Aave at the beginning, to get the position where Aave is in at the moment, like there was a lot of work around doing that, incentives, of which DAI also benefited at the beginning. Like in my opinion, DAI as a decentralized stablecoin has huge big mover advantage, because like they managed to benefit from incentives from basically all the protocols that launched during DeFi summer in 2021, and that's big in the sense that that's a great driver, and replicating that is really hard. But I do think that that's the reality with almost everything. So like at the beginning, you need to invest to actually be able to grow. So I do agree that it's more costly actually, but I see it more as a future investment rather than expenses.
Makes sense. And one question I wanted to ask before we finish is something I'm not quite sure of, Sam. You guys forked Aave v3 when it was MIT, but you guys have an arrangement with Aave DAO where you guys pay them something, but the arrangement changed because you guys were not happy with the arrangement. Or like, there's something going on, and like, can you guys give some clarity on what the arrangement is or what's going on?
Yeah, for sure. I mean, so that original deal was crafted in February, and at that time we were kind of just moving fast and getting stuff done. So we put some stuff down, in the arrangement that we thought kind of made sense at the time, but things move fast in DeFi, and so the arrangement was adjusted after the fact that it wasn't yielding money right away, and we felt that wasn't quite fair. So we adjusted the arrangement to be actually paying Aave DAO for the 2-year period that it runs. And right now, it's on track roughly to be covering about 15% of the cost to build Aave v3, which was, I believe, 10 million that was paid for that. So yeah, about 1.5 million. And it's open source code. I'm a firm believer that people should be free. We release all our code open source. Anybody can use it, compete with us, whatever. So this was an added bonus on top of it. We felt that was warranted.
Any thoughts?
Well, I mean, on my side, I know that I was one of the main critics of the whole thing. I personally, at the moment, I'm fine with it. Spark is also given a different path compared to a few months ago, where they are really strongly focusing on growing DAI mostly. So at the moment, I don't see a direct competition between Aave and
We'll even
Spark.
allocate to Aave.
Yeah. So at the beginning, I was a bit annoyed of the whole thing personally. Again, that's a fully personal opinion. I didn't like the way the thing was handled on the governance side. In my opinion, it was not clear what was going to happen. And we have been working with these guys for a long time, since 2017, 2018. We were building DeFi, and DAI was not available yet. That's when we started working. So that annoyed me, but things pass, water goes under the bridge, and things evolve. So yeah.
So what license will Aave v4 be under?
Well, 5 years BSL, that's the minimum.
5 years.
No, just kidding. I don't know. The governance will decide.
Cool. I think we have some time for audience questions, or we have more time for questions? I have one more question. One audience question is okay.
Not too many.
Not too many? Yeah. There's one there.
Hi. So in terms of different positions related to immutability of the configuration like it exists in Morpho, and some part of management which could happen in different protocols, I'm wondering how you're going to solve the case when, for example, users could be locked if the market conditions would be changed pretty fast. Because basically it's all the game if you want to explain all possible cases to users. Your explanation could be a little bit longer than in terms of use of Apple. And I want to ask, who read all terms of use in Apple device or iPhone? I think nobody here, because it's like a 50-page of low legal text. And if you start to talking more about things that in case if the risk curator set up the interest rate not correctly and the market change, your funds could be locked for a few years. So, and in this case, people could come and ask, I do not underestimate that it's possible. So how to really break this user perception that people could be able to lose their money for a long period in terms of deadlock, or do not ask them to read a 40-page terms of things like it happens in Web 2?
Right, so I just want to make sure I get the question right. So you're asking, in the event where you break the risk profile into immutable micro-primitives, in the event of one primitive going wrong, and lenders decide to withdraw, and so what was the then the question is, what happens with this given market, or just want to make sure I get this correct.
It's not a market. It's like so basically when people come to DeFi or blockchain, they should be at least tech savvy, because it's really not the best experience like you register by mail which was confusing when it started for many years. People couldn't understand how to do that. In DeFi, you should have ledger, maybe safe for security, then you should understand how it works. And then there are use cases which you do not expect. Yeah? So if you want to build a protocol which could be understandable for average user, you should really explain all possible risks. For example, if this price will going down or up, and people are not willing to take their money back and close their leverage position, we can do nothing regarding to immutability of our settings. So you should be ready to forget for your funds about for 50 years, and when you will be an old fellow, you can get an access, luckily, to them. Yeah, so it's a case which possible. I do not tell it that it could be here, but me as a user, if I'm not a very deep in lending, I should have a clear picture how it works before making a decision to provide my money to some particular DeFi primitive. And because it's immutable, it's create like a deadlock for a long period of time thing. So how you're going to explain for end users, or this immutable pools for only tech-savvy profits, like maybe 10 in this hall?
Yeah, so first, like, I completely agree that at the primitive level, if you're lending, you have to fully understand what's the full risk of like a given, primitive, right? And by the way, Morpho's frontend, like Morpho Blue's frontend, that we host as like the Morpho Association, does not give you access to the lending market directly for these specific reasons, right? Because you could have like one market with one specific issue, and it's fairly complex, especially on the lender side, less on the bar side, but the lender side is very hard, right? And so you have risk managers that are doing the job of both aggregating liquidity in case of like, if there is one market specifically that gets into a deadlock, as you described, then you have like, 10 different other markets that you get liquidity from. And then the rate of the other market will spike, eventually triggering deleverage. I don't know if that's going to take like 40 years, given like, I don't know if you studied like the specific interest rate model curve that we have, so it should be much like, shorter than that. But yeah, and the other thing is that the primitive in itself does not specify that oracles, for example, are immutable. Oracles can change, for example, like Chainlink in itself, changes the way they price things. Not always, but it depends. And you could also have like upgradable instance of the oracle specifically in that case. I don't know if that kind of answers the question.
Can I add something?
Yeah, of course. Go.
No, I just want to say that, it's a hard problem. This we have seen it happen. It happened on Aave. It happened on at some point there was huge market demand, and like someone borrowed up the whole liquidity, or there was I don't know, for example, I remember the CRV thing, in which at some point people were thinking something would happen, so they start panicking. In reality, nothing happened. In general, I think that we should approach decentralized finance. It's like self-custody, right? Mm-hmm. Self-custody, if you mess up and you sign a transaction or a message that can drain your whole wallet, you have nobody to complain to. And this is the pros and the cons of permissionless networks and permissionless finance. This can happen in traditional finance as well. You can buy a bond, and the bank disappears tomorrow, and your money is gone, and maybe you get something from the bankruptcy procedures in 20 years. So it's exactly the same thing. So I do think that we should do better, like trying to improve, like in terms of for people that are not tech, like what are the potential risks. It's not easy, I would say, to do so, because like there is a whole bunch of technology behind it, and I think like things will improve also over time, but I don't think it's a problem that we are going to 100% solve, because it's a financial problem that happens also in traditional finance. It's not specifically specific of decentralized finance.
Yeah. Awesome. I think that's us.
Yeah.
Thank you.
Thanks, everyone.
All right. So that concludes this panel. And right now, in a moment, will we have a break? OK. So please welcome in a moment again Paul Frambeau from Morpho, who will speak about aggregated lending markets going beyond modular versus monolithic.
Do I have a clicker or like something to go through the slides, or? Thanks. Awesome. Okay, I hope you enjoyed the panel. So today I'm going to talk about the Morpho approach more specifically, and how we explore the trade-off between monolithic and modular, and the solution we've thought of while building Morpho Blue, and the vision behind it. So maybe very quickly about Morpho, for those who don't know about it. So we're a lending and borrowing protocol. We started 2 years ago with an optimization layer built on top of Aave and Compound. And then we were like probably one of the biggest users there of Aave and Compound. And we decided to build our own lending and borrowing protocol because of we were missing some features or some resilience that we were expecting as builders on top of lending and borrowing protocols. And so we ended up building what we call now Morpho Blue, which is a completely immutable and permissionless protocol, lending primitive. You can think of it more as Uniswap for lending. And this talk is going to be about the monolithic versus modular approach in lending. So there is especially recently, a lot of debates around how do you design a lending and borrowing protocol. Should you make it, a monolith or multiple pieces that sort of compose with one another? And the first approach is the monolith approach. So essentially, that's the Aave and Compound model. So first introduced by Compound, and then Aave iterated on it a lot and improved it up to the V4 version that was introduced very recently. And really, what's great about this approach is that it gives you a very nice financial product, right? It's super easy to use. You have very deep liquidity because all assets are put together in a single pool of liquidity. I think you have protocols like Instadapp that call it the unified liquidity layer. I think Aave V4 has a similar term. And by treating all assets in this common pot, you have deep liquidity. So large borrowers can come in at any time and borrow large amounts of money. Large lenders, they can withdraw at any time large amounts of money. And also it gives great stability in interest rates as well. And so it's really about having this full stack experience where you put all the features and all the management, and you sort of hide this away from the user. And so the drawbacks of this approach is that it's really a one-size-fits-all approach, right? When you deposit some USDC on a given instance, you get exposure to all the different collateral backing at the same time. And oftentimes, because you have a lot of features and you have to have the logic of the code that put all those assets together, it means a lot of lines of code, and upgradable patterns are needed, and that often turns into incidents. Because due to upgrades, or just because the code is extremely large and insanely complex. I do encourage people to look into the number of incidents and reports that you have on Immunify and lending protocols, whether at the pool level or at protocols built on top of lending pools. Because lending pools upgrade, they're changing specific lines of code that could impact integrations that are built on top, right? And the last thing is really the fact that those instances, and this is what we discussed during the panel, are governed, right? So they're governed by token orders. So we mentioned the upgradability pattern, but also the risk management part. And really the idea is that token orders are going to decide on hundreds, literally hundreds of risk parameters that are fairly complex to understand, to be frank. You have, for example, what's the Oracle pricing a given market, or what's the collateralization ratio that you allow on a specific asset up to what cap. Each for those parameters for each asset You have maybe 10, 20 different assets in each pool. Then you have multiple pools on different chains. So that's a lot of parameters. They're all interdependent with one another, with the market conditions and with the parameters of other lending protocols. And we're assuming that token holders are both knowledgeable and active enough in order to make those decisions. And in practice, of course, they're not, right? Like, anyone can buy a token. You don't have a PhD in risk management, right? And you don't have to be super active. So obviously, you're going to delegate this responsibility to a consultant, right? To a risk manager that's going to, essentially do the hard work for you, right? But the problem with this approach is that it's some kind of, exclusive contract behind, the funds of like the lending pool. And the risk manager that essentially gets paid, as a consultant in order to perform those risk management, right? And also there is low incentive for open sourcing. Like when you have like some risk management tooling that you're operating as a consultant, well, if you open source your models and if you open source the code you use to set those risk parameters in Aave or in Compound, well, then you have very little pricing power when it comes to negotiating terms for your contracts, right? So you have really incentives in making this open. So the TLDR is like right now, most of the computation in lending pools of risk parameters are oftentimes completely closed source, right? And decided by token holders even though, and green lighted by token holders, but closed source, right? And so it's very clear that there is a better need for in the space for like more robustness and more flexibility at the same time in the things we want to do. We could argue also more efficiency, but really the two main things are like security and flexibility. And so modularity emerged as a solution to this trade-off, right? As a solution to those problems. So the idea of like modular platforms in general is that you can create your own lending platform and configure it the way you want. With anyone can become manager and essentially provide a unique risk profiles to users given their appetite, right? And that's really interesting because essentially the idea is that you can essentially fit the risk profile of pretty much anybody, right? Like you can create a lending pool, a fork of Aave, for example, or Compound that is specifically designed to answer a specific use case, right? And this is what Maker did with Spark, for example. Like they had some specific needs, and so decided to fork the Aave v3 implementation in order to be able to answer those needs, right? And even though that's a great approach, it has some downsides as well. Like as soon as you start creating two different instances, you fragment liquidity, right? And even though you can sort of like mitigate that through composability, like for example, if you take Compound, Aave, Spark, they have a lot of like collateral in common. And they have a lot of collateral in common, but they don't share liquidity with one another, right? And each instance is going to fragment liquidity even further, right? The second thing is that you have a lot of different it's harder as a user to make your choice, right? When there is just Aave, then okay, it's fine. You trust Aave, you just deposit in Aave. If you have multiple options, and we were discussing this during the panel, well, you have to make your own decision, which complexifies the user experience. And the last thing is that modular platforms in themselves are frankly just a code library at the end of the day, right? It's just like you have a piece of code and anyone can deploy it, right, and build their own lending protocol. The same way people used to fork the Aave v3 or the Compound v2, not Compound v3, but Compound v2 instance. The code in itself does not create value. What creates value is, as we were discussing, the state and the management of it, right? So the new use case that we create by forking the Compound instance or the Aave instance will generate value because there is some liquidity, so we match lenders with borrowers, but also because we do proper risk management. Right. So in one case, we have the monolithic approach, which has the nice aggregation of all the liquidity. And I think if you haven't looked into it, the Aave v4 forum post explained how they're essentially taking this even further and aggregating liquidity like no other like modular approach would today. And the modular approach does not. They aggregate liquidity, but they're quite restrictive in what they can enable. And on the other hand, you have modular platforms that are very flexible. They let you create what you want, but then they fragment the state. They fragment the liquidity, etc. And this is where the concept of aggregation comes in. And I think it was a term that was first used in the context of a Polygon blockchain stack, where essentially you have the same, in the infrastructure side, the same trade-offs between monolithic and modular, and they came up with the term aggregation, which essentially is visualized this way, which is you have multiple instances, in some kind of, modular paradigm, but they share liquidity to some extent, right? And so the idea is that this aggregation at the liquidity level, like the goal is really to be able to have the flexibility of modularity while preserving like a common state to a certain extent. Right, so how do we build such thing, right? What does it mean, in practice to have like aggregation and shared liquidity, et cetera? Well, what you need in the first place is a flexible primitive, like core markets that are minimal enough and opinionated enough in such a way that they can be shared by multiple people, the multiple builders on top that want to express different risk profiles, right? And then on top of that, you have modular layers. So the core primitive in itself is not modular. It's flexible in such a way that you have multiple users coming to it, but the modularity comes on top, where you can essentially rebuild and abstract away all the complexity of having a primitive. So like the UX, the reaggregation of liquidity, the risk management, et cetera, et cetera. And the idea is that they are completely optional. You don't have to inherit from the entire code base, for example, of using a very large protocol that does at the same time UX, risk management, account abstraction, et cetera. You just take the risk of what you're essentially taking. Like if you want account abstraction, then you take the risk of like the tech behind it. But if you don't want it, you don't have to subscribe to it. Right, and so this is essentially with this philosophy that we built like MorphoBlue, which is we want something that's sufficiently primitive such that it can be recomposed into multiple modular instances that will share eventually those mini Lego bricks, elemental Lego bricks, right? So one market on MorphoBlue is really one collateral asset, one loan asset, one liquidation loan to value, and one oracle. It's as simple as this, and it's immutable forever. And some people like to qualify Morpho as modular, but I disagree that the primitive in itself isn't modular on purpose. It's actually very primitive and in such a way that it's generated in such a way that multiple users will be able to reaggregate on top. So that's MorphoBlue. The downside with this approach is obviously that as we were describing earlier, as a lender, you have to do your own risk management, right? You have to decide, OK, should I be lending to so I have some USDC. Should I be lending it to the pool backed by STEs? Should I be lending it to the pool backed by WBTC with what oracle, up to what, loan to value, all these kind of things, right? And so this is why we have a second layer, which is the risk management layer that we like to call Metamorpho, where essentially, you have risk experts that can build their own risk managed vault and provide this passive experience to users. So if you have USDC, well, you can go into the Block Analytica and RiskDAO vault, or you can go into the Gauntlet vault. Gauntlet, which by the way was initially a consultant for Aave and transitioned to this new model of providing service to users directly. And so you go to their vault, you provide liquidity, and they're going to do the risk management on your behalf, essentially. And this way, you have multiple vaults, expressing different risk profiles. Some of them will expose you to real-world assets, to blue chips like STEs, WBTC, et cetera. And the idea is that those different vaults, well, they can share some markets, right? They have some markets in common. So for example, in the chart here, you have market 2, which, for example, could be like WSTEs to borrow USDC, right? If 2 vaults of USDC list this market, they would share liquidity. So to recap, if you have Compound and Aave, they both list STEs, they don't share liquidity. if you have two metamorpho vaults replicating similar risk profiles as Aave and Compound, they will share liquidity to the extent that they share risk. Anyway, so that's a quick recap of like the approach that you have on one side and on the other side, where essentially the recap is that we break into two pieces, the risk management and the liquidity and interest accounting part, such that the risk management is modularized, and anyone can plug into those elemental bricks that share liquidity and aggregate liquidity. Okay, so this is what the stack looks like in practice. You have different risk profiles. With some for example, Steakhouse Vault has a bunch of like real-world assets. Some people don't want exposure to this. The Block Analytica Vault is extremely blue chip around assets like STEs, WBTC, SDAI, etc. RE7 is more oriented around LRTs. And sometimes all of those markets, they do share some markets. So for example, the WST Swiss markets is shared by a bunch of those different risk creators. And so they will share liquidity to the extent that they share risk. And so, at scale, this is sort of like, what the stack looks like. I just presented Metamorpho, but there are many layers of abstraction that you can rebuild that either reaggregate liquidity, that arbitrage rates, reaggregate liquidity for lenders, but also for borrowers to get like a very similar experience to what you have on a Aave or a Compound. And again, as a user, you don't have to subscribe to all of this. You only subscribe and you only pay for what you need, essentially. And obviously, the advantages of that is that we have like a very immutable and robust core, which is frankly something we, as builders on top of Aave and Compound for the last 2 years, we wish we had integrated. And finally, the obvious upside of all this is that network effects compound, right? Like the more builders we have around the stack, the more liquidity and the more efficiency you get into this free market model, essentially. And so the more liquid and more efficient everything becomes. So yeah, that's it. I don't know if you have any questions.
All right, so, OK, we have the first question right here.
Hello. The Metamorpho number of where you've offloaded risk management, or it's outsourced, or however you want to describe it, extrapolated away. And as you mentioned, some of the people doing risk management now for you are former, and maybe even current, I don't know, working with Aave. So there's obviously overlap there in expertise. But I'm curious, is the risk there that over time we're going to see consolidation at that layer? So now where you have lots of different people doing different things, and you can choose, but the reality just might be that in 3 years, 5 years, I don't know, Gauntlet or Steakhouse, and they're doing 90% of the risk management. And you're kind of back where we are, if you will, today with one large entity kind of controlling your risk management.
Right, so I think that's a great question. So the first thing I would say is that it's very unlikely that the risk profiles of the entire humans, human beings, all comes back to one risk profile, right? So it's pretty much sure that we, as humans, we have different, risk appetites, and that we want to expose ourselves to different risks, right? Then we could make the point that, maybe, I don't know, like RiskDAO or Block Analytica are going to spin off, 5 different vaults, and each vault is going to cater a specific risk profile. But in practice, some of those vaults require like a bunch of expertise on specific assets. Like if you take real-world assets, for example, like Steakhouse has like a deep expertise on those things, right? RE7 is more deep into LRTs and those kind of things. So I think right now we're biased in the sense that DeFi is merely merely $100 billion, but the over-collateralized lending market in TradFi is $1 trillion of volume daily, and they all have very different risk profiles, right? So eventually, you could imagine a world where you can extend this to eventually, credit underwriting as well, right? Like where essentially Metamorpho vaults can do algorithmic risk management, but also, essentially become credit funds, right? And so our take is that yes, in the current state of DeFi, which is frankly quite small, it is possible to fungibilize everything into one mega pool, right? That we all trust, and that will cover 50% of the market, which is approximately what Aave has right now. But as DeFi scales, I'm having a hard time believing that all humans are going to be treated equally in one protocol. And also, the second thing is that it's a free market, right? So it's completely permissionless, it's completely open. So, if one player starts to become, very big, then you can challenge, this player, either by lowering the fees or by going for more risky things or innovative ways. I think open source has been a great differentiator among it's been very interesting, frankly, to see all the different risk creators competing with one another. One of the differentiator, of course, is the fee, but the other one is open source, right? How do you open source, your LTV formula or this kind of thing. Anyway, I hope it answers the question.
All right, thank you. So yeah, please thank our speaker. And now please welcome the next speaker, Gisli Christiansen from Monerium. And the title of this talk will be On-Chain Fiat, the Wallet Awakens.
Hello, everybody. It's good to be back. It's good to be back in Berlin, and it's good to be back here at DappCon. I wanted to talk to you today about stablecoins in general, but more specifically, I wanted to talk to you about on-chain fiat. And for those of you who don't know me, I'm Gisli, the CTO and co-founder of Monerium. To kick things off, I would like to gauge the audience by a show of hands. Who here uses stablecoins? OK, very good. A lot of you in the room. Is there anybody here that gets their salaries paid in a stablecoin? Well, I see a couple of hands here raised. So I think we've seen the emergence of stablecoins and their utility all around DeFi. They were instrumental in the protocols like Morpho, lending, payments, exchange, all of this good stuff. But if we really go back in time and ask ourselves, when did the stablecoins emerge? This was in a time long time ago, and this was essentially a solution to the problem of cryptocurrency exchanges not being able to open up bank accounts. So it really shouldn't come as a surprise to anybody that stablecoins are mostly denominated in USDs. And the USD is kind of the king when it comes to cryptocurrency speculation and everything that followed. Now, to maybe drive that point home, I'm going to show you the evolution of the stablecoin market for the past couple of years, broken down by currency, and this is our favorite metric, of course, the TVL. So, as you can see here, the euro is the red one, right? And this is kind of interesting to see, right? Does this mean that there is no real demand for non-USD stablecoins? Does this mean that the euro doesn't belong on chain? What do you think? I mean, I think it's a legit question, right? So in Europe, of course, OK, so you get your salaries paid in DAI or USDC, and then you want to use it for something from day to day. This usually means that you then have to move your tokens to an exchange and place them in an order book for a euro. This is where you incur fees. There's a lot of complexity there. And then you have to maintain an off-chain bank account, because you aren't going to be able to send your euros from Kraken directly to your landlord to pay for rent, right? So you'll have to have an intermediary bank account. And oftentimes, the bank will kind of reject the payment because it's originating from crypto. It's easier for the bank to say just, no, we don't understand this, so you can't use this. And recently, I don't know how many people know this, but at the end of next month, MiCA is entering into force. And this is going to change a number of things. What exactly? I don't know. But whether you love or hate MiCA, it essentially lays out a framework, a set of rules that stablecoin issuers need to adhere to. So Monerium, we are the issuer of URI, and that is a stablecoin denominated in a euro. And because the stablecoin landscape is such a big topic, we like to talk about on-chain fiat. And you may ask, what the heck is an on-chain fiat? So this is a definition that defines what an on-chain fiat is. And when we decided to put the euro on chain, these were some of the fundamental properties that we thought were so important. It needed to be real money. It couldn't be a proxy for something else. It just had to be the euro. It also needed to kind of adhere to the crypto ethos. So it needed to be your wallet, not some Monerium wallet, exclusive wallet. And it needed to be your money, just the way we like it. Third thing, it needed to be DeFi native. This couldn't be another bank coin, which wasn't usable, wasn't an ERC20, didn't have the properties. So it needs to be able to talk natively to the protocols that have been innovated on in DeFi. And then as a fourth point, all the fuzzy logic that I was talking about earlier about going through the exchanges, it never made any sense to us to go to an exchange to buy currency. So interestingly, because we are regulated and we are future compatible with MiCA, we can talk to TradFi as peers. Sure, we'll have to put on a suit, but still we can. So probably the biggest, one of the bigger innovation that we have done in the last years is the Web3 IBAN. And I'm not sure how many of you are actually familiar with it, but just to give it in layman terms, so you have your blockchain account, and you have the address, the wallet address, to talk and transact with smart contracts and peers on chain. But what we give you, or your wallet, essentially, is the superpower of being able to talk with another kind of identifier, the IBAN. So you get a personalized IBAN in your name, and now you can speak and transact to your friends in TradFi. You can receive money from anyone in the SEPA system, and you can send money to anyone in the SEPA system. It's truly magical if you haven't experienced it. So some people ask us, like, hey, how are you guys doing? And at least by one metric, we're kind of killing it, right? So last month, we surpassed the 1.1 billion mark. This is not TVL, but transactional volume, right? The TVL is still pretty minimal at 15 million, but I think this graph alone proves that the euro belongs on-chain, and it's not going. But it may be the case that it's going to be used differently than a USD counterpart. So we are, of course, here. We've all heard about Gnosis Pay. We're very proud to be powering the card. Not all of you know that when you put your money, you top up your card, it's a URI, and because we're regulated, we can settle with the Visa network. I think this is the first time, to my knowledge at least, where you have a self-custodial wallet that is connected to a card that allows you to spend it at 130 million merchants anywhere in the world. This is the power of the infrastructure that we've built. So it's not just card payments that the URI is being used for. Here's a great example. When I was on stage here last year, I talked about URAMP. Back then, this was a proof of concept. This year, we have it in production, but not we. this is a third-party UI that connects some of the components in a very interesting way. So for those of you who haven't used it, what you do is you connect your wallet to it, and then number 2, you connect your Monerium account. And this essentially gives you a bridge from DeFi to the banking system. So back to the example for the users that get their salaries paid in crypto or stablecoins. What you can essentially do is you can go from any chain. So let's assume that you get paid in DAI on Optimism. You type in the number, you get a quote, and then you go directly into just typing in the bank account details of the recipient. This could be your landlord, and whenever you hit the send, you're going to sign it with your wallet, and then literally a few minutes later, the landlord will have the exact amount in their bank account, and what they'll see is your name. It's not going to be Monerium or anybody else. So I really like this use case here. But in order for this to work, like in order for all of this to come together, there needs to be some liquidity. And what we are seeing is that the exchange liquidity pairs are being aggregated mostly on Gnosis chain. And right now, there's about 7 million euros worth of assets in those pools. So users are starting to transact here much, much more. This is kind of unlocking that use case, both for Gnosis Pay and for UWrap and others. And of course, you can use some aggregators like CowSwap, 1inch, even UWrap to figure out the best routes for you. But this is happening. Lending and borrowing. Aave recently deployed their smart contracts on Gnosis chain, and something interesting started to happen there. We see, of course, the common tokens there, but you can see the URI there, right? And this is the first time, to my knowledge, a euro enters into Aave. And if we start to look at the data and analyze what users are doing, essentially they are going from DAI, staking it to SDAI, getting roughly 12% on their DAI. And then when they're ready to spend it, they actually borrow the URI. There's now 2 million euros worth of liquidity in Aave on Gnosis chain. So they borrow it just at the time of spending, and in the word of one of our friends, they are essentially getting paid to use URI for payments. So it's interesting to see some of the yield strategies, and I think this will be a future theme for the euro on-chain as well. So here are some of the observations that we've seen. As I was going through, the euro on-chain definitely has a spot there, but it's going to serve a different role from crypto speculation. And so we should maybe not think about the TVL there in the same way, but rather how much is it being used? And I think the volume there is an indicator there. On-chain fiat, the way I kind of like to think about it, seems to be an interesting way, because it unlocks many of the use cases. You can go back and forth, and this really has the power or potential to become the daily driver of those of you in here that are, living on chain, getting your salaries paid in crypto, and so on and so forth. And maybe the third point is that Mika is entering into force. And it's going to be interesting what that essentially means. We're already seeing some news being circulated in the media about Tether specifically being delisted from the exchanges. But this, in theory, should apply to Circle's USDC as well, because they are not compliant with the regulations. So what is that going to mean? Is that going to mean that companies who are paying in dollars today will start to use euros on chain. I don't know. Let's see. Another theme that we're seeing also is that real-world assets denominated in euros are coming on-chain. I know Christoph Jetzt was here earlier talking about his tokenized platform, which is essentially a crowd investment platform where the cracked case of, like, I at least like to think about it like legal ICOs, where you can invest. We, of course, have seen the BC3M, which are the tokenized government bills, and we see some of the pools appearing in Morpho. And another theme that we're seeing is that many of those projects are finding home on Gnosis. It seems to be becoming sort of the home of the European DeFi. And it shouldn't really come as a surprise. I mean, it kind of makes sense. When you have those different projects, there's a synergy between them there. So lastly, I would say that the infrastructure is maturing, and it's probably a good time to start to put more focus on the application, the user application themselves. And I am really happy to see some of the wallets that are being announced here, the Matri wallet, the Seal, who are essentially taking all of this, all of those pieces are out there, and instead of like having the user wallet connect to random websites, change the chains and everything, they're kind of abstracting all that away, allowing the user to use passkeys instead of seed phrases. I mean, I am the naive optimist. I always think mainstream is around the corner, but it really feels like things are coming together now. So maybe not all of you know that we are optimizing for onboarding users through partners like Gnosis Pay. So behind the scenes, every card holder becomes a Monerium customer. All the investors of Tokenized become Monerium customers. But if you're out there and want to have a more direct relationship with Monerium, or if you're a builder out there building cool stuff and want to have access to our infrastructure, I have some invite codes to share with you. So if you're interested, please find me afterwards. I'll be around, and I'll hand them out. So thank you.
OK, so that brings us to questions. So do we have any questions from the audience? Oh, yeah, there's one.
Hey, thank you for the presentation, very insightful. We've seen in the US that maybe recently there might be a shift from policymakers into how they see crypto. Maybe there is an opportunity, they see it as an opportunity for the dollars to acquire even more dominance in the on-chain world and online world. Do you think there's something similar as you're closer to maybe to the European regulators can happen also in Europe? Like, is there a chance for Europe to start being more proactive or more favorable or even like optimistic about the on-chain world?
So I actually think Europe is way far ahead, to be honest. Not everybody loves Mika, but it gives you a clear set of rules. At least I know I'm not going to jail, right? We've seen the CEO of Circle kind of ask the US Congress to regulate them because there's just uncertainty around everything there. So I sometimes think about, remember the days of mobile phones when you had competing standards? GSM was the European standard, and there was another standard in the US. And if you wanted to call between the two continents, you couldn't. The GSM standard became an export product for the rest of the world, and now we can all talk together. And I think something like Mika, something like e-money could become that. So in Europe, there's legal clarity. we can issue the euro. We are already issuing the pound as well to support Gnosis Pay, but we can issue any currency out of Europe, including the US dollar.
Okay, we have another question there.
Okay, I guess it's my turn. Did Monerium come up with the configuration of, or the title like e-money, or is that something that came from regulators, or where does that come from?
So the crazy thing, this has been lying in plain sight for over 24 years. E-money is the equivalent to digital cash in Europe. It's a license that can be passported. It's been used by the major fintech players. You probably used Revolut or PayPal or Klarna. They've all been EMIs at one stage. And when we started out like creating on-chain fiat, we researched into different jurisdictions to figure out what is the best way to represent fiat on-chain. And the e-money license, which had already existed for 20-something years then, was there. And this has now been kind of enshrined or confirmed into MiCA, that this is the way, if you want to issue stablecoins in Europe, that is the way.
Okay, and I think we have the last question here.
Regarding transaction fees and Visa, I think it was like a great strategic decision to use Visa as like a middleman to the TradFi payment rails. But do they charge a transaction fee? Is it like 0.8% or something? And like, what are your strategic plans for the next years? Is there actually a way for an e-money licensed institute to access this? What is it, SWIFT or whatever? I don't know.
Yeah. So that's a great question. So I'd have to defer the Visa part to Gnosis Pay, because they're essentially handling that part. We are the underlying settlement layer, right? So in the traditional world, there are like two processes that take place. One of them is the authorization, and the second is the settlement. So all euros being settled through Monerium, whether it's the cardholders or any other, are for free. Like you can move money across the boundaries for free. So we are investigating other payment rails, faster payments in the UK. So yes, we definitely, as an EMI, have the option of connecting directly into those payment rails, right? So I think that's one of the upsides of having a regulated stablecoin. And also on that front, because Marcus earlier today was talking about separating the bankers from banking. What it means for me is that we, as the issuer of the stablecoin, we take care of the rules and regulations, and the Dapp builders on top, the Matchy wallets, they don't need to care about it. I know a product person from PayPal who had to liaise with over 500 persons across the organization to push out the release because they were holding customer funds. Now we have those teams building on top of stablecoins, including the URE, and they can push out changes much, much faster without liaising with 500 persons. Yeah. Thank you.
Okay, I'm afraid we don't have any more time for questions, so you guys can take it offline. But yeah, that was Gisli Kristiansson from Monerium. All right, and that takes us to the next speaker, who is Jan Felix Schwartz from Gnosis Guild. And he'll tell, well, the title of his talk is Smart Account Roleplay. Please welcome Jan.
All right, if I touch it, it's off. Okay, completely. Okay. Yeah, welcome everyone. I'm Jan from Gnosis Guild. Gnosis Guild is a small team incubated at Gnosis, but now working independently. And yeah, our interests and expertise is centered around research, design, and implementation of on-chain organizations, governance, access control systems, and trust-minimized applications. We are probably best known as stewards of the Zodiac open standard for modular DAO tools. And as of today, more than 150 on-chain entities utilize our modules, safeguarding more than 2.5 billion in assets. Working in the space of DAOs and looking at on-chain organizations of today led us to a somewhat dissatisfying conclusion. Most DAOs operate trustfully or inefficiently. It's inefficient to have a top-level vote on every single action. That's why most DAOs delegate certain responsibilities to a smaller group of people. And this is generally a good thing, as it's much more efficient for decision-making. However, it also means that a small group of people has broad control over the DAO. And it's this dilemma that we see a lot of organizations struggle with. In many cases, they even get the worst of both sides, like they overwhelm token holder attention through some form of decentralization theater, while in the end it's actually a bunch of people on the multi-sig who are in control. So for today I thought, let's learn from and look at one of the few DAOs that actually are successful, that do it right, ENS, the Ethereum naming service. It's governed in a truly decentralized fashion while still operating effectively. And to understand how they do it, I thought I'd briefly walk you through the history. The ENS project was started in 2017 by Nick and Alex from the Ethereum Foundation, but the ENS DAO really only came to life in 2021 with an airdrop to over 100,000 eligible addresses. And everyone claiming that airdrop chooses a delegate. And a delegate is a community member you trust to represent your opinion in governance. Then governance happens through two forms of proposals. There are proposals for social consensus on Snapshot, and anyone with a total delegated voting power of 10K ENS is allowed to post them. So this mechanism mainly serves to weed out spammers. But then to actually execute stuff, you need to submit an executable proposal, and the bar for that is higher, 100K ENS with a quorum of 1 million. Since it would be asking a bit too much from delegates if they have to pay attention to every single action the DAO takes, the ENS DAO, shortly after the airdrop, already introduced working groups. And working groups allow decisions to be made and funds to be distributed without being passed by the DAO through an executable or social proposal. Each working group has 3 stewards, and these stewards are elected for a 6-month term. And then the working group can request funding from the DAO and spend these funds at their own discretion. In order to stay long-term sustainable, even in the face of a long bear market with low name registration income, the ENS DAO in March last year formed the ENS Endowment. And the idea here is to set aside a substantial amount of the DAO's treasury to generate yield from DeFi investments. And these investments are actively managed in order to reduce risks. This requires control over a much broader share of the DAO treasury compared to what a working group would usually request. And this brings us back to the conundrum mentioned earlier. So we need a small group of fund managers that are in control and able to move quickly, but in order to react to market or risk events. But if we have this group, they can, of course, also do other things. So do we really want to trust such a small group of people with such a major part of the DAO's treasury? The answer to this conundrum lies in the Zodiac roles modifier. Our roles mod is an on-chain permissions module for smart accounts. It allows on-chain entities to extend secure transaction permissions to any address through customizable roles, allowing member addresses to act on behalf of the account. So why do we call it a modifier? It's a It's a module you can enable on your account, but why do we call it a modifier? In our Zodiac design system, we have 3 kinds of building blocks. At the bottom, we have the smart account, so the thing that holds all the assets and that you actually want to control. And on top of that, you can enable modules, other smart contracts, enhancing the account functionality. And then there's this special class of modules we call modifier. And these modules are special in that they expose the avatar interface again, meaning you can enable other modules and stack other modules on top of them. So looking at the ENS endowment setup, they basically spun up a fresh safe to hold all the assets earmarked for investments. And this safe is fully owned by the DAO, meaning it can only be controlled through executable proposals. But then they equip the safe with the roles modifier. And on top of the roles modifier, we can enable other accounts to act as role members. So the treasury management team, they use their own safe to interact with the different DeFi protocols on their day-to-day operations. And this safe gets enabled, and a role called manager is assigned to it. A new role in the roles mod generally starts with no access whatsoever. So as a next step, we need to define the permissions for the role. Role permissions can be as broad as allowing all calls to a given target address, or you can scope a target to allow role members to only call to selected functions of that contract. And sometimes you might even want to enforce certain restrictions on how to call a function, like the allowed parameter values that a function may be called with. And for that, the roles mod brings a powerful system of conditions. So conditions allow you to basically define the acceptable field values in call data. And for that, you have a range of expressions, like logical expressions allow you to define combinations, like to enforce certain combinations of parameter values, or to allow multiple different variants of calling to a function. And we even have complex expressions allowing you to drill down to nested tuple fields or to enforce restrictions over elements of an array. And finally, conditions also allow you to tie in allowances. And allowances are a mechanism to enforce rates and limits. So each allowance is centrally defined on the roles mod and carries these fields of information. Refill is the amount by which the allowance is topped up for each period until it reaches the max refill threshold. And the period just defines the duration of that refilling interval. The balance field tracks the current allowance balance, so it is increased for each period and decreases with usage. Once defined, you can consume allowances through conditions. And for this, we have 3 different condition expressions. Using a within allowance expression, you can apply an allowance on a parameter field. So this works for uint type parameters. And as a role member makes a call through the role, the observed value of that parameter will be checked against the current allowance balance. If it fits, the call passes and the allowance balance will be reduced by the observed amount. If not, the call would be rejected. And in a similar fashion, you can also enforce allowances on the Ether value sent with transactions, or you can also restrict like the call rates, like how often a function may be called in each period. So with this general overview of the roles mod's capabilities, let's come back to the setup for the ENS DAO. I thought I'd walk you through the process of actually setting up these permissions based on an example of a fresh new role. So the idea here is to make the operations of the treasury managers more efficient by automating certain repetitive tasks, such as claiming rewards from liquidity positions. And for this purpose, we want to define a new harvesting role and assign this role to a bot. And this bot could then, on a daily basis, automatically claim the accumulated rewards from different DeFi protocols to make them available for reinvestments and compounding returns. So how do we do this? How do we configure this role? A good starting point is our permission starter kit project that you find on our GitHub. And with a click on this button, you can copy this template into your own GitHub account to start your own permissions repository. Once you clone this repository and open it in a local editor, you can start working on it. And the first thing you do is basically opening the included contracts file. And in this file, you can just paste all the contract addresses you want to allow role members to call. So the ENS DAO holds positions on Uniswap v3. So we include the positions NFT contract. And they also use Compound. So we add the Comet rewards contract, which distributes rewards to lenders and borrowers on Compound. And you can basically choose whatever structure you like for this file. So this is really just meant to label and organize the contract to be able to refer to them in the next step when defining permissions. So defining permissions happens in the roles permissions file. And you can simply add a new entry to it by typing allow, and you would see the editor automatically suggesting you the contract entries that we defined before. So here we select the Compound Comet rewards contract, and it would then start suggesting the functions of that contract. So we can select that we want to allow the claim function, effectively allowing role members to claim accumulated compound rewards back into the endowment safe. Already before, we've added an entry for the Uniswap collect function. And if we look at the parameters of that function, we can see that there's a recipient field. And we don't want the bot to be able to claim rewards to any other address than the ENS endowment safe, because if the bot's private keys got leaked, this would open the doors for anybody to steal accumulated rewards. So what we can do here is set a condition on the recipient field. So in this case, we force it to be equal to the avatar address. So all calls with a different address would be rejected. So with these permissions in place, the next step is applying them to the actual roles mod we deployed for the ENS DAO. And this happens by running a simple command, the command apply, followed by the identifier of the role and the address of the roles modifier. By running it, this would open a browser window, taking us right to the Zodiac Roles app inside the ENS endowment safe. And this gives us an overview of the configuration updates that we are applying. So basically, provides a comparison view of the permissions we just defined in code, comparing them to the conditions that are, permissions that are currently configured on chain. And if we scroll down on this page, we find an execute button, or we can just simply copy the transaction payload and post it as an executable proposal on Tally. And once this proposal passes and the DAO confirms these permissions, we could launch our harvesting bot and do even more efficient treasury management in the future. Just like ENS, we have a couple of other DAOs using the roles mod for trust-minimized treasury management. So we have Gnosis DAO, Balancer, Cow Protocol, and this list is steadily growing. But the roles mod is also useful for other use cases. In fact, every single transaction you make with your Gnosis Pay credit card goes through a roles mod. It's a component that allows the card payment settlement service to withdraw Monerium euros from your safe without having any other control over it. And also, the roles mod's allowance mechanism is used to enforce the card's daily spending limit. So with that, I hope I could give you a glimpse of the powers and possibilities enabled by the roles mod. It really is a foundational primitive for on-chain permissions. And we hope that it will inspire new access control patterns. For example, instead of every protocol building their own flavor of delegation, we could have apps propose role configuration to extend strictly scoped permissions to some delegate address. And in this spirit, we hope that roles opens up the space for play and experimentation and for new ways of interacting with our decentralized systems. Yeah, the best place to get started is roles.gnosisguild.org. And yeah, don't hesitate to reach out to us on our Discord. We are always happy to help and support you on the journey. And I think we have maybe time for one question, not sure.
Yeah, we have time for questions for sure. Is there anyone in the audience that wants to ask anything? Anyone? Okay, I think, not really. All right, thank you so much.
Thank you.
That was Jan Felix Schwartz. And we'll have a short break, and we'll come back to you in a few minutes. Okay, hello again, and welcome to our last panel for today. Beyond custody, the emerging role of Web3 gatekeepers in traditional payments. And our moderator will be Karan Eswani from Gnosis, and he will be joined by Andrea Camacho from Elliptic, Marcus Nunes from Gnosis Pay, and Julian Laidlaw from Fractal. Please welcome our guests.
Good afternoon, everyone. I'm Karan. I'm the CLO at Gnosis, and I'm going to be moderating the discussion today on the role of Web3 gatekeepers in the context of traditional financial systems. And I mean, we've seen, a significant transformation as we're starting to adopt new Web3 technologies and fulfilling the role of gatekeepers. And integrating those to provide access to traditional financial systems and institutions. And the purpose of discussion is just to explore in a bit more detail today with the panelists on how that function of Web3 gatekeeping is changing and redefining the role of financial intermediaries and the way that we grant access to these systems. Just like to ask panelists maybe to give a brief introduction of yourself and your projects, and then we'll get into some questions.
Sure. I can start. So my name is Andrea Camacho, Principal Product Manager at Elliptic. My job is really to build solutions for our customers to make sure that we provide visibility and transparency about their users' footprint on chain, making sure that they have visibility and a level of comfort knowing that they are happy to provide a service to them. Imagine, for example, you're a traditional TradFi institution that is dipping their feet into crypto, or you're even a native Web3 company. The first thing, or very close to the top of your agenda, you want to make sure that you're not interacting with criminals. You're not, for example, facilitating money laundering within crypto. You're not financing or facilitating payment that end up financing terrorism. And so my job is really making sure that we create these solutions that help protect both the users and our customers that are asking questions about their users.
Well, good afternoon, everyone. Thanks, Jens. Marcos from Gnosis Pay, basically eliminating barriers between Web3 and Web2, hopefully making everything turn into one.
I'm Julian, one of the co-founders of the IDOS, and we are all about identity. The IDOS is a decentralized storage solution to store user data, and we all know the proof of personhood use cases. Our thing that we want to solve is to be able for the identity to be also be used in highly regulated use cases. And I guess that's why I'm at this panel.
Thank you. So maybe we'll start with some general questions that I'll put to the whole panel, and then come into a bit more specific questions on each of your specific projects. So maybe I'd like to put it to all of you, like, how do you see the role of gatekeepers changing as we start integrating more Web3 technologies into traditional financial systems and bridging that gap that currently exists today?
Yeah, I can probably start and give my view here. So it's a very interesting question, because I feel within Web3, the dynamics are really changing. And when in traditional finance, the role of the gatekeeper was the same and was within a specific company to ensure that there's very good visibility about who are the participants that are leveraging the service of the institution. In Web3, we're starting to see this separation between the role of the gatekeeper and the role of the companies or the project or the sort of service that helps to provide visibility about the activity. I see myself and I see Elliptic more in this second space where we provide visibility about one's on-chain footprint. And that's very distinct. We tend to not be particularly opinionated on the level of compliance risk that a user poses, because the role of the sort of like gatekeeper and the ultimate decision will still sit within a traditional institution. However, what's very interesting is that the whole technology starts to become a bit more of a primitive that is extrapolated out of the financial institutions and then is made available to a much wider audience. There's a lot of efficiencies to be gained and also an increased level of effectiveness with which this new type of primitive can help to provide visibility.
I'm personally very enthusiastic about this topic. First of all, because when you're trying to connect two worlds, the old or the traditional world, all the decisions based on are you allowed to transact, are you allowed to have an account, are you allowed to hold money, they came from an understanding of what a regulation meant. And that understanding had a lot of return on investment incentive, which means how many cents of a dollar do I need to invest in order to get a dollar. And if that user fits that profile, then very likely that you're going to be accepted to start banking. And the fact that we're now opening that Pandora box and put it in a format that is a lot more transparent if users are available to transact, like if they can, if their information, well, it's blockchain, right? It's you carrying with you, which is the entire objective of open banking and regulators in general. So when you actually go from that angle, I feel like ensuring that gatekeepers have the right understanding of the user and the users are actually worried about how are they going to be perceived by institutions, that's a good, that's a perfect new world to tap in.
I believe that if we're looking at those two systems right now in the financial world, we have the current banking system and we have the DeFi side, right? And those are on very opposite poles. And ideally, we have a very permissionless system in general. Now, in the last decade, we haven't really seen the adoption in the crypto side. And I believe that for us to really change that, it's the base question of do you change a system by completely erasing it, building something new? We've tried that. It got us here, which is quite far. But I think if we really want to go to the mainstream people, then we need to change it from within. And I think that will, in general, make it better. Because I'm kind of tired to just have this technology be available for technical savvy people as well, which also I believe is a restriction. Now, do I like that there are central gatekeepers in also the whatever the new system is called, somewhere between banking and DeFi? I really don't. And I think that the current systems are not nuanced enough by far. For example, we do not want to just keep people out because they are misfortunate to be born in a certain country, right? But unfortunately, this is what we have to enforce today. So by giving different options, and this is the thing that we are excited about, we might be able to help because people are finally able to vote by their feet who they want to identify themselves with, to change that one by one, because right now we're living in a very monolithic world when we're talking about finance. If you're in one bank, you can only use the products that this one bank has. And this is terrible in the first place. And we're not talking even about like having something available that is beyond your nation state, right? But I have to admit I'm quite conflicted when it comes to being even on this panel, you know, because I guess this is why we are all in that space, to reduce the impact that central gatekeepers have on our everyday lives.
I actually want to build on this because I think it's a very, very interesting point that you made. When I read the sort of title of the panel, I was like, I'm not a gatekeeper. I don't want to be a gatekeeper. And actually, I think that's still something that you can reconcile together, right? I feel like company like ours and projects like ours help to provide transparency and visibility about certain information. And then the virtual asset service providers, the TradFi, the various Web3 natives, everybody with this new added visibility have the opportunity to decide, I'm comfortable interacting with this user, I'm comfortable providing services, or I'm not. But I think the gatekeeping side still sits within whoever provides the service. While I feel like our role is more, this is going to be a horrible analogy, but more like a Garmin watch where we provide information, and then it's up to you to say, well, I'm comfortable with the number of steps that I did today, or I'm comfortable with the number of runs that I've made this week.
Allow me to slightly disagree. And maybe there is a fundamental element. Today you have centralized companies which are saying, I am the guardian of your data or the gatekeeper of your data, and I'm giving you access to interoperate in finance. Once you're separating bankers from banking, maybe I'm a bit biased on that view, then you're kind of shifting responsibility. That entire view that you're just basically providing someone with software, that's a short-term thinking. On the long-term thinking, our responsibility is not going to be anymore to collect those 30 data points on where do you live, white person, blue eyes, engineer, potentially not a risk to the community. Our job is going to be to effectively collect thousands of data points and then provide with certainties or provide with more guidance for decisions to be made. And then there is an element of risk, which is still going to be held by service providers to say, do I want to serve this person, yes or no? But the guardians and the gatekeepers are those that are basically able to help tracing this data and not just give it with a generic flagging system that someone one day implemented, but rather basically help to say, okay, now I'm connecting all this information, and from our view, this should be with X amount of percentage. This person is legit, his business activities are legit, up to you if you want to do business with that person, yes or no. So I think in one hand, you have a greater responsibility compared to the past. On the other hand, you also have a greater opportunity to then become a lot more relevant, because KYC is not about just saying, yeah, passport, data, address, but then again, it's a more intelligent, intelligent is not a word, but a lot more valuable to the community information.
I think that's a really interesting point, because blockchain technology gives us access to so many different data points now that are permanently recorded on chain, and that can be linked to a particular account that gives us visibility on people's behavior way beyond what we're able to access today without the user volunteering that kind of information, right? And that opens up all new kinds of risk analysis, right? And I think the role of Web3 projects who are trying to bridge that gap is to demonstrate to TradFi and to regulators how we can achieve the same regulatory objectives, but just using different sources of information and taking a slightly different approach. And I fully agree with a comment that you made as well, Julian, which is around the role of centralized gatekeepers. I think we need to start transitioning into a decentralized model, right? But one that also is consistent with Web3 principles that can ensure that users retain ownership of their data and they choose how they share that data. And there will obviously be different requirements for different service providers on what is acceptable forms of data. And I think that will evolve over time, but it's a process that we need to start now to demonstrate, that we can identify people, that we can manage risk using different data points than what, we're accustomed to doing today with, providing a passport or a proof of ID or a pay slip to demonstrate your source of wealth. So maybe moving on then. So what are the biggest challenges that we face as an industry, to bridge that gap to TradFi and make them understand that there's a different way of putting guardrails in place to make sure that the wrong actors don't participate in this ecosystem and potentially taint it for the rest of us and paint us with that broad brush that crypto is all bad and blockchain is used for things that it shouldn't be used for.
If I may step in there, I think the main problem is that it's so easy to make money with meme coins that no one bothers to actually solve the hard part and to actually achieve what we set out when the Bitcoin white paper came out as a reaction to the financial crisis, to really build a better financial system. And I sometimes feel like we have lost track of that. And when I entered in 2017, I did so because I realized that this will bring open source into finance. And I have to say I've been a little bit disillusioned and frustrated in the last couple of years because I didn't see any progress here. So the thing that kind of gets me motivated is seeing Monerium spike. I'm not sure if you've seen that presentation a little bit earlier, that shows me that this is actually around the corner, and we're starting to bring, just like you guys, open source into that field. So I'm very happy about that.
I am less frustrated. I see actually something quite interesting. First, perception, truly perception. Let's recall what is KYC today in general. And let's recall what is the incentive from the regulator or the fintechs out there. Basic KYC. Who are you? Marcos. Prove that you are you. Passport. Where do you live? Proof of address. Every second kid that was born after the 2000s knows how to use PDF editor. And that person can make a bunch of adjustments. And by the way, every fraudster out there knows this better than anybody else. And then the incentive that regulators created was, because this is the way X person did it, then every fintech out there simply stays with that boundary. I collected the passport. I asked, what do you do for a living? And then that answer is sufficient for everybody to be validated. But in reality, what do we want? What is our incentive? I mean, do we want our kids to be among criminals? Do you want to raise a society of criminals? No. I want to live in a place where it's, free and people are not going to be harmed by others. So I want to make sure that we are better than anybody out there verifying that humans are humans, and they are saying the truth about what they're doing. In fact, I don't even want to ask them if I have the data available to make decisions. So I
How are kind of the tools that you guys provide helping traditional financial institutions kind of bridge that gap and start, having a little bit of exposure to the blockchain world and start accepting this as, a legitimate, means by which they can offer services to their users? And maybe if you can give like an example of a partnership or a case study of how you've kind of brought traditional finance into the, let's say, Web3 universe.
Yeah, for sure. And maybe I can start by saying that really in the last 2 years, we're starting to see a very significant traction within the TradFi world. Maybe 5 years ago, 3 years ago, we saw the very first shy dipping their toes within crypto of various traditional finance institutions that were looking at the opportunities there. Now there's a lot of building going on. And the way Elliptic helps TradFi and financial institutions in general is making sure that they get the comfort level that they would require within the older sort of more traditional fiat system and have at least the same level of effectiveness in detecting illicit activity within crypto. I'm not going to share the specific name, but one very, very large payment provider has relatively recently launched a stablecoin within a couple of networks. The only way in which they were able to do this is by making sure that they had all the tooling from an anti-money laundering perspective, from a KYC perspective, from a sort of ecosystem monitoring perspective with Elliptic that is able to then making sure that none of the users that are benefiting from this stablecoin, that are moving this stablecoin, are associated with activities that the TradFi will be uncomfortable with.
Amazing. I'm just conscious of the time, so I'll come on to a few concluding questions, remarks from each of you. Firstly, what trends do you foresee in the coming years, and how the role of this gatekeeper and the technology we use to execute that gatekeeping function, how do you think that's going to change? What do you think is going to be the main change that we're going to start to see? And then what advice or recommendations would you give developers and entrepreneurs wanting to build systems that can contribute towards this paradigm shift? And what are the things that we're missing from a RegTech perspective to give TradFi comfort, that they're not going to be servicing criminals or they're not going to be touching illegitimate funds? Marcos, maybe?
Yeah, so we started in crypto, of course, in the way it should. Freedom, let's build tech, and then we see what happens in the usage. Now, 10 years later, you see lots of usage, very tiny percentage, very, very, very tiny. And if I actually look at banking in the amount of fines they pay per year for actually not doing proper understanding of their customers, it's a lot greater than anything that happened in crypto till this date. So again, very optimistic. Trend itself, I see more and more worry on this topic in crypto, in the regulator, in the traditional banking. So I see that we can basically play that role for more people. Second, it was about, sorry?
What recommendations would you give developers or entrepreneurs wanting to develop?
Yeah, so my first recommendation is it's there for a reason, and I think the more you understand what regulation in general says, the regulation doesn't tell you how to do it, and it says more like this is what we're trying to reach. So actually, when you read it, it's actually very good. That doesn't imply that everything you do needs to be in a given format of a regulator. Things are much greater. So you can separate. We're building a checkings account. Every fund that goes through that checkings account has a certain rule if you want to play in a given economy, right? So I would say to put guns down, that scene from Inglourious Bastards, everybody with the guns under the table. It's no longer that time. I think it's a lot more like helping them to understand, because it's better for everyone.
Julian?
The trends that I see is a modularized finance, and the tip that I would have is not to build more infrastructure, but use those tools to build cool things, because you would have an intense advantage compared to the TradFi stack.
Maybe one very quick thought. I love all the sort of crypto sleuthing going on and seeing someone like on X or Twitter like following a North Korean hacker or following some terrorist financing, laundering the funds. That's absolutely amazing. And it's just so great to see that on the open, in the public, when all of that used to happen just within certain walls in the past. I think that's just amazing, and I want to see that exploding in the future and see that more and more. It's just great. All of us.
Amazing. Well, thank you to all our panelists. I'm not sure if we have time for any questions. If there are any, in case.
Yes.
Hi. So I have a question about, over the last few years, we see the more and more regulations coming in, ML 5, 6, 7 coming in the future, MiCA, OFAC sanctions, etc., being implemented. And it seems like the crypto is becoming a permissioned pool of users who can only access crypto after getting QIT'd, etc., etc. So I would like to ask, what's of the previous permissionless ethos will remain if we just mindlessly apply all those regulations and limitations?
I mean, folks in the US would love to have MiCA in place, because then they would have some guidance that they can follow to offer things in the first place, right? Like, I mean, not knowing what to do is the thing that hurts. The ability to just build on tools that actually matter for a whole lot of people is something that I deem extremely important, and just like staying in our small niche to build tooling for very technically savvy people is not something that interests me personally much to like spend my whole career on. What I'm interested in is building tooling that everyone could potentially use, and then we should, I think, also accept that we're living in a place where we all make this regulation, right, in a democracy, and where it's not that the people that have the most tokens make the rules, but actually the people itself make the rules. So if we don't like the rules, we should change that, and we should work on changing that. And having that technology, yeah, I think actually MiCA is quite okay there. Like, they let us do a whole lot, especially the P2P side, especially the data ownership side. They understand that. Is it perfect? No, certainly not.
So what's the difference between crypto and TradFi in the end? Like, if we regulate it a lot, what remains that is better than TradFi?
Maybe not really a direct answer to your question, but something I think it's very important to recognize is that the population, the people adopting crypto right now is very different from what it used to be in 2013, in 2015, 2020. And population and user groups evolve. That means that the values also change. And so while I think it's a very fair question to ask what's the ethos that remains of the origins, I'm actually much more interested in knowing what is the type of ecosystem that we want to create, right? What is the type of ecosystem that we feel crypto should be powering for the next 5 to 10 years? I don't have an answer, and I know that obviously there's a number of attempts that are going to be made, and we're going to have to iterate on a number of different angles. But I think it's a much more interesting question, asking ourselves, where do we want to be in 5 to 10 years?
So, first of all, thank you really very much for your question, because we always debate about this. And I think there's two momentums. And I don't think when you're KYCing, you're basically being a TradFi or you're losing the ethos of crypto. I think that's an incorrect thought. And allow me to say that because you have different situations. Think about if you are now an immigrant and you are coming from X country and going to Y country, and then you have to restart your entire financial life to have access to a SIM card. So I had investments in Holland, I sold a property in Holland, and I could not get a SIM card contract in the UK because I did not have, past 3 years, an address in the UK. So there's that element of, basic need that is already resolved with blockchain because data is portable. It's no longer defined by a country. Now, access to data, when given back to the user, to the owner, it's up to you how much you want to share and how much you want to participate in a given economy. And then I actually love the comment of Julian. The way of fighting is not by avoiding. The way of fighting is by basically having the understanding that it's not the best way of moving forward and eliminating. Because what's happening right now, and maybe a lot of the global instability, is created by passiveness. The more we're able to protect by being forward on knowledge, on understanding different cultures, different needs, then we can actually say, these are the limitations where I'm willing to live, and if not, I can move. But finally, we have a financial mechanism that allows the world to be one when it comes to moving data, and no longer being controlled by maybe worse names out there, but JP Morgans or Goldman Sachs of the world. Nothing against them, but I perhaps trust more Metri to be my service provider, or I trust Binance to be my service provider. So I think there's a misunderstanding that you are dropping the ethos. I think it's a lot more optimistic than that. I think it's just allowing you to participate at your own terms, but also under a given society terms, at any point in time. So I think gatekeeping, in my view, the responsibility of gatekeepers, the ones that are providing this access, it's a lot greater now, because if somebody screw up, my daughter will only have on-chain data, and that means her life is going to be, available to anyone if not done it in the right way. So I think I love this debate, and I think it's the roots of crypto or blockchain. It's actually the reason why the world is going to evolve.
Thank you very much. I think our time is up. So thanks again to all the panelists. And I'm not sure if there's something else on now. Yeah.
No, that's it. So round of applause for our speakers.
Thank you.
Thank you, guys.
Thank you. And thank you all for attending. That's a wrap for today, and see you all tomorrow. Thank you.